Good afternoon, everyone. I'm Aishwarya Singh, and it's an absolute privilege to welcome you to Crystal Gazing 6.0 Decoding the Next Bull Run, PMS AIF World's sixth annual event. What began 6 years ago as a thought leadership initiative has now evolved into India's most influential summit for the alternates industry, a space where vision meets expertise and data meets conviction. Today, we uncover the roadmap for navigating the next phase of India's wealth creation journey. Crystal gazing is not just another investment conference, it has become an annual tradition, a trusted forum where investors, fund managers, and industry leaders come together to gain clarity in an uncertain world. It is where we decode market complexities, identify emerging opportunities, and challenge conventional thinking to stay ahead of the curve. At PMS AIF World, we believe that true wealth is built on three pillars: quality, risk, and consistency, QRC. And this philosophy underpins everything we do, guiding our approach in managing rupees 1700 plus crore AUM across 600 plus UHNI and NRI families spanning 25 cities in India and 5 countries worldwide. Our commitment is simple: empowering investors with transparency, expertise, and deeply researched insights. We pride ourselves on being your advisors in navigating the world of alternates with transparency, expertise, and very insightful analytics. We at PMS AIF World help you make informed investment decisions. This year, Crystal Gazing 6.0 wouldn't be possible without the unwavering support of our esteemed partners. It's an honor to have 16 industry leading firms joining forces on India's most trusted alternates platform. Our partners are Title Partner ICICI Prudential AMC, Platinum Partners 361 Asset and Ampersand Capital. Our gold partners are Alternates by Axis AMC, Carnelian Asset Management and Advisors Private Limited, Tata Asset Management, Whitespace Alpha, and Wright Research. Our silver partners are Blink Investment Management Private Limited, Generational Capital Invasset LLP, Neogen Capital, Prudent Equity Private Limited, Code Invest, Sundaram Alternates, and Volvin Limited. This incredible lineup reflects the growing strength of India's alternates ecosystem and the collective mission to create sustainable wealth in a rapidly evolving market landscape. And this event is spread across 2 days, today and tomorrow. And for the next 2 days, we have curated a power-packed agenda featuring insights from 40 plus leading PMS and AI fund managers. They will share their strategies, perspectives, and actionable frameworks on navigating India's next bull run. So expect deep dives into identifying the next multi-bagger opportunities, mastering risk-adjusted returns in dynamic markets, decoding macroeconomic trends shaping investment strategies, exploring new age investment themes in the alternative space. And for our virtual attendees, we've designed an immersive experience with an exhibition hall, breakout rooms, networking lounges, and interactive Q&A sessions. I encourage you to explore these features and make the most of this summit. And now, to set the stage for this extraordinary journey that we are going to be on together, I'm delighted to invite Mr. Kamal Manocha, founder and CEO of PMS AIF World, to share his opening remarks. Thank you, everyone. Let's get started. Mr. Manocha, all yours.
Thanks, Aishwarya. Welcome everyone to Crystal Gazing 6.0. The topic for this year's summit is decoding the next bull run. This event is meant for our esteemed clients and savvy investors like you who are very serious about investing in alpha-focused investments. As I mentioned, in this particular summit, we are going to decode the next bull run. Markets are in the consolidation phase, and history tells us that during the consolidation, there are new sectors that emerge, new themes that emerge. What are the drivers of the next bull run is what we want to understand. We want to understand the new themes, the new sectors which are going to lead the next bull run. So stay tuned. pause. This is the time to understand and learn. We have always empowered our clients with clarity, conviction, and confidence. And this is the endeavor of this event as well. One of the most important aspects that we want to understand in this event is whether the next bull run will be a capex driven bull run or a consumption driven bull run. We have seen in the last 4 years, the bull run was primarily a capex bull run because government had done massive capex spending. However, the concern is that in this year we have seen that consumption numbers have been falling. But the concern has been addressed in the recent budget, whereby the budget has addressed by way of giving tax benefit to people, and it is quite optimistic to believe that going forward we will see consumption driven rally. But what kind of sectors within consumption driven rally will participate in the next bull run, or we will see the continuation of capex as well as upcoming of consumption sectors. All this will be crystal gazed the next 2 days. Let me also mention we have 40 fund managers who will be discussing realistic questions, realistic concerns of our clients over next 2 days across 14 sessions. Knowledge is paramount and we have always given importance to it, and I'm equally keen to learn. Stay tuned. I again mention that next 2 days are power packed and we have a lot for you. The entire endeavor, as always, is absolutely sincere. This is going to be one of the most insightful and one of the most intuitive summits you have ever attended. Good luck to you. Thank you.
Good afternoon, everyone. I'm Aishwarya Singh, and it's an absolute privilege to welcome you to Crystal Gazing 6.0 Decoding the Next Bull Run, PMS AIF World's sixth annual event. What began 6 years ago as a thought leadership initiative has now evolved into India's most influential summit for the alternates industry, a space where vision meets expertise and data meets conviction. Today, we uncover the roadmap for navigating the next phase of India's wealth creation journey. Crystal Gazing is not just another investment conference, it has become an annual tradition, a trusted forum where investors, fund managers, and industry leaders come together to gain clarity in an uncertain world. It is where we decode market complexities, identify emerging opportunities, and challenge conventional thinking to stay ahead of the curve. At PMS AIF World, we believe that true wealth is built on three pillars: quality, risk, and consistency. This philosophy underpins everything we do, guiding our approach in managing rupees 1700 plus crore AUM across 600 plus UHNI and NRI families, spanning 25 cities in India and 5 countries worldwide. Our commitment is simple: empowering investors with transparency, expertise, and deeply researched insights. We pride ourselves on being your advisors in navigating the world of alternates with transparency, expertise, and insightful analytics. We at PMS AIF World help you make informed investment decisions. This year, Crystal Gazing 6.0 wouldn't be possible without the unwavering support of our esteemed partners. It's an honor to have 16 industry leading firms joining forces on India's most trusted alternates platform. Our partners are Title Partner, ICICI Prudential AMC. Platinum partners are 361 Asset and Ampersand Capital. Our gold partners are Alternates by Axis AMC, Carnelian Asset Management and Advisors Private Limited, Tata Asset Management, White Space Alpha, and Wright Research. And our silver partners are Blink Investment Management Private Limited, Generational Capital, Invasset LLP, Neejan Capital, Prudent Equity Private Limited, Code Invest, Sundaram Alternates, and Volvin Limited. This incredible lineup reflects the growing strength of India's alternates ecosystem and the collective mission to create sustainable wealth in a rapidly evolving market landscape. This event is spread across 2 days, today and tomorrow, and for the next 2 days, we have curated a power-packed agenda featuring insights from 40 plus leading PMS and AI fund managers. They will share their strategies, perspectives, and actionable frameworks on navigating India's next bull run. So expect deep dives into identifying the next multi-bagger opportunities, mastering risk-adjusted returns in dynamic markets, decoding macroeconomic trends shaping investment strategies, and exploring new age investment themes in the alternative space. For our virtual attendees, we've also designed an immersive experience with an exhibition hall, breakout rooms, networking lounges, and interactive Q&A sessions. And I encourage you to explore these features and make the most of this summit. Now, we are on board a very extraordinary journey. I'm going to bring to you our first session, which is going to be an unmissable one. But just give me 2 to 3 minutes to align our first speaker for the day for the first session. Stay with me. Don't go away anywhere. So let's begin with the first session of the day. The topic for this session is Equity Outlook 2025 Resetting Expectations. As we stand on the cusp of a dynamic and evolving market environment, it is essential to recalibrate our expectations, challenge assumptions, and understand where opportunities and risks lie in the coming year. This session is designed to provide a balanced perspective on what's ahead in equities and help us navigate the road ahead with clarity. To lead this important conversation, we are so privileged to have in our midst Mr. Chokalingam Narayanan, Senior Fund Manager, PMS Equity at ICICI Prudential AMC. Mr. Narayanan brings with him over 17 years of extensive experience in fund management, investment research, and market analysis. He has been instrumental in deriving actionable insights from business fundamentals and providing detailed analysis of the macroeconomy, financial markets, and ESG trends. His diverse career journey includes roles at leading organizations like Baroda BNB Paribas Asset Management India Private Limited, Deutsche Equities India Private Limited, and Batliwala and Karani Securities. Academically, Mr. Narayanan holds a postgraduate diploma in management from TAPI Management Institute, Manipal, a Bachelor of Commerce from G.R. Damodaran College of Science, and the prestigious FRM certification from the Global Association of Risk Professionals, USA. With his deep expertise and proven track record, Mr. Narayanan is here to help us decode what lies ahead for equity investors in 2025. Mr. Narayanan, welcome, and the floor is all yours. Over to you.
Thank you, Aishwarya, and thanks a lot to PMS AIF World for giving us the opportunity to present at this important event. I'll try and cover our equity outlook for 2025. Resetting one's expectations is the topic. Uh, there are two constants which the way we kind of see with regards to the equity markets, particularly whether it's the Indian equity markets or the global equity markets. What you can clearly see is it's a high risk asset class, but then in the long run, because you're effectively a equity owner, part equity owner in a company through the journey. But it's not a easy ride, given that the cash flows for an equity business tends to be volatile. So as a result, you will always see that this journey is always volatile. You cannot wish it away. So when you kind of look at this long-term journey, even for Nifty or Sensex in the long run, even in India, you would see that from time to time we do have pretty large drawdowns. In history, you've kind of seen that on an average, every year there is one. On an average, there's about one instance of 20% sort of correction. Once a year, you could say, and 30 instances over the last 34 years. You've had this, and over 10% corrections when you kind of look at it, you've had it at least three times a year on an average. Okay, so this is how volatile the market tends to be. It doesn't mean that every year it has to fall three times or every year it has to fall once 20%. But there are periods that you have it successively, and there are periods where you don't have it. Like for instance, over the last 4 years, when you kind of look at between post the COVID period for about 4 years, you hardly have one instance of more than 10% correction. Now is where we are seeing the second instance of that correction starting to has been there. So I think while this correction has started, it's a it kind of masks what's lying underneath. So that's where the opportunity also lies. Typically, these drawdowns are where the big opportunity is actually from the next set of when you kind of look at the longer term cycle. That's where it kind of sets a base for the next leg. And in that sense, it's actually pretty important. So while at a index level, when you kind of look at even till end of January, when you kind of look at Nifty 500 having fallen about 11.9% from their 52-week highs, what you'll see is that when you look at it on a stock-wise basis, the underlying correction has been a lot more severe. So when you look at this, let's say even when you take the entire 500 companies, you've had the number of companies which have fallen by more than 20%. was about 213 as far as small caps were concerned. Now, this is 250 small caps are there. Out of that, 213 have seen this kind of a correction. In mid caps, we have 150 companies, and within that, 105 odd companies have actually seen a correction of more than 20%. And large caps has been about 57 companies out of 100. When you look at 10 to 20% correction also, you pretty much see that another 32 companies in small cap, 31 mid cap, and 28 in large cap have fallen. So when you kind of take between a 10% plus sort of a correction at a stock level, pretty much the entire universe in this thing is actually got covered, and that's where the underlying pain has been a lot more than at the index level. So which for bottom up stock pickers actually is a great setup to kind of work towards more longer term wealth creation. But it will not be a one way journey. It will have its own ups and downs. Our core belief historically, when you kind of look at this kind of data, so when you kind of take a step back, look at what's really happened, you will very clearly see that when you and equities, and typically we keep saying that it's a long term asset class. So when you kind of take a 5 year bucket, rolling bucket, and look at what have stocks done over a long period of time in that entire journey, and when you take this data all the way back to 2009, so 5 years back from 2009, and look at every subsequent year for the next 5 year rolling periods, what you'll clearly see that is that irrespective of what's happened underlying at the market level for that particular year, when you take a 5 year bucket, you will see that anywhere between 77 to 335 companies have given you a return more than 15% as per the when you look at the top row, you'll kind of see that, which effectively means anywhere between 15 to 70% of the companies kind of give you that kind of a return in any given year, which means it's our job to find out how to identify those companies, which is where a lot of research actually comes in, and a lot of hard work to identify those companies come in. And because it's not quite easy to follow 500 companies at a easy pace, which is why you need a large team, which is where our particular strength kind of comes. ICICI Prudential AMC is among the largest ones as far as equity plus hybrids segment is concerned within the country. And we, as a result of that, we also have the largest research team, which is our biggest backbone. What we are able to do as a result of this is stay a lot more bottoms up and then identify ideas. So the alternatives team within the entity functions pretty separate. And using the research that we get, we then use our own BMV philosophy to screen stocks and figure out how to do this. And we try to keep things pretty simple. This is a simple mathematical formula. For price is basically EPS into PE. So for price to do well, you need earnings growth to be there, and you need PE re-rating to happen. So if you have one of these, then it does well. If you have both of these, it actually does much better. But when you kind of look at this again, the data 2 slides back, if you kind of bucket companies into different segments and look at what are the common threads, what you'll kind of see is that as long as earnings growth is there, and if high ROEs have been maintained over the long run, then you are able to identify a good company. These two things help you provide a good identifying a good company. Now, the reason why ROE is important is because it's basically return on equity. And who are we? We are typically equity investors when we are investing into the equity markets. So it's important to understand what is the return on equity that the businesses are generating out of the capital that we've provided. So that really, if the ROE direction is stabilizing at a high level, or if it's increasing in the long run, then you tend to get a PE re-rating. So basically, the proxy for the stock to do well, you need to look at earnings growth and you need to look at ROE improvement. If these two things happen, then you've identified a good company. But for it to become a good stock, you also need to identify them to be available at the right valuations. That's when the risk reward becomes favorable. If you don't do that, even though you might have identified a great company, the PE re-rating might not be as high, and if the earnings growth starts decelerating, then actually you will have a deceleration in terms of the returns. Which is why when you kind of look at the bottom two buckets, there is no earnings growth and there is ROE moving in the wrong direction. Then there is actually huge wealth destruction. And when you look at the second bucket, you actually have companies growing at a decent clip in terms of earnings, but when the ROEs are trending in the wrong direction, then re-rating potential actually becomes far lesser. And actually, when you look at the valuations on price to book multiples, then it becomes actually there's a huge derating. On price to earnings, it doesn't show up as much, but in price to book basis, it actually derates quite a lot. So, which is the aspect that we always harp upon, that take a long term view. Second, don't just go by any one particular parameter. It's important to look at earnings growth. It's important to look at ROE improvement, and it is equally important to pay the right value for that particular stock opportunity. So that's the most important thing, that you need to triangulate all these three aspects, and in a disciplined manner keep doing it again and again and again. So that's the most important thing. That's where we focus our entire efforts on. On the outlook and opportunities, when you kind of look at what's really there, we've just kind of gone past the most important event as far as the country's economy is concerned, which is the budget. So I'll kind of start off with that. The budget has been quite realistic about what they're set out to achieve. I think the revenue receipts and direct taxes and total receipts, when you kind of look at that, it's looking at about 11% sort of growth penciling in. And within this, when you kind of take the personal taxation changes that they've kind of implemented, while that does reduce some amount of the receipts, I think the growth, the nominal growth of the country itself is anywhere between 10 to 12%. So in that light, this number seems reasonably realistic as far as the receipts is concerned. On the expenditure side, where people have been possibly a little bit disappointed, is at the headline level. When you look at the capex, there's only been a 10% increase, and then 10% increase has also come on the back of a 8-9% decline for 2025 in terms of versus the budget estimates. The revised estimates is for a decline, and actual numbers, it's kind of remained flattish over 2024. So that's where there has been a little bit of initial disappointment when you kind of look at that. But when you actually, and more importantly, when you look at the fiscal path, I think they've kind of done the right thing. They were very counter-cyclical during COVID, and they had invested quite a lot. So they are now coming back on the fiscal path in terms of reducing the fiscal deficit, and they're going about it quite gradually. So versus the 4.9% fiscal deficit that they kind of looked at for 2025, and the revised estimates are suggesting it will be at about 4.8, and for 2026 they're looking at 4.4%, which is quite good. Now, there is obviously fillip to spending. I think the government took the onus of expenditure over the last 3 years and did a lot of capex, and also supported a lot of growth at the bottom end of the economy in terms of the consumption, by supporting the bottom strata of the society. So I think they've largely done that bit. While they continue to support the bottom strata, what they've also gone on to do is announced this personal taxation changes, which kind of supports the middle class in the country to kind of open their purses a little bit more by giving them the tax incentive. I think that's a that remains a quite a good initiative. Let's see if the consumers respond with that kind of a change. The tax buoyancy, and better fiscal kind of continue to be there. Adjusted capex, so which was the other point that I kind of mentioned, that when you kind of look at the initial capex, while it remains, while it appears to be low, when you kind of adjust it for different capexes from the public sector enterprises, the IEBR, which is external borrowings which are required, which are taken by some of these institutions to support capital expenditure. The outlined amount for that is actually quite healthy. That number is what I think overall one needs to look at as far as government direction for capex is concerned, and that still seems reasonably significant even for FY 26 in higher than mid teens. So that's a pretty positive outcome as far as even the capex side of it is concerned. So I think there also the other factor that the government has kind of done is whatever new industries that are emerging, I think they're giving enough incentives to support that adoption of technology in the initial stages. That handholding is kind of worked out well through the PLI initiative, which is one of their flagship initiatives. I think they've done a fantastic job on that. The outlay has increased from 3,700 crores and is likely to hit 15,000 crores in FY25, and in FY26 is further going up to about close to 27,000 crores. Not only that, the government is now encouraging the industry to invest a lot more in R&D as well, because what we've clearly seen is some of the other economies which have kind of grown quite fast, their ability to sustain that growth has been on the back of investments into R&D. I think the government recognizes that, and that's where in this budget they've kind of announced a 20,000 crore allocation towards R&D. Even if this particular year they don't end up spending all of it, I think it will kind of at least kickstart that, and by the next year, the government machinery, will be able to support that kind of investment, in the long run, and it's a very, very healthy sign from an economy perspective. I think that's definitely something which is on the positive side. As far as the global economy is concerned, obviously there is uncertainty surrounding whatever developments that we're seeing on the tariff side post Mr. Trump coming into power in the US. While there are tariff differentials which are being looked into, I think the trade deficit wise, India is probably the 11th on the list as far as the higher trade deficits which are there. But as far as reciprocal tariffs, which is possibly the topic of conversation last evening and today, I think India does have one of the higher gaps there, but every country has a certain natural advantage with regards to certain aspects. Say, for example, US might be a lot more advanced in terms of and competitive in terms of defense, given their technology. You can say that India is a lot more competitive in a lot of other areas, whether it is agri, whether it is textiles, whether it is pharmaceuticals, whether it's engineering goods, whether it's software or things of this nature. So I think there is obviously the cost differential in terms of labor, which accounts for a larger portion of this. Competitiveness for India to be competitive. I think so. I think at the end of the day, normal economics will kind of prevail. There'll obviously be a little bit of brinksmanship and negotiations which will be involved. But I think this period will be volatile. One can't wish it away. But I think we are headed in the right direction. Unlike other countries which run large trade surpluses, we are actually a country with that being actually on the balance. And there are a lot of items which historically India didn't get as much preference treatment like some of the other trading partners with the US got. Given that some of those items are also being brought on equal footing, I think it also provides a level playing field for India also to better participate in some of those areas. So on balance, I think this will, hopefully work in favor of India, given the way it is evolving. What also one needs to understand is US is currently at near full employment. So if they were to bring a lot of jobs back into US, there are not enough people to deploy and work on that. So which is where I think there is that opportunity with India having such a large labor pool available. and given that we are a large functioning democracy with a functioning judiciary and legislation, I think it positions India in a favorable manner in the long run. That makes us quite positive about the country. Among the large countries, we kind of continue to believe that India will remain one of the more shining lights as far as the global economic growth is concerned. Now coming to the stock markets itself, when you kind of take a step back and look at what's happened last year, we had actually a tale of two halves, where you had the pre-election period, which was a lot more risk on with the hope that the existing dispensation kind of continues with absolute majority. I think that's kind of come in with a bit of coalition, which is where there's been a little bit nervousness around some of the policies, and some of the sectors which did well prior to the elections kind of gave up that outperformance. But when you kind of look at in the second half, but when you kind of look at on balance for the full year, most sectors actually did pretty reasonably well. The only few sectors which didn't do as great despite delivering numbers could say were financials, because their balance sheets are today possibly in the best of the shape, and numbers have kind of come through. But despite that, they haven't done that great. In other areas which haven't done well, say for instance FMCG, we haven't seen as much volume growth, so that's possibly one of the reasons why while it kind of did the way it did. Last 4 years, when you kind of look at since COVID, it's been clearly a earnings driven rally to a large extent. So in that sense, the beta of the market was also equally responsible for driving the stock returns. We even within that, I think the until then an ignored segment of the market was the B2B segment. And as the earnings in that segment kind of improve, so you can clearly see on the right hand side chart that the earnings growth for the non B2C was actually much superior than the B2C segment, and that's where that particular segment of the market actually did pretty well. Index EPS also, when you kind of look at 8-year period, while the first 4 years didn't do much, I think the earnings growth over the last 4 years has kind of caught up pretty well, and that's where the catch up in the markets have also kind of happened. The micro trend, obviously, if one were able to identify these micro trends, then one was able to create a reasonable amount of alpha. And I think that's what played for people who identified the non B2C segment improvement in profitability. When you kind of look at the period between pre 2020, the earnings growth for the B2B segment was relatively more muted, whereas post 2020, this was significantly better. So if you kind of caught that change in trend, then one was able to make decent alpha, notwithstanding just the headline movement in the markets in terms of the beta play. One was able to also participate through the alpha creation. But that said, the stage is now a little more mixed in terms of there is a bit of slower growth which was there in the first half of this fiscal. I think now we are slowly starting to see the government loosen its purse strings, and next year's budget, as we kind of highlighted, it looks on balance reasonably okay. Corporate profit to GDP seems to be reasonably better, while inflation is slightly at the higher end. I think, and interest rates are settling at a level which is higher than the what we were used to between the 2010 to 2020 period. I think they're settling at a reasonably okay level. And the setup is okay as far as the economic activity is concerned. So we are quite sanguine about that particular aspect in the economy. That earnings growth is still pretty decent, but you will have these phases in the market where things tend to be a little bit more volatile, largely to do with the macro aspects that are there, and the liquidity flow which is following the same. So when you kind of look at the longer term trend, the cyclical and capital intensive businesses tend to get slightly better tailwinds when the inflation and interest rates are at a higher level. So which is where we believe that kind of still remains okay, but it will be a lot more bottom up. It is not a one-way street that you saw for this particular segment over the last 4 years. So the B2C side, you would see that they haven't participated as well in the market rally. But now, because there's been a reasonable amount of time correction, you could start seeing bottom up some opportunities starting to emerge in some of those spaces. That's something that we are looking at. And last but not the least, obviously, financials, while they've continued to do well, they've not participated in the rally as much, and which we believe actually sets them up quite nicely for the period ahead, and which makes us quite positive about that space in particular. Um, uh, this is largely, I think, we've kind of covered. The other aspect that I wanted to highlight was, while the government finances are also moving in the right direction, the corporate balance sheets are also in pretty fine shape, and individual balance sheets are also reasonably okay. While there is, you could say, a possibility that there's a K-shaped kind of recovery. I think with the hopefully with the support that the government has provided through the tax changes, I think we'll start to see some amount of improvement in the financials of the lower start of the population in terms of individuals. I think the upper start of the population in terms of the individuals is doing at an individual level is also doing reasonably well, which is where you're seeing a pickup in real estate activity in the country, and that real estate cycle seems to be in fine fettle, which is again a good sign from because real estate has one of the higher multiplier impacts on the economy. So that's again something which is quite nice for the economy. Overall, the outlook is one has to when you kind of look at the country is giving you a nice little 10 to 12% earnings growth, which is still one of the best across the world. The market is likely to be in 2025, our sense, more earnings growth led. PE rating could be a little more difficult, especially PE rating tends to be a little more easy when the liquidity is light and the market in general is in a more bullish phase. When there is a consolidation phase, it tends to the opportunity for re-rating tends to be a little lower. It's more driven by earnings growth. In summary, we are more looking at things at a bottom-up basis, which is where our core philosophy is also lying. And the if one were to take a 3 to 5 year view of the markets, I think things look reasonably decent. The beneficiaries in the markets, it's going to be pretty bottom up, but some common threads that we kind of see is financials is something that's looking quite quite a good pocket of opportunity. On the capex side, there are some there's now a difference between the guys who are executing well and those that are not. So bottom up, there are reasonable opportunities. Energy is a pretty interesting energy transition is a pretty interesting development across the world, and I think that's something that we are looking at bottom up. A few pockets of opportunity available still there. Consumption. Discretionary is where we see a lot more opportunity, as because as income levels increase, you will kind of see that opportunities on the discretionary side are a little bit better than the staples. So that's broadly where I'd kind of leave it. Final thoughts. Define who you are. Whether one is playing T20 cricket or Test cricket. I think equity markets are more like Test cricket. You have to when the conditions are overcast, you have to play the ball by its merit, and if the ball is outside the off stump, you need to leave it, and only when it comes to your playing direction that you need to play. So that discipline needs to be there when you kind of ride through that period, and when the conditions kind of improve, that's when you can start playing your shots and work your way. So I think that the outset, I think that's something which is pretty important. You need to figure out what the circumstances are and then play accordingly. I'll kind of stop here. Yeah, be patient, because in investing, patience is a very very important virtue. I think if you're in a phase that you want to get rich quickly, then investment is not the equity investment is a more long-term journey. It's not a short-term journey. Yeah. And this is our final thought, I would say. Focus on what you can control. What you can't control is returns. That's an outcome. Control on what is under our this thing. Risk, cost, time, and emotions. Yeah, that's largely it. I'll kind of stop here.
Thank you. Thank you, Mr. Narayanan, for your incredible insights into equity markets and helping us reset expectations for 2025. Thank you for setting the context, and your perspective set the perfect foundation for what's to come in this event. Now, for everyone watching, we will take a brief 2 to 3 minute break to align our speakers for our next session. Please use this time to explore the exhibition areas, networking lounge, or connect with fellow attendees. But I will see you in 2 to 3 minutes only with a power-packed panel. So come back in about that much time. Thank you. Welcome back, everyone. Up next, we have a session that dives straight into what every investor aspires to achieve: unlocking exponential returns. This session is titled Formula for Generating 10x Returns Over the Next 10 Years. And this session aims to explore actionable strategies, innovative frameworks, and the key themes that will drive wealth creation in the decade ahead. As we navigate the dynamic landscape of investments, the next 10 years bring immense potential, provided we position ourselves wisely. This discussion will focus on how to spot opportunities early, leverage compounding, and embrace the evolving role of technology, innovation, and niche themes to achieve extraordinary outcomes. To guide us through this exciting conversation, we have an expert panel of industry veterans. We have with us Mr. Satvik Jain, founder and executive chairman, Generational Capital. Mr. Jain is the founder of Generational Capital and leads the investment committee at Generational Capital Bharat Breakout AIF. With a rich background in equities, alternative assets, and M&A, Mr. Jain achieved the milestone of financial freedom at the age of 26. He also brings a unique perspective as a professional golfer and a venture partner. We have with us Mr. Neil Behel, founder and fund manager, Negen Capital. Mr. Behel established Negen Capital in 2007 and transitioned into portfolio management services in 2017. Known for his focused strategies on special situations and technology investments, Negen Capital's PMS has earned a 5-star rating in the multi-cap category by CRISIL and PMS Bazaar. And our final panelist, Mr. Siddharth Oberoi, founder and CIO, Prudent Equity. He comes armed with over 28 years of experience in Indian capital markets. Mr. Oberoi founded Prudent Equity in 2012 to guide investors in building sustainable wealth. Under his leadership, Prudent Equity has consistently outperformed benchmarks over each 3-year period. This session promises to be packed with insights and actionable takeaways, helping us all understand the pathway to multiplying wealth over the long term. And this session will be moderated by Ms. N. Mahalakshmi, Senior Consulting Editor, Money Control. Ms. N. Mahalakshmi, a seasoned financial journalist with over 25 years of experience, is a senior leader at Network 18, heading markets and economy coverage at Money Control. Previously, she served as editor of Outlook Business and Outlook Profit and led markets and investing coverage at Business Standard. She holds the rare distinction of being among the first Indian journalists to interview Warren Buffett, along with other global investment icons like Howard Marks and Joel Greenblatt. It is now my pleasure to hand the proceedings over to Ms. Mahalakshmi. Ma'am, all yours.
Thank you so much, Aishwarya. First of all, thank you very much for this opportunity to moderate this um, a session that promises to be super exciting because the title itself is super exciting. The fact that you're looking for 10 baggers, which is what everybody wants all the time. But the 10-year part, I don't know how many investors really have the patience to think about 10 baggers in 10 years. But what we all have obviously learned in investing, it's compounding that's a big contributor to returns. But first of all, thank you, Kamal. Thank you, PMS AIF, for giving me this opportunity. Super excited to be doing this. And thank you, panelists Neil, Siddharth, Satvik. Wonderful to join you guys, and I'm hoping to learn as well. So please bring it on. The first question really is if each one of you can quickly, in just about 3-4 minutes, articulate what is your framework for thinking about 10 baggers. So for now, let's just keep aside everything else, the markets, the context, and all of that. What is your basic, bare bones way to approach a 10 bagger portfolio? Neil, should we start with you?
Sure, sure. Hi, Malakshmi. I mean, I didn't know you had interviewed Joel Greenblatt, so that's a conversation for later. I'll
Yeah.
get in touch with you because he's one of my gurus in the market. All right, so everything comes down to getting a good bargain to begin with. And in a bear market like right now, there's value to be found at most places. But when markets typically get fairly valued and sometimes overvalued, you tend to look at special situations to get bargains. So the first starting point is, am I getting a reasonably good bargain where some part of the business I'm getting for free. Then, of course, you have to marry valuation with growth. I don't believe only in buying into a cheap asset or only into getting into a growth stock. If we can marry an attractive valuation with growth prospects, then of course I think that is the starting point of how we get to where we want to achieve. So the and since you said us in a nutshell, so this in a nutshell, we try to find a bargain first and figure out where there could be growth going forward.
Fair enough. Quickly, Satvik, would you like to go next?
Yeah, sure. So broadly, Mahalakshmi, if we are investing in any business or participating in any business, there are only two ways we can make money. One is the entry valuation we are getting in and the exit we are doing. And the second is what is the rate of the earnings growth. So I personally have this framework of 25 cube, which is basically 25% sales growth, profit growth, return on equity, and ideally at less than 25p. So if we can get these three to four, like three out of four parameters in a company, and if the company executes well, right, based on triggers like a management change is happening, a private equity is taking over, or some margin changes happening, then I think serious wealth can be created. And if you see the leaders of the past bull runs also, like same pattern they had been created, that historically they had been growing very fast, and then some trigger happened that the orbit of the growth changed or the margin expansion happened. So then serious wealth is created. Then to minimize the risk, then we have developed an in-house forensic accounting framework based on 16 ratios where we try to marry the balance sheet, P&L, and cash flow of a company to see whether the companies are doing frauds or trying to show us what we want to see, which is basically growth in sales and profits. Along with that, there is a 150 keyword fraud search, which we check the integrity of the promoters. And finally, look at the moat of the company and the right to win of the company. And then mostly the focus is on the consumer, healthcare, and technology sectors, because we have seen over the last 120 years of Dow Jones data that these three sectors are kind of anti-fragile in case of recession also. So we want to have the best of both worlds, which is a very low volatile business also, as well as superlative earning growth also, getting in at cheap valuations.
Fair enough. Quick. Siddharth, would you want to go? Siddharth?
Hi. So, when we are saying 10x in 10 years, we effectively are saying that the capital should double every 3 years, or the capital should compound at 26% per annum. So for us, that's a pretty long period. So we break it into several short-term periods into 3 years. So for us, long-term is a series of several short terms. Here if we invert this 26%, we would like to see buy companies which are growing at about 20-25%. That is one way to achieve it, but that is just one part of the puzzle. The second is that we need to buy it at statistically cheap prices. So, the cliche now is that buy growth is a reasonable price, but for us, we need that growth at a very cheap price. So, for example, when you put your capital into FDs, that doubles your capital every 9 years. So when you're taking the risk of equities, would you want to, double your capital at much higher speeds? So with that, we go about valuing companies. We understand the business and we try to figure out a business value of the company. In the investment parlance, is called the intrinsic value.
Yeah.
So our catch is to buy these at a 40 to 50% discount to those conservatively estimated values. So we do that, and in between we have several special situations as well, where we try to create alpha, turnaround companies where there's a change of management, etc. So a combination of this, we are able to achieve this kind of a return.
Okay, fair enough. So largely, I see that all three of you have similar sort of framework, in the sense that all of you are looking for growth, not necessarily hyper growth, but I think even 25% in a very significant growth, especially when you look at long time periods. The other thing all three of you are saying is that you want reasonable value, but this is largely the combination that everyone talks about. All investors want reasonably strong growth at attractive valuation. So that's not rocket science. So I want to understand what is that unique part of your approach, and how do you, approach stocks in a way that you are able to get this combination? And if you can illustrate that with maybe a few examples. Neil, would you want to go first?
Uh, yeah. So as I said, uh, there has to be a framework that allows you to find bargains. So for us, around our special situations, it's almost entirely focused on finding bargains where there's a corporate action. Because there is a general consensus that conglomerates trade at a discount and the breakup value of companies are usually higher. So there was a study done in the US that, what if you blindly bought all special situations? Don't do any study. You bought all of them over a 25 or 30-year period. It was done by the Penn University. And the result was pretty astonishing that blind buying of special situations and a holding period of 3 years, you end up beating the S&P 500 by a factor of 2x. So if you kind of then uh, actually analyze businesses and get into the right ideas, then you can do what someone like a Joel Greenblatt did. His CAGR was 52% over, I think, 12 years or so. Uh, so the point is we have to find bargains and we have to look at special situations. I'll give an example. Of course, we cannot talk about anything that's happening right now in our book. There are a lot of SEBI regulations on that. So I'll talk about what happened probably 7 years ago, a particular transaction we did. It was a company called Green Ply.
Yeah.
Green Ply decided that, okay, we'll split our MDF business separately and we'll keep our plywood business separately. There was a family split also probably happening at the same time. So I think I can't remember exactly. Price was about 150 to 180 kind of range. And on the day when they actually went X and Green Panel got out of it, the market thought process was that MDF is too soon and MDF won't be so good, and it's a big plant and it's not the same as not as good as the plywood business. So the market got big relief when Green Panel went out, and instead of adjusting down, that particular company adjusted higher. Green Ply went from 150 or 160 on the date of going X for Green Panel. It went up as a standalone entity to more than 200 rupees. And that also coincided in a bear market. So in a bear market, doing special situations is even more rewarding, if you ask me. And then, of course, Green Panel listed at 30, probably went up a little bit, then came down during the COVID crash to 25, and then went to 600. So when you do these kind of things, I think you increase your odds of of you know delivering good returns. But also there are more factors. It's not as simple as buying something, as you said, buy something cheap and sell, and hope that it has growth, and then you will sell at around the top. There are other factors. There are, one more thing that we look at is something called the incremental CAGR. Every 2 years or 3 years, there should be a process of re-looking at the entire portfolio. At least start with a paper thought process that if you have a 20 stock portfolio, now after the 3 years, which of these 20 stocks would you buy fresh? Many times, their stocks have gone up 5x for you, and you don't want to buy more of it. You want to, just hold it. But if you don't want to buy more of it, should it be in your portfolio to begin with?
Oh, absolutely. Correct.
So that's
I
a
think Howard
concept
Marks talks about it. A lot of investors have spoken about this, that it is intellectual dishonesty to be holding a stock that you would not buy afresh.
Exactly. So after every 2 or 3 years, kind of Joel Greenblatt spoke about this when he spoke about magic formula investing. Just wipe the slate clean
Yeah.
and start again. It also, there is a very good analogy that I keep telling people around me. It's like a game of chess. When also coinciding with something called beginner's luck in investing. Whenever, what is beginner's luck? Beginner's luck is basically you are seeing a situation and you're buying according to the situation. So you're mostly going to be right. It's also like a game of chess. The opening part of a chess game, whether you do the king's opening, queen's opening, the retaliate, the moves against every opening is there. The complexity starts when you get to the middle game, and when you get to the end game, it becomes even more complex where things start changing. You cannot just play pre-decided moves anymore. So that's exactly what happens to a portfolio. In the year two, in year three, in year four, policies keep changing, founders keep changing, new businesses you keep getting into. So many things in the cycle keep changing. So if you have a habit of looking at incremental CAGR and kind of wiping the slate clean and figuring out, will I buy more of this stock after 4 years? And if the answer is no, you should. So all of these factors help you a very long way to creating alpha,
Sure.
if
Thank
you
you
ask
so
me.
much. So I will just allow me a few more minutes. Neil, I'll come to you, Siddharth and Satvik. Some questions and clarifications around what you said around conglomerates going for spin-offs. There are multiple strategies around this. You know, some people buy the business. The way you explained it, it occurred to me that you are betting on 1 plus 1 when a split happens becomes larger than whatever it was, and therefore but you can play this in multiple ways. You can bet on it. Once it splits, you can sell both businesses because both of them are more than the price at which you bought, so you pocket that gain. Some people bet that the bigger business, like in this case, the bigger business or the more profitable business sort of gains more in value because a loss making business just went out, and therefore the investors are latching on to it because it's a pure play on a profitable business. The third way to play it is also that you buy the unloved business because everybody is dumping it, it is going out of the index or something like that, so it becomes cheaper than what it is worth. So in our markets, since you've been doing this for a long time, what kind of opportunities do you see more of, and what has been more rewarding for you?
Purely speaking, demergers have been the most rewarding. And the best time, if you ask me, to get into a demerger is around the approval from NCLT. If you buy when a demerger is announced by the company, then there's a 12 months to sometimes 24-month wait for the demerger to go through, and that could be frustrating, and it could have implications on your CAGR that you end up getting. But around the time of NCLT, that's largely a done deal. It takes 3 to 4 months. So I found that if you like a company, which is that you want a demerger, the two businesses that are getting split are largely equal in size. You can go around a time of demerger, but sometimes a company will demerge, which is a small part of the overall parent, and it makes absolutely no sense then to buy it pre-demerger. Then ideally, you want to hope that as it gets deleted from the MSCI index, all these ETFs who just have to follow what the MSCI tells them, they will once it gets deleted, a lot of their selling comes. And in a bear market, if this happens, you end up getting something for far better than fair value. I mean, far cheaper than fair value. So there are multiple variations that come into special situations, and especially during demergers. And we look at all of them, and there is no right answer. Like for example, in a bear market like today, I will not probably even want to wait for a NCLT date to come. If I like
Right.
something, I'm just going to buy it right now because I know the breakup value could be much higher.
Right. Because the
You know,
market is giving you an opportunity to buy something
correct,
cheap.
correct.
Fair enough.
So you just have to take sometimes decisions based on what is happening around you also.
Right. So, Satvik, you talked about this 25 by 25 by 25 model where you're looking at 25% growth in revenue, 25% growth in earnings with a 25% ROE, I think. That's what you said, right?
Right,
So,
right.
do you get and for typically a company that's growing earnings at 25% with a ROE of 25, what is the multiple that you would consider all right to pay? Include, I mean, after
So
accounting for a margin of safety.
Right, right. So it frankly depends on a sector to sector. The multiples I would be willing to pay, but ideally on a price earning growth ratio, more than 1.2 times on a 1 year forward basis, I would be skeptical to pay. Essentially, on a trailing basis, it could ideally be a 45, 50 price to earning multiple. That would be kind of the maximum. Because again, if we pay very high valuations for the companies, then probably we would not end up making those kind of IRRs. And the scope for disappointment also would be very, very low. The company would have to do flawless executions, and even a couple of quarters of disappointment will lead to share prices tanking because the expectations would not be met. Now, obviously, we are not very, very fixated on price to earning ratios because a lot of accounting standards have changed and different companies have to be valued differently. So retailers, we would consumer retailers because they are a big part of our allocation because they are very easy to understand and we can see the growth prospects ahead. We value it on an enterprise value to EBITDA basis after the Ind AS accounting changes have happened in 2018. When the assets taken on lease are marked as right of use assets and they're depreciated, so the PE will look optically higher. Same way for a IT services company, a P ratio would be fine. For a platform company which is profit making, doing 70%, 80% return on capital employed, a P ratio would be fine. And mostly what I have figured out where we would make money, lose money is when we figure out the longevity of the growth. Because markets are very short-sighted, they look at 3 months, 6 months, or maximum 1 year. But even if we can figure out based on our research, our understanding of the sector and the business, okay, 3, 4, 5 years ahead, the company can sustainably grow into the valuation the prices are factoring in. I think that is what will differentiate us probably from the overall market or the index.
Okay. So, so you're saying that essentially you do not always look at PE depending on the nature of the business and the cycle of business where they are in. So, for example, a Zomato or any of the new age businesses will not qualify there. But in a steady state business, which is sort of, the growth rates are fixed, but there is always, in all companies there is this golden period of growth. And definitely 25% over 10 years is a very long golden period of growth. So, so how do you navigate this?
So,
Do you look at, should you have visibility that this company would grow 25% earnings over 10 years, and then you take a call on what should be the value, what is the value that will create through earnings growth, which is 25%, which itself can give you if the PE remains constant. But you also talked about a PE re-rating, which means you're willing to accept a lower rate of growth. So some part of it comes from re-rating, or you will achieve a much bigger growth, much bigger, return, which will make up for perhaps some of the bad calls you may make in the portfolio.
so I like spend a couple of minutes on the process we take to identify stocks. So then I will get to what you like the specific question. So first we will see that okay, over the last 5 years or 10 years, the company would have consistently grown at least 20% or 25% year on year in terms of sales profit, maintaining a consistent return on equity. And then we
Okay,
would
so what you are talking about is past. The history should give you the confidence. Okay,
yeah,
but then past is not an indicator of the future.
absolutely. So then the research starts that okay, now what is changing here, right? Or what the market is not factoring in that this 20-25% can grow to 30-35%, or probably the business is available at 15-20 times price to earning multiple. That markets are not factoring in the longevity of the growth. So I'll give you a couple of examples. So just a disclaimer before that that these are currently also in our portfolio and these have been long-term holdings in our family portfolio, also our portfolio management service, as well as the recently launched alternate investment fund.
Sure.
So, Trent, which is the leading retailer, now it has been included in the Nifty. So, we had been holding the company pre-COVID. And the patterns were very similar that West Side was growing very fast. Some of the parts valuation was very attractive. It was available at around 25 times EV to EBITDA. P would not make sense again, like because P would be showing around 110, 120 times, but it had to be valued at EV to EBITDA. And then Zudio had just started scaling up. At that time, they were doing around 250, 300 crore of annual sales. The company was available at around 15,000 crore market cap. Cut to today, at its peak, trend was around 2.5 lakh crore market cap. Today, I think it will be around 1.9 lakh crore market cap, being one of the largest winners for us. The sales of Zudio has grown from around 250, 300 crore to 8,000 crore. More
Yes.
than 800 stores have opened up, and the pattern was very visible. Like what they had done with Westside, the same they were doing with Zudio, right? Similarly, another retailer, again, it is a very small cap company, so I would not take its name. Basically, a Bihar-based electronic retailer we had entered in 2020, and the idea there was, last 5 to 10 years they had done exceptional work, growing at 25% plus year on year, not a single store closure, and had reached around 200 crore of absolute sales. Now they were, and they had only raised around 8 to 10 crores from their IPO, and they were doing it profitably, 6 month break even. And what I could figure out there, what was their right to win was, Chroma, basically Tata and Reliance would not go to Bihar as such, because the capex involved was very, very high for kind of a 2 crore investment per store. Right. So this company scaled up from around 25 stores to 150 stores in a matter of 4 years. The sales have gone from 200 crore to 2000 crore. They are doing more than 100 crore of profit. The stock price has gone up 30 times in that time frame. And we entered at around 8 times EV to EBITDA. Today it's at around 35 times EV to EBITDA, probably priced to perfection right now. So markets kind of do not, I would say, underestimate the longevity of the growth, or a lot of time institutional money does not look at, say, sub billion dollar ideas.
Right.
Most of the
Have
mutual,
you sold this Bihar company yet?
no, we currently also are holding it.
Okay. So what are you holding it for?
Right now also they are growing around 25-30%. So versus the other retailers which are there, right? They are still kind of doing above average results. So after capturing the whole of Bihar, they have become the number one retailer in Jharkhand also, and now they are going to UP till Prayagraj. So broadly, the work they are doing is good. So it can be a compounder story now. It won't be like that 10x idea in 3 years.
Okay, so in which case, I'm just going to post the point that Neil made in terms of, uh, wipe your portfolio clean every now and then to see whether you will buy that stock now for the reasons that you normally buy stocks, and whether they meet the criteria to ensure that they continue to have that position in your portfolio. So if you don't believe that that the the past growth cannot be replicated, why would you want to hold it? Will it not impair or diminish your returns in future, overall portfolio returns?
So broadly, we the internal IRR expectations are on any stock is 25%, which is broadly without any valuation re-rating. The company should double its sales and profits in the next 3 years. So the retailer we talked about, broadly, the expectations are that they should be able to do that based on what they have been guiding, what their execution has been. So that is why we have been holding as of today.
Okay, so you're saying when you bought the stock, the expectation you had on the stock is similar to what it is now.
Yeah, yeah. But the markets re-rated it, and the company also delivered much better than what we had expected when we had bought the stock.
Okay, fair enough. Um, Siddharth, you talked about, essentially inverting this 26% CAGR, which is what 10 bagger in 10 years really converts to ensure that you buy stocks which grow at 25%, which is pretty much the same formula that, Satvik is talking about. He's also talking about earnings growth of 25%, right? How is your approach different from what Satvik explained?
So see, we want to hunt in shallow waters. We're afraid of heights. And as I'll quote Charlie Munger, as he said, that if you want to shoot fish, you shoot them in a barrel which has no water. So So how easy it is to shoot that. So with that, I just give an example which actually proves our strategy. So there was this company called Time Technoplast, which we have sold by now, but we bought it about some 80 rupees, which was actually 7 times multiple. So a company organically growing at 15% CAGR, having a 60% market share in its products, and one of the new products it had launched was composite cylinders. It had double the capacity, was fully sold out. It was tripling the capacity, and that too was sold out. Now, now you had everything in the bag. You had earnings growth, you had valuations, and the management in subsequent con calls came over and interviews came over and said that now they're focusing on capital allocation, etc., paying back shareholders. So those sound bites were really good. And then what happened was that the company decided to sell its overseas business for sum of 1,000 or 2,000 crores, whatever. So they had hired a banker for that, and it was in the news. So you had a company which was essentially a 1,500 crore market cap company selling its 35% business for 2,000 CR. Uh, and then you had earnings growth and you had valuation comfort. So everything was in place. Where we took the bet. So um, effectively, we sold it at about 400 rupees after 18-month period. But the point to say was that it went from 7 times to almost 20 times. The earnings trajectory played out. They didn't sell their business, but nevertheless, the ROC went from, I think, 10, 11% to 20%.
Right.
And everything play out. So this is the kind of stocks we like, where everything is in our favor. It's a mispriced bargain, and we have got it at a good price.
Right. So I think this should be our last round in terms of just contextualizing what you're saying to current markets, which is where the challenge is. Of course, we are talking at a time when the market is off. At least a lot of small mid caps are down about 20% on average, at least the index level. Have we come to a point where you are able to find 25% earnings growth with good return on equity, at least upwards of 25%, like Satvik articulated? Are those businesses today valued at an attractive enough price for you to make 25% returns over the next 3 years? Let's just cut it down to just have some near term or medium term visibility.
Yes, we have few of them, but we're still sitting on 35% cash, which means we are still not finding those lucrative businesses at our desired prices. And just to put this in perspective, uh, in India, the bull market has consecutively lasted for more than 5 years. So there was this 91, 95 period. Then there was a 98, 2000 period, which was the TMT bull market. Then we had the 2003, 8 period, which was more broad based. Then we had the 13, 18 period. This one started in April 2020, and we are ending the 5 year period there. So we may be lucky this time that uh, India breaks its 5 years string and goes ahead further. But I think that the earnings that have come in and the kind of valuations we are in, I expect that the market is headed downward before it goes up. And so in that, we may get opportunities to invest in the businesses we like.
Okay. And what kind of correction would you expect, let's say, for an NSE mid cap 250?
So we don't know. Nobody knows, and nobody can predict this. But
No, roughly. I mean, roughly, because we all have some sense of history and say, okay, the longer term trajectory is this. We are maybe 10% overvalued compared to history. Do you even look at historic valuations as an anchor or
no, we don't. We
completely?
don't. But broadly, if individual stocks were to fall 15% from here, I think we would be able to deploy everything. So we are around at that place where if individual stocks were to fall 50, 20%, I think I
You
think
are a
our capital
buyer.
would be fully
You are
allocated.
a buyer, and
Yes,
the
absolutely,
35% cash you have, you'll confidently deploy all of it and put
absolutely,
it to work.
absolutely, because this will be bargain prices there.
Okay. Satvik, what do you think of prices today? Does it allow you to buy stocks to compound at 25% growth over the next 3 years?
Well, absolutely. In fact, contrary to Siddharth, I am more on idea than short on cash. So there are so many attractive opportunities right now available at 10, 15, 20 times price to earning multiple, with companies putting up large capex, and the expectation is they should do at least 2 to 3 times sales and profits in the next 3 years. So that is the space I'm looking at, without taking names, say the fastest growing co-working player, the fastest growing spice maker in the country, luxury watch retailer. So these kind of companies are there, where very good opportunities are there. The fastest growing domestic cancer drug manufacturer, and all debt-free companies.
So one follow-up question to that. Usually, when tides turn, a lot of companies which have expansion plans, capex plans, all of them, along with the downturn in the economy, gets shelved. And usually, slowdowns do not last for just 1 or 2 quarters. It tends to be a 4 to 6 quarter kind of a thing. Do you think this time is different? That you can believe what companies are saying in terms of their expansion, expectations on growth, capex, etc., will indeed come through for that 25% growth over the next 3 years to come through?
Especially focusing on the consumer sector broadly, I've seen the companies catering to the top 1% or the bottom 5 to 10%. They are kind of not very much impacted, because those two segments are consuming what they have to consume. So essentially, the focus is on identifying those kind of companies where the demand is of anti-fragile. Right. So for example, 11 Jacob and Co watches were uh,
Sorry, I'm
launched and sold on
losing
one
your. Okay.
price around 88 lakhs.
Sorry, your audio is not very clear to me. Can you hear me?
Okay. Yeah, I can hear you.
Okay, I lost you for a bit. Sorry, can you just repeat what you said? Just the last part.
Yeah, so the focus is on the companies focusing on the in both these segments. The demand is kind of very sustainable in the future, as per our analysis. So, for example, 11 Jacob watches, each luxury retailer. So the demand is not slowing down at the top 1%, neither bottom 10%. Where leading footwear manufacturer, they are growing at 25% plus, when the whole footwear industry is declining, because their average selling price is around 700 rupees.
Sure. Okay. Okay, so you do see opportunities for companies which are catering to these two segments, absolutely premium end and absolutely at the bottom. So that's
Right.
that's your focus area. Neil, for special situations, usually I think you also started off saying that bear markets are great for special situation. By the way, I'm not saying this is a bear market. At least some pockets of the market have gone down more than 20%. So that's definitionally called bear markets. But are these markets conducive enough for your kind of investing? And do you see a lot of opportunities to make 25% returns over the next 3 years?
So, I kind of agree with Siddharth. Uh, Late last year, we went big into cash. Around October, in our PMS, we went 27% cash and then defensives and arbitrage positions. So, in effect, it was more than 30%. In our AIF, we were almost 45% in cash. Right now, also, we're at 36%. We have started deploying, but I kind of agree with him that high quality businesses at the price that you want are still not high quality businesses have not become cheap yet.
Yeah.
You've got your average companies which have become cheap and attractive. So yes, a lot of stocks which are considered to be okay are available. But if I'll take a name. I'll take a name because I have no position in it, right? I may buy it later, but let's say if, in my opinion, Tips Music is one of the most fantastic businesses I've seen in a long while. I used to own it earlier. Now we don't own it, but I still find it ridiculously expensive, and it needs to fall. If
Yeah.
someone like me would want to kind of just blanket shoot at sight approach has to be given. So I still don't think the exceptional businesses have come to a level. So we continue to hold cash, but yeah, there are pockets. I mean, I
But
agree
I
with
mean
both
that.
the panelists.
But is that wishful thinking? Because those kind of businesses may not fall because
Yeah.
nobody's going to sell.
Correct. So if they don't fall, then we kind of figure out if something around decent businesses offer great return possibilities, and then we keep doing these special situation kind of trades, 3 year holds where you kind of do one and then you find the next one. So there are different ways, but for us, I'm still in cash, and we've not been very aggressive. We've been buying, but not very aggressively, and thankfully, because of that, this correction has kind of harmlessly passed us by without causing too much trouble. At least in our AIF, PMS has come down a bit, but luckily not as much as what I would have thought otherwise.
Sure. Thank you so much. I think I'm already getting nudges. We've overshot our time by 5 minutes, but thank you so much, gentlemen. I think the broad framework is to focus on that 25% earnings growth and keep a margin of safety. That should sort of hold you in good stead. And of course, look for special situations opportunity because they are really a sitter. How quickly and how agile you are about those investments can make a lot of difference to your returns. On that note, Satvik, Neil, Siddharth, thank you so much. And over to you, Aishwarya.
Thank you very much, Ms. Mahalakshmi and our eminent panelists, Mr. Jain, Mr. Bahel, and Mr. Oberoi, for such an insightful discussion on generating 10x returns over the next decade. The perspectives shared by the speakers truly shed light on how to navigate investments with a long-term lens. A big round of applause for them, a virtual one indeed, while we're sitting and watching. Up next, we tackle a question that has been at the heart of many investment decisions recently. With uncertain growth ahead, secular or cyclical stocks, what's the better choice? So we're going to take a 2 to 3 minute break to align the next set of speakers. Please feel free to grab a quick refreshment and keep exploring the zones, and we'll be back very shortly. Welcome back after that short break. As we face a complex macroeconomic landscape, one pressing question investors are asking is how to position their portfolios. Should we focus on secular growth stories that promise stability or take calculated bets on cyclical stocks that can thrive in a rebound? The Nifty is currently trading at a price to earnings ratio of 21, which, while not cheap, indicates fair valuations in a market filled with opportunities and risks alike. With global uncertainty persisting and India's domestic growth story evolving, the choice between secular and cyclical investments has never been more critical for portfolio allocation. This session brings together a panel of industry veterans who will guide us through this discussion with their expert insights. We have with us Mr. Manoj Baheti, co-founder and portfolio manager at Carnelian Asset Management. With over 2 decades of experience in financial services, Mr. Baheti has worked with marquee institutions like Edelweiss Securities, Morgan Stanley, and RIL. He is known for his differentiated non-consensus approach to research. He pioneered forensic research, popularly referred to as analysis beyond consensus, the ABC research, and he's a member of the CFA Institute's global committees. Mr. Manoj also champions health and fitness, having run multiple marathons over the past 8 years. His unique blend of analytical rigor and disciplined personal growth sets him apart as a thought leader in the financial ecosystem. We have with us Ms. Geetika Gupta, Senior Fund Manager at ICICI Prudential AMC. And Ms. Gupta has over a decade of experience in investment research with a keen focus on BFSI, consumer, and technology sectors. Prior to ICICI, she served as Vice President at First Voyager Advisors, managing the fund's investments in Indian equities. Ms. Gupta began her career at Lehman Brothers and later worked with Morgan Stanley Singapore in investment banking. An IIT Delhi and IIM Ahmedabad alumnus, Ms. Geetika combines a sharp academic foundation with practical investment expertise, and her ability to assess high growth opportunities with a long-term view makes her a trusted voice in the industry. And we have with us Mr. Madan Gopal Ramu, Head Equity and Fund Manager at Sundaram Alternates. With over 14 years of experience in the Indian financial markets, Mr. Madan manages an impressive AUM of rupees 3,100 plus crores. He joined Sundaram Mutual in 2010, quickly rising through the ranks to become head of research in 2015 and actively managing funds from 2016. A qualified cost accountant and a management graduate from BIM Trichy, Mr. Madan is known for his sharp analytical acumen and ability to navigate complex market dynamics. His focus on identifying emerging opportunities in the equity space has delivered consistent results for investors. And this session will be moderated by Mr. Neil Borate, who is the personal finance editor at Mint. Mr. Neil is a graduate in law and economics with a postgraduate diploma in investments from the University of Birmingham, UK. And Mr. Neil started writing about personal finance in 2016 at Value Research. After a stint at a fintech, Mr. Neil joined Mint in 2019 as a mutual fund reporter. He was made deputy editor in 2022 and subsequently promoted to the role of personal finance editor. He has also co-authored the book, The Big Bull of Dalal Street on Rakesh Jhunjhunwala, one of India's most successful investors. I now invite Mr. Neil to steer this exciting discussion. Mr. Neil, it's over to you.
Thanks, Aishwarya. This is probably the most pivotal question in the markets because if you get this trend right, this determines your success or failure over the next cycle. Now we have quite a few questions to get through. So what I will do to optimize for time is open up each question and then move to the next. So only if you differ with the answer given, please also add your inputs. Otherwise, that's how we'll cover the entire list of topics that's given to us. So let's begin with the definitions. When we say growth versus value or secular versus cyclical, what exactly do we mean? How do we define it? Who would like to first address that? Manoj, please go ahead.
Yeah. Hi. So good afternoon, everyone. And in fact, it's pleasure to be on this forum. And thanks, Aishwarya, for the introduction. So let me just start with secular versus cyclical opportunities or secular versus structural trends. So our view here is that in essentially in a structural growth market, one should always focus on the structural trends. Secondly, in uncertain times like this, when there is a lot of volatility in the market, these uncertain times gives a very good opportunity to capture structural ideas. So let me just ask a question back to you and audience, that if you can capture, let's say, a cyclical idea which can give you a potential upside of 25, 30, 35% over a period of next 12 to 18 months, vis-a-vis a structural idea which is available at a reasonable valuation right now, and which can give you a power of compounding, let's say, of 15 to 18% over last 15, 20 years. So my call will be to pick up the structural trends, to pick up those structural stories which are reasonably placed from the risk and reward perspective, like which are available at a reasonable valuation and which delivers a reasonable growth to the investors. And if I look at the various structural trends, definitely there are like cyclical issues, like there is a quarterly earning disappointment vis-a-vis expectation. There are global geopolitical issues. There is a kind of tariff war which is going on globally. Every day we are hearing a new noise, and which is creating a volatility in the market. But within this volatility, I think it also create opportunity to capture those structural trends or those structural names and live with them peacefully for next 5, 10, 15 years. So I am in the camp of the structural ideas vis-a-vis cyclical ideas.
Sure. But Manoj, in terms of defining them, could you lay out some parameters? Is it the volatility of earnings that separates the two categories? Or if there are certain sectors that by definition are cyclical, like capital goods, if you could just give some examples.
See, I would say over short term, most of the sectors are cyclical, even like the consumer names. The way the urban consumption have taken impact, the way the consumption has slowed down, whether it is impacting the structural trend of those names, even like we have invested in various CDMO names. Few of the quarter there can be a delay in shipments, there can be delay on the customer side, there can be a delay on the factory ramp up, whether we call it as a cyclical factors. So definitely few of the sectors which are like essentially commodity linked sectors like metals, oil and gas, where like your destiny is not in your head, neither you can determine the prices of raw material nor you can determine the prices of finished good, you are just a price taker. So these are essentially commodity sectors. There are experts who can play the cycle. But other than that, in a market like in India, whether you take pharma, CDMO, consumer, capital goods, there are structural trends if one looks beyond short term cycles.
Okay.
Yeah,
Would
just
any-
to add to
yes.
that, I think just thanks Manoj for laying it out. But I think you've mentioned like the right thing, right? Like basically, it's a very gray line between what is structural and what is cyclical, right? Because even sectors like consumption, and there are various legs within consumption, right? Be it real estate, services, products, consumer durables, consumer FMCG, all of them are cyclical to different degrees. So, I mean, without basically compartmentalizing the market between what is value and what is growth, I think, basically we need a combination of both for stocks to do well. Growth without value, even if you're capturing a high growth name, but it's trading at a very high valuation, that doesn't, generate alpha. Similarly, at the same time, if you're going for a value stock, but, there's no growth, it might end up being a value trap. So, you need a combination of all. You need growth, value, as well as a great business. The business should have some right to win. If you get a good combination of all three, that's basically what we sort of focus on, instead of really looking, saying that okay, now growth will work or now value will work, and accordingly let's reorient our portfolio. That is not the approach that we take. It's more bottoms up and looking at the earnings growth with the valuations for various stocks and sectors.
Okay. Madan Gopal, if you'd like to add the definition. Yeah.
Yeah, as I think Manoj put it, there is this thing like as much as you want to think there is cyclical and structural. I think everything is cyclical. It's the time zone of how long the cycle remains, and that's where the difference comes. If you look at, there are certain, if you say how you define a structural story and how you define a cyclical story. A structural story, in our experience over last say 15 years, we can give examples taking a sector and telling you between these, within the sector, these are all structural and these are all non-structural. Like let's take banking or NBFC. What an Bajaj Finance could do, what a Chola Mandalam can do, is not something what a PSU bank can do, or even what HDFC Bank did for so many years. It's not something that your PSU bank can do. So what really Bajaj Finance did, or what really Chola did, these are run by amazingly great management or promoters, right? They started with one business, that TAM was say X, they kept growing, but they never let down the growth. They kept adding the TAM continuously. They kept adding the TAM continuously to the extent that today we are in Bajaj Finance with a 4 lakh crore loan book. We are still talking about 25% growth. So at 1 lakh crore, there was a doubt whether this company can grow 25%. At 2 lakh crore, there was a doubt. There's at 3 lakh crore book also, there was a doubt. Even at 4 lakh crore, we are still saying he will still grow 25%. So what really changed in this? The ability of the management to continuously identify adjacent areas or new areas and keep adding the TAM and execute it. Same thing done by Chola. While on the other side, if you take a PSU bank, they just depended on corporate as a only area of growth, which went through a cyclical period of up move during 2008, 9, 10, 11. And then when the corporate loan book started degrowing, these automatically become cyclical stories. And then the growth saturated. Probably once the corporate leverage starts picking up momentum with private capex, hopefully it is not still happening. All of us want to happen, but it is still not happening. Probably they might remain cyclical growth story for 2-3 years. So I think that's where the definition. I can take one more sector, like even within consumption, what a trend can do by starting with West Side and then adding Zudio. Again, it will come to the same point. In India, you are obviously not going to get tech companies like US, where it's going to be a structural story for 10 years, 15 years, right? You are going to get companies which are probably 5 years growth story maximum. Sometimes exceptions are these Bajaj Finance, which are 10-year growth stories. But yes, an ability of the management to continuously identify new growth areas to sustain a 20% plus growth and then keep delivering that and executing it is one way of defining structural stories and non-structural stories. There are very rare such companies in India. Probably in a year, if you get 2 ideas, you will be very lucky. But I think everything else can be defined as a 3-year cyclical story or just a 6-month cyclical story. That is the cyclicality that is dependable. And post-COVID, I think the cyclicality just increased tremendously because companies came back of COVID in different period and delivered growth. And we are seeing the problem of that, right? Not almost all the sectors now come down back to the base in terms of expectations. So that's how we internally look at structural and cyclical stories and define them.
I'm going to segue a little bit into an area a question that actually Devina Mehra raised in her book recently, which is the issue of forecasting in a DCF or any other kind of method. It's very difficult, she says, to forecast valuations beyond, let's say, 1 or 2 years. Even the management doesn't know how the company is going to pan out in the long term, 10, 15 years. So in that context, is it even possible to identify a secular stock? As in, does that present a challenge?
You are asking me to start with this?
I'm opening it up to the panel. Anyone can take it.
Okay, so I'll start probably when others join. If I have an additional point, I'll come back probably after that. See, I think first point is I think getting into DCF for every stock is actually probably a misnomer. I feel that although we have all studied about DCF as a methodology, very sound, but as you said, it suffers from the predictability point of view beyond a particular point. Your ability to put numbers beyond 2 3 years. I don't think you need to project sitting today beyond 5 years. I don't think that much is expected from the fund managers to create value. I think today, if you can project any business beyond 2 years itself, you can create a difference between expect. I'm not talking about the value zone, whether it creates value or not. That depends on what is the valuation of the stock. But for you to say that you have a differentiated growth path compared to what the sell side is having or not, I don't think you need to think beyond 2 years. I think most of the sell side will try to get the 1 year number right. Maximum 2 years to an extent. I think broadly 2 year numbers keep getting revised. This year is a great proof for it. From a 16% growth, we have come down to 7% growth. So it's a great proof that the consensus is always not right, and most of the time it goes wrong. So for you to get a structural story, I think most importantly, what is important is where are we in the cycle of that particular company's growth in that growth engines. So that is very important. Like for example, I can talk about Unominda as a very different sort of company. Auto anchors are not known for growth, right? I don't think in many auto anchors after a brief period of growth. But Unominda again comes back to the same point that I mentioned. This company will keep on getting you new products. And they have devised their business in such a way they will form part of the high growth engines of the market. So now if you break it and then see, you will get at least in industry growth, plus you will get the content per vehicle in growth of around 5-6%, and then new product addition will add another 5-6%. Basically, if you find enough number of points adding to each of these three zones of growth that the company is creating, for you to say that this company, irrespective of auto sector growing in double digit or not, or even if they grow in high single digit, this company can grow at 19-20%. And then when you observe the valuations are somewhere closing, it will not available at a discount to overall value, right? Book market valuation. So probably if it comes closer to the market valuation at some point of time, you probably look at a great value in front of it. So we approach most of the structural ideas also from that framework. Probably some of these ideas are at the end of their growth cycle and may not be able to continue to grow at the pace at which they probably delivered the last 4-5 years. But I don't think you need to come down to DCF to come to a conclusion in these. Most of the time they get overpriced when they are at the peak of the valuation. Best way to judge whether value is left or not is to say that whether there is a lot more people who are turning positive on the stock and it's becoming, mostly I say, you enter the stock before it gets into MSCI and you exit the stock after it gets into MSCI, because by that time most of the flows would have happened and the stock valuation would have got identified. So this is one way of looking at it. I think DCF is a great technical tool. Using it without paying attention to flows in the market and buys and sells of the market in that particular stock can make you make mistakes.
Okay. Geetika or Manoj, would you like to add?
Yeah. So I think DCF as a tool works more for companies which have a high predictability of business. What that means is companies which have a strong competitive economic moat and where the longevity of the industrial growth is quite high, right? So it works more for those kind of stocks. But having said that, the moat and the longevity also keeps changing, right? So for example, for a company like DMart, where you would think it's a structural story and growth, you can predict it for 10 years. But as the environment changes and as new competition comes in, maybe in the form of quick commerce, which happened in the case of DMart, it is not static. The assumptions which go into the DCF, growth, profitability, all of that, nothing is constant. All of that constantly evolves. So to that extent,
Because
DCF.
therefore, is the margin of error bigger in a structural name because there you're paying a higher premium for those earnings?
So margin, see, every valuation has to justify the ROE and the growth rate that it delivers, right? If the growth rate is coming down, or if the profitability is coming down because there's a new competition or a new business model which has come and attacked the existing business model, at that time the valuations will not sustain, right? So for a stock which is trading expensive, so if there is an expensive stock but you can't justify it saying it's a structural story if there's no growth, right? Or the profitability is coming off. For those valuations to sustain, the profitability as well as the growth rates have to sustain. So it's never static. It's never. I mean, it's not really you can just buy great businesses, secular stories, and sit. You have to constantly evaluating what's changing in the business environment to also make sense of the valuation. So secular stories, we've seen a lot of them go through challenges in the last couple of years, especially where newer competition has come in.
Okay. Manoj, you want to add to this or?
Yeah, I would just like to add, I think both of them have covered pretty well. Only one thing I would like to add. I think, unlike common sense, it is easier to predict long term vis-a-vis short term. And in DCF calculation, even if anybody's model, if you see, 60 to 70, 80% value comes from terminal value. And what is terminal value? It is not just putting just some number in denominator, then arriving at a number and feel happy about it. Terminal value is the outcome of the quality of management, quality of business, how business is placed vis-a-vis competition, how business is growing over long term. Let me just give you an example. I worked in hardcore business with Reliance Industries, and there I used to run cash flows of refining business, and our target was to reach 10,000 crores that time within a certain time frame, and we used to do a monthly monitoring of that. Despite of having all the ingredients with me, unlike outside sell side analysts, including prices, production, and all those numbers, monthly number used to be off by a huge percentage. Still, we comfortably crossed 10,000 crores ahead of the time schedule. So I would say, if even if you take an example of India, if anybody says that during Amritkal period, India's GDP is likely to grow from 4 trillion or 3.8 trillion to 28 to 30 trillion, I would assign a low probability of him going wrong. Maybe like he may go off by 1 or 2 years, but we will be there. But if one has to do a forecasting that what the GDP is going to be next quarter or next year, then the variation can be much, much higher. So my call will be, rather than just focusing on numbers, focus on the drivers which goes behind those numbers, which are like a mix of qualitative and quantitative factors, which I mentioned: quality of management, business, moat of the business, and the competitive scenario.
Okay.
I'll just take a minute just to add to that. Actually, DCF works as a wonderful a tool to identify what is getting mispriced, right? So if there's a stock which has not been able to deliver in the near term and the valuations have crashed, right? If you look at the DCF, that will tell you, the growth rate that the street is factoring in is very low, right? Because of the recent past, right? So then you can actually take a call that, when you build more reasonable growth rates, which the business is actually, which has the potential to deliver, then you get to know the mispricing a lot better. So DCF as a tool works great the other way around, where you get to know what is, on the way up as well as on the way down, what is getting mispriced.
Right. Okay. Now there's been a heated debate in the market about the valuations of large versus mid and small caps. Does this connect to the topic at hand, which is the rotation from cyclical to structural? Would somebody like to take this up?
Yeah. Yeah. So probably I'll take it. See, this is an interesting debate. I'll throw what we learned looking at mid and small caps very closely, particularly mid cap. I'll take a lot of people ask me about whether mid caps at this valuation should be a set zone. If you look at the long term chart of mid cap versus Nifty, the way the premium increases and decreases, like a triangle, it's never proven wrong. I think every 4 years this keeps happening, and how much ever you try to be away and saying this time the cycle can be different, probably the longevity of the cycle can change, but I think the cycle goes through this phase of getting over too much attraction and fall. I think you need to be very conscious about it when you're trying to decide particularly if you are in a passive investor or a diversified sort of a portfolio investor in the mid and small cap space, because you benefit from the cycle, up cycle, and you also have to go through the pain during the down cycle, irrespective of it is a function of flow most of the time. Sometimes earnings helps you, but most of the time it's a function of flow, which we are seeing. But when you look at the mid cap, it's an interesting space. Mid cap is like a railway junction, in the middle of India, somewhere like a Bhopal. It trains which are coming from becoming a large cap to mid cap to small cap, which is like a derating stories. For 10 years, they have not grown, and they are also sitting in that. And trains which are moving from small cap to large cap is also midway, they are sitting in mid cap. Now, unfortunately, market tries to look the entire universe as one and say entire mid cap is either buy when the flows are happening, sell the entire mid cap when the flows are weak or when the earnings is weakening. Actually, it is not. If you look at Q3, when the Nifty's earnings growth is only 5%, 40% of mid cap universe out of 150 mid cap index, if you take, have delivered more than 15% earnings growth. This number has come down from the peak compared to last 4 quarters. It has now come down, but still it is almost 40 to 50 companies which are delivering in mid cap out of 150 index, which are delivering more than 15% growth, which is 3 times the growth of large cap. But there are another set of 60-70 stocks where the growth is less than 10%. What worked really well in last 2 years because of cyclicality, the other bucket worked really well because they were cheap and the mean reversion happened really well. So you made money out of mid caps from completely non-structural. Structural stories also participated, but if it is more predictable stories, it has not probably participated. It is mostly wherever there is surprises that participated. So lot more of the momentum narrative based, the bucket which I am referring to, the bucket where it is heading down and temporarily it got the benefit of doing well after the COVID. That bucket got overpriced for at a point of time. So I think this differentiation has to be kept in mind. So when people look at mid cap as a cap curve and invest into diversified funds or invest into passive investment into it, they should probably understand that there is 2 types of buckets within this mid cap universe, and according to which bucket you are in at what cycle will depend on what return you make. Otherwise, I think from a growth engine perspective, looking at what is happening in Nifty, so Nifty's problem is not valuation, Nifty's problem is earnings. And for a 5% earnings growth, how it will justify an FII to come and buy it? Imagine if you are getting 5% US Treasury yields and then you have a risk of currency depreciating. I think FIIs will not come unless something dramatically happens to the dollar call.
You're saying even 21 is not justified.
Yes. Unless we come back next year and say, no, Nifty's earnings growth is now going to be 15%, which is what the expectation at the beginning of the year was. Now it has come down to almost closer to 5-6%. So we feel that if there is no safe zone in the market across the cap curve, you can say you can hide into Nifty, probably because Nifty has not worked for 3 years. So 70% of Nifty stocks have not worked for 3 years. So you can hide there. But if you really want growth, and with the way market is crashing today, and keeping in mind that there is a bucket of mid caps, small caps, which are still growing and growing substantially better than the Nifty. At some point, if you find valuation, you have to get in with a 3-year view. Next 1 year, I think all nets are going to be chopped off because as much as it went up, everybody is trying to cut it down. But I think if some investors who can take a 3-year view, they will get a good bargain on some of these mid and small cap names, which have potential to deliver a 3 year of very high growth compared to Nifty.
Very well put. Geetika,
Yeah. So I think let's look at what led to the rally, right? Like if you look at last 4 years on the base of 2019, the earnings growth was very healthy, right? And it was very, very broad based. So if you look at just a small cap, the earnings CAGR was close to 40%, right? And that drove the sort of returns that we saw in the small cap and similar in mid cap. And this is not just coming off a low COVID base. Even if you look at the period prior to that, which was basically 2014 to 19, right? Even then, I mean, if anybody were to take a guess of what was the earnings growth for small cap, it was literally 0%, right? So it's coming because of a low base, not only COVID base, but even prior to that. And because of this 40% kind of earnings growth, we saw the kind of rally we did. But today, as we speak, I think a lot of it is in the base. The base effect has sort of normalized between small cap and large cap. Can we still get another 30-40% growth? I think the jury is still out. But I think because the base has normalized, expectation of 15 to 20% growth would be more reasonable. So because the growth rates for a lot of stocks will come down from 30% plus levels to closer to 15% or 20%, the derating is something which is taking place accordingly. So not don't want to paint everything with the same brush, saying that the small caps are expensive. I think for each stock, each sector, we have to take which are the companies or sectors which can still deliver maybe 15-20% growth, which are the companies where they can't basically deliver even 10% growth, and accordingly one has to take a call. But we are definitely away from that period where the discoverability was an issue, right? So 3 years back when we bet on manufacturing, there was a big difference in the market. People had given up on manufacturing. Consumption names were very expensive. There was low discoverability on manufacturing. That we think is largely done now. Manufacturing is also expensive. So the stocks which are expensive have to justify those expensive valuations. And if they are not able to deliver that sort of earnings growth, there will be a continued derating. So I think the base is normalized, and accordingly one has to be careful, because earnings growth will not remain as high as it was in the last 2-3 years.
Right. But do you agree with Madan Gopal's assessment that in large caps, the earnings growth is just 5% and therefore even 21P looks expensive?
So earnings growth, again, if you look at Nifty as a basket, again, maybe 5% is the number. I mean, we always take a bottoms up approach. As I said in the first question as well, basically you need a combination of growth as well as valuation. So just valuation, so sectors which are not able to deliver growth, which can only deliver 5% earnings growth. I think I would agree with Mr. Madan Gopal that it's very difficult to get valuations in those sectors. But some sectors, like for example, even within consumption, right, like we are seeing a big difference. Like services sector is doing much better, right? Maybe the FMCG companies are not able to deliver those sort of earnings growth, but just because of shift from unorganized to organized, retail sector is doing very well, right? And some of these stocks have done really well, and which might continue. So wherever there is growth in large cap, even in maybe in the other market capitalized stocks also, accordingly we will see the movement in the stocks. But having said that, the 10 to 15% earnings growth in an uncertain environment, whether large caps are better placed or the small caps, that's basically the key debate.
Okay. Manoj, a slightly different version of the question to you. So if you think back historically, we've had very distinct phases of growth versus value. So we had the 2016-17 boom in value. Then we had 18 to 20 where growth took over, the breadth narrowed massively. And then post-COVID, again, value came back with a bang. So are we at another inflection point where we're going back to a 2019-20 kind of or 18-20 kind of market?
See, I think if you are investing in a market in India, I think you cannot live without the growth element. Just buying a value stock where the growth element is missing. See, if you look at India, the right now, even at the subdued GDP growth, your nominal GDP growth is close to 10%. Your corporate profit has to be grow much faster than 10%. Like if I take corporate profit to GDP ratio right now, it is at 4.8%, which is last 15 years high. So I will be really surprised that this 5, 7, 8, 10% kind of corporate earning CAGR will be a sustainable growth for a country like India. In fact, one more data which I would like to add, if I look at the overall incremental GDP growth of the world, and on a purchase price parity terms, India is contributing almost 20% of the incremental world GDP growth. So we are in a in a country which is known for its growth. And here, if anybody is putting money into stocks, he will make money only, or he will compound the money only by growth element. The value part also comes in, that you should not pay any price for the growth. You should be cognizant of the fact that there is a risk and reward in the investing. What is the margin of safety when you are buying the growth? If you are paying any price for a lower growth or for a reasonable growth, then it can lead to a subdued growth. And on your topic of mid cap to large caps, I would say that every large cap used to be a mid cap at some point of time. So in this country, in India, it gives enough opportunity to identify those mid and small caps which has potential to be large caps of tomorrow. So if you can just focus on slightly medium to long term, I would say that value versus growth debate tilts in the favor of growth stocks available at a reasonable valuation, where businesses have a large TAM, where management quality is good, balance sheet is good, and business is delivering decent ROEs, ROCs. If you can pick up those names, whether it is in mid caps, large mid caps, and even in some large caps, it doesn't matter over a long period of time.
Thanks, Manoj. We are sorry.
One additional point that I had on the approach towards, so how do you really, so where is the gravity shifting? That's a very important point that we keep debating, right? The gravity last 2-3 years was like, if the more of a value sort of an gravity shift. So in your portfolio, if you had approached anything with the view that it's cheap and there can be some positive surprise, that worked. And now we are slowly shifting to a period where we need some bit of a conviction growth. It can be even smaller, but still it matters. In that context, in large caps, as much as there is a problem in terms of growth, but it can always be looked at from a Dorcas theory. They may not be the winners, right? They may not be the winners from a growth perspective. But in a Dorcas theory, you don't make money by betting on the number one stock all the time, because the bet against the stock is very low. Therefore, in a total sum basis, the guy who's betting on the number one horse is not going to benefit. The guy who's betting on the second or the third, and if the third becomes second, he is going to get more money than the guy who's betting on the number one horse. From that, bucketing can see some that can be a bucket where you need to be a little bit more focused on, because the growth itself is going to be constrained for many. And if you already want a stock which so far till the growth came, till the money kept on flowing, you could have said where stock is trading at 30 times can go to 40 times, 40 times can go to 50 times. Now, where really does the bottom lie? Whether the 40 times can come down to 30 times, even if the company is growing at 30%, and if the valuation drops from 40 to 30 because the overall mid cap valuation is coming down, then you're left with no return from that stock. So that is going to be sort of a challenging thing, because we also basically believe in growth as a basis to invest. But this is the challenge we really face today, that we can talk about growth, but they are sitting at a very high premium valuations. So where it stops? Does it stop with a 10% correction or a 20 or a 30% correction? Then the growth is taken away from you. But I think slowly we are getting into this inclination. We have to look at certain companies which are growing even between 10 to 15%. If they, by luck, surprise you this year, then they will be the ones which will create alpha for you from this year. And this may not be the entire portfolio. I think part of the portfolio needs to be allocated to such buckets also.
Fair enough. Great. Thank you so much, Madan Gopal, Geetika, and Manoj. We are at the end of our time. I'll now hand it over to Aishwarya. Thanks, everyone.
Thank you very
Thanks.
much. Thank you to our panelists and moderator for shedding light on the debate between secular and cyclical stocks amidst uncertain growth prospects. So thank you, panelists. Thank you to our moderator, Mr. Neil. Your insights have undoubtedly helped us better understand how to approach portfolio allocation in today's challenging environment. And our next topic delves into the realm of alternative investments with a focus on leveraging long-short strategies for superior risk-adjusted returns. But before we move on, let me remind all of you, and especially those who have joined us in the last few minutes, that this event platform has specifically been created for hosting the summit virtually and has many dedicated areas apart from auditorium, like the breakout rooms, networking lounge, a lobby with an information desk, and so on. So while we quickly line up the speakers for the next session, please explore all these options for a better experience. I will see you in 2 to 3 minutes. Don't go anywhere. Long-short strategies have emerged as an important investment category in portfolio diversification, particularly for HNIs and NRIs. These strategies allow investors to capitalize on both rising and falling market scenarios by taking long positions in undervalued stocks and shorting overvalued ones. This approach not only enhances returns but also serves as an effective risk mitigation tool in volatile markets. For large investors, long short AIFs are especially valuable as they provide an opportunity to access sophisticated investment techniques, balancing wealth preservation with growth. In a world where traditional equity investing alone may no longer suffice to meet risk adjusted return expectations, long short strategies offer a pathway to sustainable and superior outcomes. This panel features industry experts who will share their deep understanding of crafting and managing such strategies. And we have with us Mr. Kalpesh Jain, fund manager at Tata Asset Management with over 17 years of experience. Mr. Jain has honed his experience across fixed income trading, derivatives research, and hedge fund management. And Mr. Kalpesh's ability to navigate complex market conditions and generate low volatile risk adjusted returns makes him a standout in the alternative investment space. Before Tata, he held key roles at Julius Baer India Limited, Ambit Capital, and Edelweiss Financial Services, further enriching his knowledge of innovative strategies. We have with us Mr. Puneet Sharma, fund manager and CEO of Whitespace Alpha, and I am Lucknow alumnus. Mr. Puneet Sharma is a leader in designing advanced investment strategies with a focus on derivatives and cash markets. At Whitespace Alpha, he emphasizes creating high risk adjusted returns while incorporating robust risk management practices. His previous experiences as associate director at PwC India and his early career at SAIL bring a unique blend of financial acumen and strategic vision to his current role. We also have with us Mr. Vineet Jain, CIO and founder of Volvin Limited. And Mr. Vineet introduced India's first AIF centered on a covered call strategy, revolutionizing how conservative investors perceive risk and return. With over 30 years of equity market experience, Mr. Vineet has weathered numerous market cycles, including the Harshad Mehta era, the dot-com bust, and the 2008 financial crisis. His entrepreneurial spirit and innovative mindset have reshaped the alternative investment landscape. A graduate of MDI Gurgaon, Mr. Vineet's groundbreaking initiatives, such as India's first All India B School stock market game, underline his ability to think ahead of the curve. And this enlightening session will be moderated by Mr. Bhautik Ambani, who is the Chief Executive Officer of Alpha Grep Investment Management. Mr. Ambani is responsible for driving business growth, strengthening and expanding the firm's domestic presence, and enhancing customer experience. Under his leadership, the company has launched Alpha Grep's maiden Alpha Mine Absolute Return Fund Category 3 AIF. He has over 18 years of industry experience and is an MBA in finance from SP Jain Institute of Management. Mr. Bhautik, so privileged to have you here. The stage is all yours.
Thank you so much, Aishwarya, and thank you everyone for joining on this call today. And a very big congratulations for PMS AIF World to have the sixth conclave. So what I'm going to do is, I think it's an extremely opportune time to be discussing risk-adjusted strategies or hedge fund strategies, considering the volatility in the markets that we're witnessing nowadays. I think it'll make a lot of sense for investors to kind of understand how some of these strategies aid or help portfolios in times like these, which generally don't get protected, let's say, if they were just investing in traditional investments. I think the word risk-adjusted returns, to a certain extent, from a layman perspective, is difficult to understand. It basically means that for every unit of risk that you are taking, what kind of returns does one generate? I think from today's call, what we will try and understand is how some of the strategies that some of my colleagues here run as funds do help in better returns for the same amount of risk that you take, and how it is different compared to, let's say, what you generally do with traditional investments, so-called mutual funds or PMSs, which are not able to deliver similar risk-adjusted returns. I think another way to look at risk-adjusted returns is, let's say, you are driving a car and the journey for both the drives is the same, but one car is driving very recklessly and the other car is driving safely. The objective is not to just reach the end point or the end of the journey, but the objective is to enjoy the journey as well, which is what I believe is, what can be offered with better risk-adjusted returns. or with some of the funds that some of my colleagues run here, or even we run at Alpha Grep. So with that, I'm going to start with the first question, which I'm going to be asking all the three panelists, and which is to very simply, what I can do is, maybe Puneet, you can start on this. Is how do you, from your perspective, how does a layman kind of compare a hedge fund strategy or a long short strategy? Because some of these terms get used very interchangeably in the Indian markets. I know they are different from each other, but having said that, if one has to look at some of these products which use derivatives extensively as part of their investment strategy, how does one compare that to traditional investments, or how does one differentiate that compared to traditional investment? So, Puneet, maybe you want to start at this, please.
Sure, Gautik, thank you so much for this. I think what you've spoken about is a strategy which is using derivatives in order to curtail the amount of risk that a portfolio is generating. So I think Vineet also does something very similar in this field. Uh, by using derivatives, we can essentially hedge off the risk of whatever is the long position that you have taken in the underlying portfolio. So if you have a portfolio which is all long onto a certain specific sector, let's say banking sector, so you obviously have a index which is available in order to hedge off the position in case you are afraid of a particular fall in the market or any event which is going to happen in a field which may impact the returns from the equity portfolio that a particular investor may have, or the management may have. The hedge funds that we have here in India are slightly different from what we would normally understand them to be. Obviously, there are a lot of restrictions on what Category 3 AIF can do or cannot do in India. Within those guardrails, I think we have a lot of opportunity to generate alpha using these strategies as well. That is what something that we do at Whitespace Alpha as well. But having said this, in order to compare the difference between a long only strategy or a long short strategy or a hedge fund kind of a strategy, I think long only strategies are purely banking on the fact that in the long term, equity stocks or whatever portfolio of stocks that a particular investment manager has picked, they will generate a certain amount of return out of just pure capital appreciation. On a hedged portfolio, what additionally you can do is that by also accounting for the capital appreciation from the equity stocks, there is a possibility of either restricting loss in the event that the particular stock falls or generating a small amount of profit while the stock is actually going up. That's, in my opinion, how they work well. Anybody else on the panel has any inputs, will be happy to hear that as well. So I can
Thank you, Bhautik. For the layman, I would first want to add, just to explain to them, that we have close to 1,000 equity mutual funds in the country. We have close to more than 500 PMS, around 500 PMS, and we have alternate funds, maybe around 100 alternate funds in Cat 3. And you will find that, about these 2,000 funds in the country, all the funds are focused on long only, means passive investment, do a lot of good research, buy the stock and sit tight and wait for it to go up. So it's the most focus is on research and trying to create an alpha of 3 to 5% over what the market does. But a very interesting data that I would want to share with you is, for the last 25 years, Nifty has done a CAGR of around 13-14%. And 15 of these years, it has created a positive return. And 10 of these years, that is 2 out of every 5 years, it has not created wealth. So, that is 40% of the time annually, if you measure, Nifty does not create returns. But all the 2,000 funds, primarily more than 99% of them are focused on simply buying and waiting for the stock to go up. But what about those 2 years, which come every 5 years on an average, where Nifty does not create returns? So this is where the long short fund has an edge, because in these 2 years, you can also try to create returns if your view is negative. So mutual fund managers, if their view is negative, they cannot take benefit of it. All they can do is reduce their cash positions. I mean, increase the cash positions, reduce the portfolio. But in a long short fund, you have the ability to use derivatives, to use it any which ways you want. You can short the market, and also try to create an alpha even when the market is going down. And the second point I want to mention is that primarily all of us, in research are focused on trying to create an alpha of 3 to 5% over the year. But we fail to recognize that if we see, I mean, we have tracked the volatility of F&O stocks, 200, 180 to 225 F&O stocks for the last 4 years, 5 years, what they do on the difference between their highs and lows in a year. And if you hazard a wild guess, people might say that the difference between high and low could be 20%, 30%. But the price differential between their and lows in each year is more than 80 to 120% a year, which is a crazy number. And if you compare it with an alpha of 3 to 5%, it is probably 10 times more important to track the volatility in the stock. Whereas long only the traditional investments, they are not worried about volatility. All they say is that, try to stay put, try to buy the right stocks and do the right selection. So this is long short is much more dynamic, and you need a lot of expertise in handling this. So, and this is probably how it is extremely important and different than the traditional investments. And it is for that period where, those 2 years where most of the other fund managers will be helpless. This fund at least has the possibility to generate an alpha even when the markets are going down.
Thanks, Vineet. Kalpesh, do you have a perspective on this?
Yeah, so very well said by Vineet. So what we have seen, at least in India, the long short actually came into place in 2013, and over the years we have been seeing a good amount of attraction by the HNI clients in the long short fund. But why they are seeing attraction is as is as you already said, the long only mutual funds are something which are giving you good hope for the next 5 to 10 years. But there has been many years where the markets have given negative returns. So in such case, long short funds are something which helps you in equalizing your expectation, and it also helps you in getting positive returns even though markets are down. So, and what we have seen in last few years is like Indian markets have evolved very heavily in on the futures, and as well as majorly on the options front, where the volumes have been at least, if not less than 1000x in last 10 years. So there has been very high liquidity in the options front, and options has been one of our core base to make money in our long short strategy. So overall, there have been some regulations within our Indian as compared to hedge funds, but overall that regulation is something which is good because it helps us to curtail our risk, because there have been situations where hedge fund gets bankrupt largely because of the over leverage they take. But in India, we have this restriction of 2x max coverage of your AUM. So I think what we have in our in India is basically good amount of risk management by the regulators, and what we can do within our framework is something which can help us invest at least on the volatile markets like this. Like when markets are down 14-15%, most of the long short funds are giving you 7 to 8% return. So this type of volatility will actually help which will actually get reduced when you use a long short fund as your category.
Thanks, Kalpesh. So I think that helps me segue into the very relevant point, which is again extremely pertinent in times like these today, where the markets have corrected in the last maybe 4 to 6 months, and they corrected fairly sharply in certain segments of the market. Vineet, maybe I'll direct this question to you. Do you think that there is an opportunity for investors to capitalize on both rising and falling market scenarios using hedge funds, long short funds, or do you think these kind of funds only make sense when markets are falling? And in those kind of scenarios, can one take an advantage by participating in some of these long short funds?
So, Bhautik, I guess this is one of the toughest questions to answer. And the answer actually lies in, the view of the market. And, it's very easy to say that, tomorrow the market is going to go up or down. But we never try to predict market. And if somebody has a very clear view that the market is going up or going down, then definitely we can benefit, because it's an option you have. If you have a view, for example, if I am a equity mutual fund manager, and I've bought 20 stocks, a well diversified stock, portfolio. And all I can hope is that, industry will do well and the stocks will go up. But just in case, what is happening for the last, couple of quarters, we're seeing the quarterly numbers are very bad. And, even the next quarter numbers do not seem to be auguring well. It does not seem that they will be good. So I have a negative view, but being an equity fund manager, I cannot do anything. I'm helpless. All I can do is have a little more cash. But in case one has a strong negative view, a view on the market that the market is going down, like we have currently, and in that scenario, definitely the fund manager of a long short strategy fund has an option to create more shorts than longs and try to hedge the portfolio. But it will be very, very difficult, and depending on what the objectives of the fund are, whether he's trying to preserve wealth or create wealth. And it's easier said than done. But even if I have a negative view, and let us say the market moves up, the fund manager may actually end up losing money because, it's purely based on the directional call you have taken. And if your directional call is wrong, you may not actually end up making money. But at least if your view is clear, you can reduce the risk. So I cannot say that, the investor will be, or the fund manager will be able to create wealth on both sides, because having a market view is itself is very, very difficult, and having a clear view about the market is not so easy. But definitely, if the valuations are high and you are not liking the market, you can engage in, de-risking your portfolio by creating more arbitrage positions, by creating higher shorts positions. And there is a possibility that the fund manager can actually try to create wealth. Yes, it is possible, but I will not say that, it can be done easily. It's a very, very difficult thing to do, but can be done.
Sure. So I think what I'll do is, Puneet, maybe I'll jump to you as a next point here. And the point I want to make here, and the question I want to ask you here, is that I think this is something that you all offer as a solution, like even we do at Alpha Grep, is to offer replacements or solutions to, for example, fixed income or equity, by combining fixed income with, let's say, derivatives trying to generate alpha, by combining equities with derivatives to again generate alpha.
Right.
Now, why do you think that is a good solution? B, why is it better than just investing in a pure play traditional debt or an equity product? How is it different? How is it better? And why is that solution kind of making sense for clients?
Sure. Well, before I even get into the details of why this is probably better solution compared to the other alternatives, the other alternatives that are there in the market essentially are long funds, which are more passive in nature. Our funds, and I'm assuming something very similar happens at Alpha Grep as well, is this is more of a replacement for funds which are more passive in nature, and thereby somebody who's already taking a view on the market is confident of the India's growth story, and that's how it's going to pan out, and that's how it's going to reflect in the Indian equity markets as well. It's a very good alternative, because what it allows you to do is, in the long term, equity markets are expected to go up. And we need to obviously very articulate in emphasizing the fact that they've delivered about 12 to 15% kind of a return, 13%, I think, if I remember correctly, over the past 20 odd years. That's something that is expected to continue in the near future as well, and in the long term. So banking on that, but at the same time, if you're able to add an alpha on a month-on-month basis or a quarter-on-quarter basis to the investment of the portfolio, that just makes the whole story a lot sweeter. So while the equity market goes up by, let's say, about 12, 13% in a year, averaged out over a long period, of course, a market neutral strategy, which kind of makes money when the market is going up or when the market is going down, that primarily obviously using derivatives and solutions that you have built around options and futures. So that enhances the returns that an investor can generate out of this long portfolio comfortably. Also, it reduces the volatility in the returns overall, because when the market is going down, you lose less than the market. That's very critical. When the market starts going up, you're starting off at a base which is much higher, and thereby gain a lot more when the market correct and go up again. Similarly, for the debt investment, if somebody is investing into a debt portfolio with a very secure kind of a return that they want to achieve out of that particular portfolio. A debt product with an essentially very low risk strategy on the derivative side can generate an alpha. It's possible, it's risky, but it's possible to generate those kind of alpha. And like you started off the entire discussion, risk weighted return is essentially what we are aiming to generate out of all the portfolio that we also manage. So there, it's a very good replacement for somebody investing into the debt portfolio, because while the debt portfolio currently will generate about, let's say, about 7% this kind of a product can, and other similar products in the market can generate an additional income, an additional alpha over and above the 7% in order to generate long-term growth.
Sure, thanks, Puneet. I think Kalpesh, you also operate, a fund which is in a similar
Yeah.
category, return category. Your take on that. Why do you think it's a good, solution or a replacement to fixed income?
Yeah, so there are a couple of reasons why we could see good attraction in the long short fund. So in fact, in India, majority of the long short fund do operate as an absolute return fund. There are few who do something like over and above alpha, but overall majority of us are something which targets 12 to 15% on an annualized basis. So now when you see fixed income returns in India, they have been now around close to 5 to 5.25% post tax. So this is something which we refer, because now if you see earlier there was 3 years of taxation indexation benefit over there, but now there is no indexation benefit, and we could see lot of shift at least from the HNI front, if not from the corporate, from HNI front, which are taxed at now 40%, are looking at as an alternative to debt. And even if you see when it comes to long short fund, when you see the composition of a long short fund, 85 to 90%, or if not 90 but 85% of the money actually is parked into debt instruments, and what risk we take is from that 15% which we have. That risk could be in the derivatives front, that could be in the equity front, but this is how long short funds are something which are more or less operating. And why it has been attractive is, one is the tax advantage, or not the tax advantage, but the tax free returns to the investor are as are 7.5 compared to what we get in the debt fund, which is 5.2 to 5.5. Even arbitrage fund now post tax is giving you close to 5.25 or 5.5% return. So one is obviously this one type of tax post tax return is slightly higher. Second is, there are a lot of people who don't want to play a larger equity game at current levels, and even in the last couple of years we have been seeing markets going up and up and up. We are seeing now some bit of cautiousness across HNI as well as treasury. So that type of investment are also now chasing. So if you go and listen to large long only mutual fund and as well as PMS guys, they have been articulating returns of close to 10 to 11% on a 3 to 5 year perspective. So if that is getting at 11 to 12 or 10 to 11% in a 5 year perspective, I think that long short fund is something giving you similar returns and with a very minimal risk on the downside. So such type of arguments are something which is helping long short fund to gain good momentum.
No, I think that's very relevant. I'll just add to that part, is that we've seen a lot of interest amongst investors for such conservative absolute return funds, which can offer a better solution compared to, let's say, a fixed income solution by offering an alpha of 300 basis points. Again, something that we also operate in. Similarly, we have funds which operate in the more maybe higher risk category, which can offer again an alpha compared to maybe a large cap fund or an ETF by effectively using derivative strategies, by not only generating alpha but also trying to minimize risk. So these are solutions that we've seen being effectively implemented in the long short space, or in a space where people are using derivatives in Cat 3. I think what I'll do is I'll move to the next point, and we need
I want to add 2 points
yeah,
here.
please.
Yeah.
Please go ahead.
So most of you guys are, also doing the debt plus or similar products to debt by having more of, I will not say market neutral, but something similar to market neutral strategies where you don't end up losing money like equity does. So what we are doing is, what I will also encourage you to consider is that, equity mutual fund market is more than 20 lakh crores. And the AF, I mean, we guys are sitting here, but we know there's hardly any even 1% of the AUM is in long short uh,
1
category.
lakh is what I
Yeah.
could say.
Yeah. So, what I mean to say is that the kind of strategy we have, we are doing a covered call strategy because it is very, very similar to an equity mutual fund. For example, it's an equity mutual fund, but you use derivatives. You have a very diversified portfolio. The only difference is that portfolio is more into the 225 stocks that fall into the future and option segment. And you use derivatives for three reasons. One, you want to hedge the portfolio. You feel that, okay, the market is seeming risky, I will hedge the portfolio. The second is, you and the hedging could be by buying put options or by selling futures of index. The second is you hedge the portfolio by putting it into an arbitrage position. I have the cash stock, but I think some policy is going to come out, or Mr. Modi is going to visit US. Why not, not be out of the market for 2 days? You sell the futures, you create an arbitrage, and you be out of the market for some time. The third and the most powerful tool which we are using is the covered call. So covered call essentially makes us very similar to an equity mutual fund, but every month we are trying to generate some alpha by selling call options on the underlying portfolio. So if you guys consider, or if we have more funds coming wherein you want to sell covered call options, then the fund is more dynamic because then it has the option to create money in all kinds of scenarios. When the market is going up, you create money. When the market is going slow, you create more money. When the market is stagnant, you have the best outperformance because you might deliver 10 to 15% returns on a stagnant market in equity, and which is a great number. And the point you also mentioned earlier was why this has an edge is the example you gave about the kind of journey you have. So, because we have the option, or these funds have the options to use derivatives, the volatility in the portfolios are much lower, and which results in delivering a much higher, sharp ratio or a very higher risk adjusted return. Because, for example, we have 945 mutual funds. So we have not done too well last year, delivering hardly 8 or 9, 10% returns in the last calendar year. But if you see the Sharpe ratio, we will rank number 3 in the country. Only 2 more funds have a higher Sharpe than us. So for those people who are conservative investors, even in the equity domain, if they get the option to put small monies into these kind of covered call funds, or derivative uh, funds which use derivatives to reduce the risk, I think it will be a great option for a common man. But today it is only the rich guy with a minimum net worth, or 1 crore investment that goes into it. If SEBI understands that, or we guys can, make presentations to the industry, and even the small investor demands that, okay, it's a low risk strategy with similar funds to equity mutual funds. Why should I not be allowed to invest in such a fund? So if SEBI opens it for, mutual funds industries to use these kind of strategies, I think it will be more tax friendly, and a smaller investor who does not have a large corpus will also be able to benefit from these strategies, which are, great, where a risk adjusted return is considered. So, my plea is only that, somehow Bhautik, you are also part of other organizations. So I'm sure you can, we need to think and let the
It's a
authorities
very
know.
relevant point. Yes, yes, yes. It's an extremely relevant point. We'll try and take that forward, with using our associations that we are members of. Uh, Having said that, and what I will do is, Puneet, maybe bring you in here, that when investors, let's say when they're investing traditional products, let's say a PMS or a mutual fund, it's very easy for them to kind of understand whether the strategy is effective or not by comparing the performance of that fund with a relative benchmark. And you can very easily compare and understand whether the fund was, did outperform, underperform, how effective was the fund or not. Now, how does one do that for a long short strategy, right? Because let's say some strategies don't even have benchmarks. Even if some strategies have a benchmark, then how do you kind of compare, considering the fact that you're doing a combination of equities and derivatives? And there is this additional complication of fees, which is slightly more differentiated compared to what you see in traditional PMSs or mutual funds, and an additional element of tax.
Right. So you brought up tax right at the end, but I think that is one of the biggest differentiator between what we do versus what a PMS or a mutual fund would do. Obviously, as a Cat 3 AIF, we are taxed at the fund level and therefore no pass-through taxation. Even in the new draft of the Income Tax Act or the Income Tax Bill of 2025, there's status quo, no changes there. I am sure that you guys would have already seen that as well. But addressing the other points, yes, benchmarks is something which is kind of a gray area as of now, but I think there are steps being made to kind of regularize it, or reporting has to be a lot more uniform, which is in the works from whatever that I understood. I don't know how effective that is or how it is being implemented. But having said that, I think all of the funds, they really have a target in mind, or a benchmark, which is at least, if not put down on paper, they at least are aiming to generate a return, certain benchmark returns that they're able to generate. Best is to compare it against what a particular fund's benchmark is. For instance, if my equity fund has a benchmark of Nifty 50, I intend to beat Nifty 50 on a periodic basis. For me, the target is on a month-on-month basis. Other funds will have different objectives. Maybe Vineet's fund is also looking to do something similar on a month-on-month basis, generate an alpha over and above their investment into the portfolio of stocks that they have. A very critical aspect in this one is the amount of exposure being taken in a particular sector or in a particular category of market capitalization. So for a lot of the funds, they talk about uh, investing into small caps and mid caps, but they invest into BSE 500 stocks or NSE 500 stocks. Still, a majority of the exposure lies in the large cap stocks. So those are differences in the benchmark, which is something that the investor needs to be aware of. Unfortunately, I'm not the authority on this one. I can speak about my funds. We are very clear about the benchmarks that we use. We are Nifty 50 and the interest rates which are prevalent in the market right now, represented by T-bills or FD rates. So as long as a particular fund is beating its own benchmark on a month-on-month basis, over a period of time, for sure, it is going to compound and deliver a phenomenal return. So that's something that the investors should clearly be looking at. Speak to the fund manager, get a clarity on what the benchmarks is. That's probably the first step that I would recommend anybody evaluating similar products. Anything that if I missed out, let me know.
No, I think what you said just makes a lot of sense, that people might have a perception that it's difficult to compare or judge the performance of some of these long short funds. But I think all long short funds do offer a benchmark. It could be a relative benchmark, it could be an absolute benchmark, but there is a benchmark which I believe is available with most of us, and which means that for investors to judge the performance, I think it's as easy as that they would be able to do with a traditional product. So, I think it's more about a perception rather than an actual framework out there. I think, considering time out here, I'm going to pose the last question to everyone out here, which is looking forward, right? And we've seen a bunch of products in the market today. So we've seen conservative long short funds, we've seen aggressive ones, we've seen some in the middle. We've seen funds which are being managed, using discretionary fund managers. We've seen funds being managed using a quant strategy. We've seen funds using multi-strat. So there are funds which only deploy equities. There are funds which use a combination of multiple asset classes. So we've seen a bunch of different products out there in the market already so far in the market. I think what I want to ask you all is, going forward, maybe in the next 3 years, 5 years, where do you think this industry is going? Do you think, there'll be more people who will be gravitating towards these long short funds? Do you think there'll be more innovations which will happen in long short funds? Where do you see this going? Maybe Vineet, you want to start and then we can go around.
I'm already smiling at the question, So when equity is doing well, like 3 out of 5 years, it does very well. So nobody needs to look at an alternate thing. You simply put money in mutual funds and, ride. But when the difficult period starts, for example, now this calendar year has been pretty challenging, and we've seen Nifty correcting, and now possibly a big sell-off might start from. I mean, you cannot predict the market, but the way technical charts are showing, we may have a bigger sell-off coming. So people will need those options where at least the fund manager has the flexibility to generate some returns. Because mutual funds, you see all the fund managers, all they talk about is equity mutual fund managers is outperformance care. What do you mean by outperformance? I mean, you're willing to say कि हम 10 निफ्टी 10 गिरेगी हम 8 गिरेंगे 12 गिरेंगे. What do you mean? You're still talking about negative returns. So based on the small survey we had been doing with our investors, 80% of the investing community says we need performance, we need returns. But all the people evaluating these funds, the distribution channel, what do they want? They say कि हमें तो भैया आउट परफॉर्मेंस चाहिए. अब आउट परफॉर्मेंस में आप -10 गिरे हो -20 गिरे हो does not sound very interesting. So I think with the more volatility and the global risk we have, with USA doing a lot of things differently and global demand slowing down, it is going to be a golden era when these alternate products are going to be, considered by even those people who think it as risky. I would just want to add that using derivatives in the wrong way increases the risk, but using derivatives to hedge the portfolio actually reduces the risk. So these long short strategies and derivatives, where derivatives are used to reduce the risk in the portfolio, can actually deliver a much better risk adjusted returns or sharp. So going ahead, because the market is expected to be more volatile, I think in the next 1 to 5 years, the industry has a great chance of doing well. Again, I would want to reiterate that a smaller investor today cannot be part of this pie, and something must be done that even smaller investors can adopt these long short strategies.
Okay, sure.
Yeah. So I think one data point which I would just want to say is it's very difficult to earn your first 1 crore of your life. So even in and then it's very easy to make it a fourfold, fivefold. Even in AIF, what we have done in last whatever 10 years is an AUM of close to now 1 lakh crore, which it took 10 years to build 1 lakh crore of AUM in CAT 3 AIF. My sense in the next 3 to 5 years, it should be a ten lakh plus crore journey for us. And what we are now sensing is like if you see, it's a scenario where interest rates are going down, so there are a lot of less alternatives for HNIs, for treasury clients to go and buy into fixed income products. So this is something which will help us in gaining a good momentum. However, there is always a tax advantage as compared to an AIF versus a mutual fund. But I think in everywhere in world, the advantage of tax will not remain forever, and there could be some sanity at some time. But overall, my sense is, even if you do a post-tax returns, also long short funds are giving you a much smarter return as compared to a normal fixed income product like corporate bonds or as well as an arbitrage fund. And I think with this call writing scenario which Vineet has mentioned, I think this has been a true if you see, I come from a HNI background, so I know people have been itching to sell calls across their portfolio. I think the one which got restricted because SEBI has came with a 50% rule of cash in their while doing a call writing or any of the derivatives position. But as a fund, we are not or required. We can just park in our GSEC and do that. So I think if you give the money to the fund, call writing can be done in a much better way as compared to you doing it on your own because of the margining issues. And overall, my sense is with this volatility, and I think this volatility will till should remain in markets for the next 18 to 24 months, given that a lot of political changes have happened. And overall, historically, whenever Trump is there, there will be volatility in the market. So I think more or less it's a good scenario for AIF to the next 3 to 5 years.
Okay, so I'll just quickly add a couple of points to Kalpesh. Very well said. I think a lot of volatility expected, probably some adversity as well, but adversity is what leads to innovation. I think there's a lot of scope of innovation in the field that we are in. There is definitely a bit of a overhang from the from SEBI and a couple of other places. But given that, I think I would expect a lot of newer kind of funds to come out and bring out more strategies into the overall play in order to hedge the portfolios, generate additional returns, or generate absolute returns. So yeah, I'd be keenly looking at the space as well, because I think there is still a lot of scope for development of this particular field. If regulations improve, if we are able to do more with what we already have, then I think that is one more impetus that we would definitely have in the industry for innovation to kickstart.
Thanks, Puneet. Thank you, everyone. I'm just going to leave everyone with one final thing from my end. And considering we're a cricket-loving country, in investing is just not about how many runs you score, which is nothing but the returns, but it's also very important how safely and consistently you score them, which means what kind of risk are you taking to generate those returns or score those numbers. So please do focus on that as well, which is what all of my colleagues spoke about. So thank you so much for having us here.
Thank you very much. A big thank you to our eminent panelists. I thank you so much, and our moderator also, for the insightful discussion on leveraging long-short strategies to achieve superior risk-adjusted returns. Your expertise has provided our audience with a comprehensive understanding of how such strategies can be utilized to navigate market complexities and create sustainable wealth. Now we will move on to our next topic, which is as exciting. Where are we headed in 2025 and beyond? This session will explore key market trends, investment opportunities, and strategies that will shape the next phase of economic and market growth, but after a 2 to 3 minutes break. So come back, but stay with us. Don't go away anywhere. Explore all the zones around, but come back to the auditorium in 2 to 3 minutes.
Thank you.
Thank you, everybody.
As we approach 2025, investors are navigating a challenging yet dynamic economic landscape. The Nifty has recently corrected nearly 10% from its September 2024 highs, reflecting heightened market volatility and cautious investor sentiment. This pullback raises questions about whether this is a short-term correction or the start of a broader trend. In addition, with Trump's re-election, the recession in the West, the war scenario, and multiple other things, the global and domestic macroeconomic environment continues to evolve with geopolitical shifts, technological disruptions, and structural reforms shaping market movements. For sophisticated and high net worth individuals and institutions, understanding these trends and positioning their portfolios for growth opportunities while managing risks is more important now than ever. This panel brings together three of India's most respected industry veterans, each with extensive experience in navigating market cycles, identifying turning points, and driving successful investment outcomes. Their insights will provide a forward-looking perspective on where the Indian markets and economy are headed in 2025 and beyond, helping investors decode the next big opportunities. Ladies and gentlemen, our panelists are Mr. Sunil Singhania, founder of Abacus Asset Management. Mr. Singhania is a pioneer in the Indian asset management industry with a career spanning decades. As the founder of Abacus Asset Management, he has established a formidable platform for India-focused investments, and prior to this, he held leadership roles at Reliance Mutual Fund, where he managed one of India's most successful equity funds. A global thought leader, he was the first Indian to serve on the global board of the CFA Institute and has made significant contributions to advancing professional standards in investment management. His ability to identify trends and deliver exceptional returns has cemented his reputation as one of the country's top fund managers. We also have with us Mr. Ramdeo Agrawal, Chairman and co-founder Motilal Oswal Financial Services Limited. An awardee of Rashtriya Samman Patra by the Central Board of Direct Taxes, Mr. Ramdeo Agrawal is the chairman of Motilal Oswal Financial Services Limited and the driving force behind the company's approach to investing. Mr. Agrawal has created the QGLP, Quality Growth Longevity and Favorable Price Investment Process, and its buy right, sit tight investing philosophy. Mr. Agrawal is also the driving force behind the MOFSL Group's highly awarded research. He has been authoring the annual Motilal Oswal Wealth Creation Study since its inception in 1996. An associate of Institute of Chartered Accountants of India and a member of the National Committee on Capital Markets of the Confederation of Indian Industry, he has also been featured on Wizards of Dalal Street on CNBC TV 18. And our final panelist is Mr. Vikas Khemani, founder and fund manager, Carnelian Asset Management and Advisors Private Limited. And with Carnelian Asset Management and Advisors Private Limited, ladies and gentlemen, he is a stalwart in India's capital markets. Mr. Vikas brings 23 years of experience, including his tenure as CEO of Edelweiss Securities Limited, where he built industry-leading businesses in institutional equities and research. As the founder of Carnelian Asset Management, he leverages his vast network, deep market insights, and strong relationships with corporate India to identify and capitalize on high-growth opportunities. He's an active member of the industry bodies such as CII and FICCI. He's also a recipient of the ICAI's Young Professional Achievers Award. Mr. Vikas Khemani's strategic mindset and understanding of macro trends make him a highly sought-after thought leader in the investment community. And this absolutely power-packed session will be moderated by Mr. Kamal Manocha, who is the founder and CEO of PMS AIF World, where he leads both wealth management and content initiatives with a strong focus on research-driven investing. It is under his visionary leadership the firm has introduced several innovative investment frameworks, the last being the quality, risk, and consistency model, designed to provide deeper insights into portfolio management services. PMS AIF World serves 600 plus high net worth clients, managing assets worth rupees 1,700 crore plus, reflecting its strong commitment to delivering quality investment services. With 20 years of experience in the financial industry, Mr. Kamal Manocha has consistently driven strategic growth and thought leadership in the investment space. He holds a master's degree in management and an honors in economics, along with multiple prestigious investment certifications. Mr. Kamal Manocha, the stage is all yours to guide this esteemed panel in an engaging discussion on what lies ahead for investors in 2025 and beyond. Take it away, sir.
Thanks, Aishwarya. Thank you for such an, I would say, elaborate start to this session. And I'm really honored to be moderating this panel every year. We do this crystal gazing summit, and the objective is very sincere. We want to handhold our clients by providing them clarity, conviction, and confidence. And times like present where markets are going through correction, reinforcing the confidence of our clients and investor ecosystem is very important. And that is where I really thank Ramdev ji and Sunil ji and Vikas for joining for this particular panel. We want to understand, way ahead. So first question to you, Sunil. We are decoding the next bull run. We have kept the topic optimistic, and by nature we are optimistic. In India we are seeing reforms, and we have seen articles written in the past by eminent Ramdev ji that Sensex is heading to 2 lakh. But this is a time to kind of maybe verify and kind of understand, and yes, kind of deep code. So are we really in a bull run, or is this a beginning of something which is like bothering you as well?
Thanks a lot for having me, Kamal, and Aishwarya, thanks a lot for making me feel so good by this elaborate introduction. But you're right. I think we have been in the midst of a challenging time period. And in fact, the challenging time period has been going on for the last 9 months. But obviously, because of various reasons, optimism from all of us, flows, and so on and so forth, I think the broader markets were sort of sustaining itself. It's only in the last 45 days that we have seen a real correction, particularly in the broader markets. Having said that, it's not the first time we have seen this kind of correction. I think over the last so many years and decades, corrections have kept on coming. I think the only difference this time is that normally, corrections in the markets will have time correction and price correction, and both. When there is a time correction, obviously, the pain is not as much. When there is price correction, which happened during COVID, but the time horizon is not very long. You suddenly have a sharp dip and then you bounce back. I think this time it has been both a time as well as price correction. And at least my view is that this time correction might continue for some time. And the reasons are as follows. Normally what happens is when you have 9-10 months of market correction, in those 9-10 months, companies have normally built in another 10-15% of additional profit growth. And therefore, you have a 10-15% price correction and then 10-12% profit growth. And therefore, the correction technically becomes 25-30%. This time, there has been a price correction, but unfortunately, profit growth, particularly in the September quarter, was very poor. And in December quarter has been just marginally better. And therefore, with the same time correction and the same price correction, we are still the valuation. And to that extent, even now, when you look at the broader markets, I think stocks, I would not say all the stocks, but quite a few stocks are still trading at a premium to their long-term averages. And therefore, being always an optimistic, and I do believe that India will grow from 4 trillion to 7-8 trillion to maybe further. And, investors will make a lot of wealth over the long term. I think we still believe that this is going to be more a W-shaped recovery rather than a V-shaped recovery, where you will have some, pullback on the upside, maybe some correction, and then again, slowly it will inch up. All we need, obviously, is earnings growth. And now we'll have to wait for the March quarter for that elusive earnings growth to come. And I think if that comes, then maybe the time correction also will get, fulfilled.
Sure, Sunil. Ramdevji, how do you assess and see the current year 2025? We have seen last 8 years, equity markets in India have consistently given positive returns. How do you decode 2025 and the current correction, and the way it is going on? What are your views, given your last 30 years of illustrious experience?
Yeah, this time, so what Sunil said is right. But this time the difference is that it is happening with sustained inflow. At least till January it is there, maybe in February also. So in the past, the retail participation was not taken for granted. But the flow of about 45-50,000 crores per month, it may come down to maybe 35-40,000. So that only time will tell how much flow continues. But things are correcting while flow is on. So the sellers who are the sellers? The sellers are FIs to some extent. Your promoters, promoters are selling and IPOs are coming. Private equity, everybody is selling. So the selling is now coming. About a year back, only FIs were selling a little bit, but the primary market was not that active. But last 1 year has been bumper primary market. So now supply has caught up with the demand. So it is no more that because there is a flow, enhanced market will remain up. And particularly in the mid and small, at any price is the right price and it was going up. So that phase is over now because there is enough supply from the promoters themselves. I mean, in those stocks, promoters themselves are willing to sell. QIP is happening, IPO is happening. So there is an IPO machine is so big that they are saying that, okay, if these three companies are trading in mid cap range at say 35p, I am willing to offer at 25p. So they are also bringing out the table continuously. So there is a supply and demand has matched now, and probably maybe supply is a little more than demand right now. And that's why market is corrected, which is, I would say it is healthy so far. It has not become unhealthy. I mean, if you look at the large cap, a large cap damage is not that much. The damage is actually in the mid and small, where money made was also too much. I mean, if you see the last 12 months performance, some of the stocks were crazy. I mean, so clearly there is a correction in those stocks where it was excessively pushed up. So I would think this is a very healthy correction and markets are, I mean, even at 21, 22 times, I think market is giving a good valuation to us. Now, in my mind, the only point is uh, how will this correction stop? What are the forces which will kind of create some kind of bottom, because it can't go to zero or something like that. I mean, like from 23,000 is 23,000 bottom, is 22,000 bottom, and I don't think it is about the absolute number. It is about what are the forces, what will change of these 4 5 things. Either supply is going to change, or earnings are going to come up, or demand is going to increase. So all these things will happen at lower prices. Maybe promoters will stop selling. Maybe IPOs will stop. Even FIs at some point of time they'll say we'll want to buy. Instead of at 21p, they're not coming in, but 1920p they can. So all the 4 factors, which is supply side, can become demand side, and in any case, the domestic investors are buying. So something will change, but right now it looks that supply is more than demand, and hence correction is happening very in a methodical fashion. And at times it is giving jitters. Like today, I was getting some calls from some people they are concerned. And the problem is that out of 190 million demat account, 140, 150 million are less than 4 5 years. They have come post COVID. They have not seen corrections. So for them, it is a lot more unsettling. So that is also a factor. There may not be. There is quite possible that the whole lot may become a little more concerned. So let's see. I mean, it's I would say, a little concerning time for the investors at large. For me, I have seen a lot of markets. Sunil has seen a lot of public markets. So I think it's a good panel to discuss how things may shape up. See, nobody knows. Actually, nobody knows how things will shape up. But one can visualize, looking at the variables, at what level promoters will stop, at what level IPOs will not happen. Because we are seeing bankers are bidding say 20,000 crores. At 10,000 crores also now IPOs are not happening. So now trouble is shaping up even in IPO market. So at what level IPO machine will stop, that also one has to see. So I think it's a very dynamic situation. It will be, but markets are expanding. See, size of the market is expanding. More IPOs happening, more QIP is happening, promoters holding is coming down, FI holding is coming down. There's a lot of activity in the market. So that's positive. But right now, I think we are in corrective phase.
Sure, Ramdevji. Because you have always been a proponent of, Bharat Amrit Kal, and we are obviously all believers of the same. And within that, you have had a very successful run up in the shift, discovery, whereby Indian economy did see and demonstrated a structural shift towards manufacturing. But after the recent, deglobalization, I would say fear around the world, from Trump coming in, and he kind of expected to announce a lot of tariffs, whereby if tariffs announced on China, then China could dump manufacturing products to India, and it could impact Indian manufacturing. So that would derail the entire, I would say, Bharat Amrit Kal scenario. So how do you see this entire present time, in this context?
Thank you, Kamal, for inviting me on this August panel. So I think, in every market, every economy, we have seen this for a very long time, last 20 years, 30 years. I think many corrections have come, many such periods comes. I mean, from immediate memory, this time reminds me of, in some sense, Jan Feb of 22, when Ukraine war had started. We were, market recovered. 21 was a great year. A lot of money was made, and then, Ukraine war started, and suddenly global fears, inflation fears, and, and market corrected from almost 18,000 Nifty of to 15,000. And around that 6 months period, everybody, who was turning bullish in 21 kind of started questioning and India story and, what can happen and all. So whenever markets correct, very natural thing is to start questioning long-term India story. But we all know from experience that India story is not a short-term story. So and people who invested in the time of that, vintage of Jan to June 22, today also after correction also are sitting on a very, very large handsome gain, right? So it is in the times of uncertainty where you need to hold on to your nerve and you need to have conviction that India story is a very long term story. I mean, in last 20 years, if I were to go, Nifty has moved from 800 points to 23,000 points, and in this period, all kinds of, uncertainties have come. Governments have changed. Global financial crisis happened. Many scams happened. Fragile 5 happened. ILFS crisis happened. GST, demonetization, Ukraine war, pandemic, everything happened, right? But the fact of the matter is the underlying strength of the economy today, underlying strength of our whole nation and the economy is so robust. We have grown from $250 billion to almost close to $4 trillion. This number in Amritkal will go to $30 trillion. It will happen in this period, like we have had many past corrections and consolidation, both at economic as well as market levels, will continue to happen in times to come. Investors have to understand that every time something like this happens, we don't question India's story. Today, if you see, risk is far more talked about the potential. Last year, nobody wanted to talk about risk. Everybody, like Ramdevji was saying that, fancy valuations, everybody wanted to, go IPO. And, so markets will have these kind of phases and will continue to have these phases. My conviction is that there are not many structural weaknesses in our economy. Our corporates are not leveraged. Government is not leveraged. Our fiscal is in control. Current account deficit is in control. Our banking system is solid. Our inflation is under control. Our, forex reserves are under control. So, there are no structural fault lines in the economy which typically drive deep corrections in the market. So those deep corrections are out, in my opinion, not a possibility. 5, 10, 15% correction are par for the course, normal in any market. And today, like Ramdevji was saying, market has given a very good reality check. The excesses which got built in last 6, 8, 9 months have got corrected. Promoters who were looking to raise capital at any fancy valuation have been given a reality check. I think, and I think this is very good news. And I mean, as a manager, I think this is a great time to receive money to kind of invest, because like 22 vintage delivered great returns. I have zero doubt in my mind that this vintage of first half of 25, if we were to do a call 2 years later, we will talk about this and say this vintage was a great vintage to kind of have invested, because many mid and small cap stocks have corrected 40%, 50%. Many IPO companies have corrected 40%, 50% from their prices. Same great companies, but valuations are great, right? So I would say that I am not at all worried from a long-term perspective. Medium term, anybody's guess. I think, like I completely agree with Sunil that it might not be a quick recovery. It might require some bit of a time consolidation. But again, these are the times where, rather than getting scared, to redouble your conviction is the more important thing.
Right, because we are absolutely, I would say, confident, and at the same time, it is our responsibility to help investors make, well-informed decisions, and that is the context. And we want to be realistic in our expectations, and that is where, we all understand that yes, 2025 may not be, same like the past years that we have seen, and it is a time to take a pause and kind of understand where we are headed. So moving on to you, Sunil, I have been kind of moderating almost all top fund managers, and I have seen another fund manager, very well known name, Mr. Samir Arora, who always says that in long term, Nifty 50 and Nifty 500 returns are always alike. It's like 10-year period. Ultimately, you invest in large caps or you invest in a basket of mid and small caps. you ultimately end up getting similar returns like long-term averages of 14-15%. Why to get into mid and small cap kind of a fund, and ultimately have so much pain? Because 80% companies eventually end up giving bad returns, and the average at a fund level ultimately is same. But you are a fund manager who is mid and small cap focused fund manager, and that is where I understand that at stock levels returns are good. But from the point of view of investors, when they invest money in portfolios which are like 5,000 crore plus assets and are invested in mid and small cap oriented companies for long term wealth creation, how do you give them a perspective when we see such times and one is reminded of such wisdom that yes, ultimately long term returns are same? Why to get into mid and small caps?
So a few things. One is we do invest across market caps. Obviously, I think the interest and we're known for, I would say, broader market investment because, the whole focus from our side is in-house research and trying to find companies which are not normally widely tracked. Having said that, I think, at the index level, Nifty 50 and BSE 500 are not the true indicators because there is almost a 95-96% correlation between them. I'll just take the example of two funds which were very popular in my earlier avatar at Reliance, Reliance Growth Fund and Reliance Vision Fund. They were very, very well known. Both started at the same time. The NAV of Reliance Growth Fund has grown to 4,000 from 10 in like 31 years. The NAV of Vision Fund is 1,300 in the same time frame. Now, Vision was focused on large cap and growth was focused on mid and small cap. So I don't think it is right to say that the returns have converged. I think the indices taken are very different. The other thing is when you are doing broader market investment, it is not the index. You are looking at companies which can grow faster. And as I said, where, the coverage is not that much and therefore there is some, you can say, differentiation you can add. See, ultimately market price is equal to EPS into P. EPS earning P is perception. When you invest in a broader market company, normally the perception is much lower than an established company. And the EPS growth is faster. And when you have both EPS as well as P growing, you end up making slightly higher returns. Now, India is a country of entrepreneurship. India is also a country of various sectors, upcoming sectors, new sectors. All the so-called large caps at some point of time were startup businesses, including the recent, the Dixons of the world and so many other companies, or Varun Beverages, who started very small and have now become large caps. So I would say that as long as you are entering into a company from a view of obviously some time frame, 3-4 years, faster growing and at the same time trading at discount to the larger bets, I think there is differential return to be made. So we always say this, large caps are like elephant. It is very difficult to topple them, but they will have their own pace of growth. And mid and small cap would be obviously like maybe tigers or some other fast moving animals where there will be more volatility, but when they move, they will move fast. So I think in Indian context, it makes sense to not ignore the broader markets. From an investor perspective, I think investors have to take their call in terms of asset allocation. If you are okay with a longer time frame and willing to bear the volatility, then obviously I think the broader markets will do very well. But if you want stability, you have to have large cap. And if you want both, then maybe a diversified approach or a proper asset allocation is what is needed. But I would disagree that returns converge. If they have not converged last 15-20 years, and at least for the next 5-10 years, barring this short-term, phenomena which we are seeing right now, it will happen. Hey, Kamal, what happens, we are swayed by recency bias. If recently something has worked, we believe that it will work forever. If recently something has not worked, we will believe that it will not work forever. So last year, we were very aggressively telling our investors that please avoid mid and small cap fund of ours and invest more in a flexi approach. But because of the recency bias, they were not willing to listen. And now I'm very sure even if you tell them that please invest in mid and small cap, because of the recency bias, investors will prefer the large cap. So I think we are all human beings, and these are characteristics which we cannot get away with. But I think in India, I would disagree, and I would say that there is merit in expecting higher returns in the broader markets.
Sure, Sunil, well put. Moving on to Ramdevji, I have been reading off late your articles, and I have been getting this feeling that you have this conviction that the next bull run will be giving a lot of significance to some of the bruised large cap companies. You have mentioned that in a couple of articles. I read that, and I'm talking about stocks like Asian Paints, which we used to call as compounders at some point of time. Obviously, we have forgotten them because they have not participated in the last rally. What are your views? We are wanting to kind of see way ahead and decoding the next bull run from here onwards. And what are your views in this regards?
Yeah, so there was a study, last valuation study about the blue chips. And clearly, these kind of markets, they throw some of them, I mean, as the correction deepens, you'll find some of the overvaluation in the blue chips, particularly not such a big ones, but next Nifty, next 50, and between 50 to 150 kind of a ranking companies. So there will be, I'm sure, some companies will get bruised, and the corrections will be quite deep, and particularly the growth companies, the corrections will be even deeper because they also move high beta stocks, so they move big time. I mean, 10% market moves up and they move by 30-40%. So on 10% decline, they'll also fall by quite significantly. So clearly, this will give opportunity to the people who understand the value of the companies. One of the things which I think is going to happen is that the risk capital flow in the economy has increased significantly, and it's permanent feature in the sense that the participation of retail, which was not there earlier in about 2020, you had only 40 million total demat accounts. That is duplicate, or if 50% was duplicate, in that case, you had only 20 million demat accounts. I mean, it looks unbelievable that you had only 20 million demat accounts which were operating. Today, you are talking about 190 million. I don't know how much was the duplication. Even if 50% is duplication, you are talking about 20 million going to almost 100 million. So there is an expansion of the market, and that expansion continues. Last month also, there is 3 million, 2.8, 2.9 million accounts of demat accounts have opened. So clearly, market is expanding and the risk capital flow is increasing. Now, at what this risk capital flow into the new corporates, new entrepreneurship, getting confident about getting money and getting good amount of money. So instead of putting a 5-acre plot, they might go for 50-acre, kind of expansion. So that how this will shape up the corporate world, it will have an impact on the corporate world and corporate earnings as we go forward. Maybe not this year, after a year or so. So that is what really, I mean, now one phase is over. In my mind, post-COVID recovery and whatever happened with the earnings doubled from 450, 500 to 1,000 rupees for the Nifty. So that happened, and we gave the valuations, and whatever happened, one round is done. Now the second round, after this correction, wherever it stops, then the recovery, we have to focus on the recovery. What will do well? And there, I think the corporates which are beneficiary of the capital raise now, and those who have a bright, what do you call, business prospects, and wherever earnings build up, So, so that's where the focus will be, in the sense that next round focus will be there. And some of the, what you said about the bruised blue chips or busted growth stocks, the second category is busted growth stocks. So what happens is in the high growth companies, suddenly the IPO happens at 100 rupees, the stock go down to, they go up to 200, 300, and then come down to, half the price and those kind of things. So I think the same framework, again, some large caps will give opportunity to buy in. So actually, I mean, for a person like me, it is an opportunity to watch some of the good companies getting bruised, and can we buy them? We couldn't buy in the past. Can we buy them now? Whether it is a growth company or whether it is whatever you like, or it is a value company, whether it is a growth large cap, say banks are like clearly slaughtered, or they have not made money for last 4-5 years. And in this kind of a downturn, because without banks, you are not going to go anywhere. So clearly, some of the banks will become very attractive to buy. Their valuations are reasonable. They're well-running banks. Their asset books are very clean. So this downturn should be used as an opportunity to pick stocks rather than kind of getting depressed or anything like that. This is a part of the life. It will bottom. When it will happen, I don't know, and why. What will force it, that I also don't know. But this can throw some amazing opportunity to look at the values.
Sure, Ramdevji. Moving on to you, Vikas. As I mentioned in the earlier, question, you have been kind of very intuitive in identifying some of the themes, and your last identification, which is structural shift towards manufacturing, has been phenomenal. After recent budget, I had read, you were mentioning that the consumption sector rally that has happened may not sustain because it's like budget, though seems to be optimistic of consumption, but the earnings will not come soon. And exactly the same happened. Whatever stocks went up during budget day, ultimately the subsequent week, they were all down. What are your kind of views in this regards? As Ramdevji mentioned, that these are interesting times and a lot of new themes will definitely emerge. What are the next, I would say, drivers, the next themes which you are looking ahead of time in terms of identifying and then kind of adding in your portfolio?
I think, Kamal, first of all, I will say right now, in the recent correction, market is ignoring two or three very interesting policy pivots which has happened. Right? If you see today, I mean, last 6 months, we had a huge shortage of liquidity in the country. RBI was tightening and they were support defending rupee, and which kind of created an unintended consequence in terms of slowing of the credit growth, tightening of the liquidity, hardening of the rates. Today, I think, governor has kind of, RBI has released liquidity, given an indication of cutting in the interest rate, right? Which markets are completely ignored. I mean, that's what at least you want when economy is kind of slowing down. Same thing, I think, in the budget. The reduction of the tax rate was a great thing in my opinion. It has, of course, left a lot of money in the hands of the citizens. Now, how they will use it, definitely. I mean, I'm sure that it will not entirely go into consumption, and there can be many debate where it will go. But the point is that at least that much money is there, and it will definitely help, reviving many sort of slow growth, right? So, and also, if you ask me, this time, a lot of measures were taken in the budget, which was towards ease of doing business, opening up long pending demands, which were not much talked about. I mean, it's a long discussion, but I'm saying is that a lot of interesting things are happening right now from policy perspective. But today, and they are all macro, they will have impact 3 to 6 months down the line. So, in my opinion, market is ignoring that all lot of good developments which is happening in the recent correction. And I think this is the time to kind of, capitalize on some of these things. There are medium term themes and long term themes. Long term themes, whether it is manufacturing or consumption, or infrastructure, don't change. I think manufacturing, according to me, continues to remain over next 10, 15 years a very big theme, as we've been saying for last 4 years. Whether it is, and within manufacturing, then you can talk about things like CDMO, things like auto components, things like EMS, things like defense, which are again long legs, and then you have to identify your risk reward focused companies specifically. So themes are there. But I think from this year's perspective, I feel last year, banking didn't do well. I think again currently continue to remain weak. But this year, my view is that banking will surprise everyone. Banking will be one of the big winner as this liquidity eases, credit growth picks up. The credit growth which was there in 16-17% range went to 11% with the liquidity tightening. I think second half of this calendar, probably we will start seeing the pick up on the credit growth, and system liquidity will become easy. Interestingly, by the way, last 1 week, a lot of debt flow has come into the country, foreign debt flow. Foreign money has come into the debt. That again tells you that a lot of positive moves are there. Foreign investors are not worried about as a country risk, right? So a lot of these things are there. Now, if I see the structural drivers are player and policy pivots which are happening, they're all positive news. So I think banking will do well, IT will do well. Again, there's no doubt in my mind that there's a reasonably good demand opening up in US and all on the IT side, and we will beneficiary of that. Pharma is doing well, manufacturing doing well. So some of these things continues to, but this year I feel banking will be one of the bigger winner.
Sure, Vikas. Sunilji, do you agree with Vikas' opinion on banking doing well, IT doing well, and manufacturing being a long-term trend, at these levels from here onwards?
So, I'll just like to just point something. So one is, a lot of times sectors do well, but stock prices don't react, and vice versa. So, for example, 2024 was the best year for banking in terms of asset quality and even profit growth, but the stocks did not do anything. And IT had the worst growth in profit, since Lehman time in 2008. But stocks did very, very well. So I think it's all about what your view on the future is. But having said that, I would completely agree on the banking side for few reasons. One is obviously, at least our view is that globally, we are hitting the peak as far as inflation and interest rate is concerned. Now, the joker in the pack is what happens to the tariffs if and when they are imposed, because tariffs will lead to all the expectations on inflation having to be reworked. But taking that out, I think it is very clear that globally now we are looking at interest rates coming off. I would completely agree with Vikas that liquidity scenario is now improving. Little bit, the central bank is also realizing that if they squeeze too much, then there is an impact on growth, which we are already seeing, whether it's the IIP numbers, whether it's the GDP numbers, corporate profit numbers, and so on and so forth. Third is, I think this is the only sector which is trading at a significant discount to its long-term average. And on a PE basis, even large banks still are trading at like sub 15 PE multiple. Smaller banks are trading even lower. So I would agree with that. In fact, if you see Europe, which is supposed to be the worst region in terms of growth, I think the markets are all-time high. And if you see the drivers there, it's predominantly the financials. And I would say that the reason might be, we are not experts, that the view is that interest rates are slowly going to inch down. Manufacturing will always be a good thing. Unfortunately, the valuations are discounting the sky. They were discounting the sky 3 months back. I think now they have just come maybe slightly lower, but they're still significantly at a premium to their intrinsic value. Now, for them to perform from here, profit growth has to be very strong. And unfortunately, September was bad. December also, that sector has disappointed massively. And in themes like defense and railways, we are a little careful because there is only one buyer, which is Government of India. And we saw what happened when the budget for defense was disappointing. All stocks fell 10-20%, and it's a very, very low, I would say, long gestation kind of thing. So while being very positive on manufacturing, we would wait for either valuations to become more thinner or growth to start surprising on the upside. Pharma continues to be a good sector for us, positive. But again, there, I don't know what will happen when the announcements of tariffs on pharma comes. I don't think they will be able to implement it. But markets right now is behaving more on news flow than actual understanding, because I don't think the US can afford not to import generics, because their own costs will go up and there will be massive shortage. So I think it is going to be a very interesting next few months. But a clear, I would say, positive is the banking, or the outlook is banking. I don't know whether it will come right or not, but others will have to take it as it comes.
Sure. Thank you, Sunilji. I think it has been really insightful in conversing with all of you. We are like finishing with our time. I will just say, my quick, conclusion to all clients and investors that, everybody here is perennially an equity investor. All of us have our own asset allocation, but, I can tell you that investing in equities is always going to create maximum wealth. And times like these are times to take pause and definitely make, knowledge your friend. Something which is done with understanding converts risk into an opportunity, and that is exactly what we intend to do. And we at PMS AIF World have made knowledge as our weapon, and we don't just say that, we implement that. And that is the power, and that is the kind of, I would say, foundation that we have created. And that is where, year on year we have been doing such phenomenal summits. It's like absolutely, I would say, happening because of such fund managers who also support us in this regards, because it is important to handhold our clients and investors, especially in the journey. Thank you once again, for joining, and thank you everyone for your time. Over to you, Aishwarya.
Thank you very much, sir. And thank you to our distinguished panelists, Mr. Singhania, Mr. Agrawal, and I thank you, Mr. Khimani, for sharing such invaluable insights during today's session on where are we headed in 2025 and beyond. Your expertise and foresight have been truly enlightening, offering our audience a very deep understanding of the evolving investment landscape. And as industry veterans, your perspectives on market trends, sectoral shifts, and strategic insights for the future have greatly enriched our knowledge. We deeply, deeply appreciate your time, dedication, and thought leadership in making this session such a success. Now, ladies and gentlemen, let's take a brief break. When we return, we will dive into the next session, strategically capitalizing on early to mid-stage private equity opportunities in India to unlock unmatched wealth creation. We'll be soon back with you. Take this break and come back. Welcome back, everyone. India's unlisted equity space is undergoing rapid growth, fueled by the expansion of innovative startups, robust private enterprises, and a supportive policy ecosystem. This sector is increasingly becoming a game changer for sophisticated investors who understand the importance of diversification and are willing to take calculated risks. Private equity investments, particularly in early to mid-stage opportunities, have proven to generate multi-bagger returns, creating unmatched wealth creation potential for long-term investors. In recent years, the surge of venture capital-backed enterprises and private equity deals has underscored the tremendous opportunity in this space. As India continues to cement its position as a global economic powerhouse, the unlisted market is poised to play a critical role in shaping its growth trajectory. For investors, this represents a unique chance to strategically capitalize on disruptive innovations, untapped market segments, and high growth industries. This panel brings together three of India's leading private equity veterans who have successfully navigated the complexities of investing in unlisted companies. Their expertise spans early stage technology firms, growth private equity, and strategic partnerships to help portfolio companies really scale. And they will share insights into how sophisticated strategies and disciplined approaches in this space can unlock extraordinary value, build wealth, and redefine investment portfolios. And our eminent panelists are Mr. Naveen Honaguri, Managing Partner, Elevate Venture Partners. Mr. Naveen Honaguri is the Managing Partner of Elevate Venture Partners with over 15 years of experience in investing in early and growth stage technology firms. He co-founded KE Capital and later founded Elevate to address the challenges in participating in subsequent fundraising rounds for successful portfolio companies. Elevate is backed by KB Investment, part of Korea's KB Holdings, and aims to expand its portfolio across Southeast Asia. Mr. Naveen has been instrumental in building investment strategies in the technology and venture capital space. We have with us Mr. Ashish Ahluwalia, Director Private Equity Alternates by Axis AMC, and Mr. Ashish Ahluwalia, the Director for Private Equity at Axis AMC. There, he focuses on strengthening the firm's private equity and venture capital capabilities. With over 20 years of experience, Mr. Ashish previously held senior roles at CDC, now British International Investment, and AIF Capital, where he specialized in growth private equity and late-stage venture investments. He has extensive experience in portfolio management, strategic growth, and fundraising, and holds an MBA from the Indian School of Business and a chartered accountant qualification. We also have with us Mr. Amit Ratanpal, founder and managing director, Blink Investment Management Private Limited. Mr. Amit Ratanpal has over 25 years of experience in private equity, capital markets, asset management, and investment banking. He founded Blink Investment Management in 2014 and has been investing in education and financial services sectors for the last 10 years. He has deployed over rupees 400 crore across 25 plus companies, achieving multiple successful exits, and he has held key leadership roles at ICICI and Birla Sun Life, where he led private equity businesses and treasury solutions. He's a chartered accountant, holds an executive MBA from Narsi Monji Institute of Management Studies, and has completed a general management program at Harvard Business School. And this session is going to be moderated by Ms. Lavanya Ashok, who is a partner at Trifecta Capital and leads the firm's growth equity investing business. In the past 3 years, the firm has set up its first 1,560 crore growth equity fund and made investments in a dozen category leading tech companies. Ms. Lavanya has 19 years of investing experience, investing as well as investment banking experience, and she has previously been Managing Director, Goldman Sachs, Principal Investing, deploying capital from GS's balance sheet and $8 billion global private equity fund in India. Ms. Lavanya earned a bachelor's in economics and finance summa cum laude from the Wharton School at the University of Pennsylvania in 2004, and then where she was among the top 1% of students in her graduating class, and an MBA in 2010 from Stanford University. It is such a pleasure to have you here. Over to you, Ms. Lavanya.
Thank you so much, Aishwarya. So excited to be moderating this eminent panel. And I think it's topical because India continues to witness rapid growth in VC and PE. The public markets have been on a really strong bull run over the last few years, the few months recent notwithstanding. And we continue to believe that the private asset classes, as they look to be worthy of permanent sources of capital, will continue to benefit from that. 2024 has really been a pivotal year, right? About 11 billion was raised by private investment funds in India, and about 60 billion invested across almost 1,600 deals. So really robust investment activity. Growth investments, however, have seen a little bit of a decline. So early stage was very robust. Big private equity was robust. But growth stage, we saw actually deal sizes come down a bit, though deal volume actually went up. The exit landscape continues to be very robust. So we saw 28 billion across 263 exits. So I'm sure there are various LPs who are finally happy. I remember when I was at Goldman, India used to be accused of being a black hole. A lot of money goes in, not as much comes out. But 28 billion of exits in 2024 is actually a really strong milestone year. And really, if you look forward to 2025, some of the sectors I've seen excitement across the ecosystem for include, there's always consumer internet in different forms. There continues to be a large number of enterprise deals, maybe a little bit more focused on AI now. And there continues to be, everlasting interest in BFSI, right? These are really some of the sectors where we're seeing a lot of investing activity. So the first question I wanted to throw to all three of you, and maybe we can start with you, Amit, is if you can each describe your firm's strategy and where in that risk return spectrum you play, how you think about your entry point and your exit points, and really what your life cycle in the investment landscape looks like. That I think would be lovely context setting for everybody who's listening.
Thank you, Lavanya, for a wonderful introduction of the VC and the private equity world, and specifically about the exit, because the biggest question which all the investors have always been asking is, am I going to get money back? And I think that puts in a quick example that yes, we all do make money as well for ourselves as well as for the investors. So Blink is a VC fund, and as Aishwarya mentioned, we only invest in two sectors, that is education and financial services. And where we differentiate ourselves with others is that we have a very mindset of business building. And that's why we call ourselves as a co-founder approach, or we are a third co-founder if there are two co-founders. And the reason is that we work very, very closely with all the portfolio companies, and mainly because of a deep expertise that we have in each of the sectors, that is education and financial services. And even from a cultural perspective, we believe that probably the better way to make returns for us and even the investors is with a very hands-on approach. So our sweet spot is to invest between $2 to $4 million per portfolio company. And every fund which we launch, we always make 5 to 6 investments, a very, very handful of investment, concentrated portfolio. And the objective out here is that can we help the founders with our network, with our understanding of the businesses in the last decade or so to scale the business? And that's what I would say we've been doing it. Arguably, what we say to all our investors, to put it differently, is that we are a VC firm, but our investment style is like a private equity style. And we invest mainly in companies which will have between 50 lakhs to a crore of revenue per month. Ideally, about 10 to 20 crores of revenue per month is where we would invest. And the kind of companies where we are investing, I think the biggest question is that there is a proof of concept, there's a product ready. What is the growth strategy of this company? Can this company, which is doing a 10 crores of revenue or 15 crores of revenue, can it become 100 crore of revenue so that Lavanya, I can come to you and then you can write a big check of 50, 100 crores, whatever your check size is. And that's the objective which we operate on. And most of the time we invest in the companies at a sub 150 crore valuation because the risk reward is there. Right. In our assumption, and that's what my track record also shows, that if you look at Fund 1, where we made again 4 investments, all of our investment did very well. In fact, that has returned 5x multiple return and a more than 40% IRR as well.
Wow.
Right. And similarly, what we are doing in a current fund also. So here, the approach out here is that probably none of our company will be written off because they're making revenue and there are in the growth part. But at the same time, we've seen as our track record that in 18 months to 24 months, we want all our companies to become profitable. And the reason is specifically in the education sector, which is a sector where the opportunity is very large, but the patience also plays a very, very important role. And hence, we want to ensure that we make profitable businesses always. It's about, can we create businesses rather than merely making investment?
That's amazing. And Amit, I think you've shown through your returns that, very, very contrary to the spray and pray strategy that some adopt in the early stage, because you sometimes need that large portfolio to make sure that you give yourself enough shots at goal. You've actually proven that with a very targeted, concentrated portfolio, you can generate, huge alpha. So very, very impressive.
Thank you.
Ashish, maybe we come to you and request you to talk about, you've worn many hats, but, in your current role, where you sit and the risk reward you are most excited about.
Yeah, no, thanks, Lavanya, and thanks to the PMS AIF team for organizing this every year. It's always a good discussion. For us, the alternates business and private equity was set up as an extension to our main business, and that's the mutual fund. We are amongst the top five money managers in the country and very very heavily focused on equity. And even in equity, Axis is known for its growth style and it's known to pick high quality businesses and become long term stable shareholders. The private equity franchise was set up as an extension of that, right? So it's the same attributes but transferred to private businesses. And that's basis the need of the investors to now sophisticated investors want to catch these newer businesses early. So we're right at the opposite end of the spectrum that Amit is at. We're late, mid to late stage. We will typically get into companies with a 4 to 5 year horizon and not longer. Companies that have existed for some time, have shown good growth in some way, have become leaders in their segments or their subsegments, and hopefully, which are capital markets ready in 4 to 5 years. If not, then for other forms of exit. Um, so across funds, to give you an idea, we've been investors in companies like a BKG Snacks or a Fab India or an SBI General Insurance or a Lenskart, Swiggy, Gopal Snacks, a couple of large financial services NBFCs. And the idea is to get into high growth businesses, as I said, which are capital markets ready. We're also very, very focused on return of capital. I think, being managers of public money, we've realized, and you sort of preempted that and said India has been a bit of a black hole, and we saw that investor fatigue when we went out. So I think apart from just paper returns, the focus is very clear, which is on DPI and return on capital, right? So our first fund, which is a 2019 fund, we fully returned capital with a 21% IRR, which is what one expects in sort of late to mid stage growth. And the focus is quite clear, which is stay true to our promise to return. Obviously, safety of capital extremely important, growth important, but also converting paper returns to actual cash. Sectors that we focused on, high growth sectors, so consumer, financial services, technology, manufacturing, and healthcare. And 15, 20 years of data shows that these are the sectors where private markets, the highest amount of value has been created. So that's where we go.
Lovely. And maybe Naveen, we now come to you, the man in the middle. So Elevate is a nicely data-driven investment firm targeted at growth stage, right? And little bit seems to have grown out of when you were an early stage investor, the desire to keep backing your winners as they grew and became sort of large and showed even higher return and compounding promise from that point on. So would love to know, can you give us a flavor of the activity you're seeing and a little bit of, where you are on the risk reward spectrum, because we've seen two bookends.
Perfect. Thank you so much, Lavanya. And thanks, the PMS AIF team for having me over. So we focus on investing largely in early growth, the way we'd like to put it. Our sweet spot for investment is companies with 20 to 70 million of revenue and about 100 to 300, $350 million in terms of valuation. The reason we call ourselves data driven is we follow a fairly rigorous checklist and a quantitative checklist of what we want to see while investing into the companies, right? So broadly within the 100 to 350, India has about 125 unicorns. Companies between 400 to $1 billion are close to 300. Companies between 100 to $400 million, where we usually play in, are at about 600, 650. And the intent is to, invest into companies which meet our checklist. And it's a fairly simple one. Companies number one, number two in their category, profitable, growing at an X percentage rate, and so on and so forth, right? So that's broadly where we look in. I think if fund thesis changes as per vintage, in my opinion, we'd of course love to back profitable companies which are available only today. It wasn't available a couple of years. Yeah, no more. If I had my checklist in 21, I wouldn't have been able to find a single company, right? So from that perspective, the current vintage is sort of helping us from not only deal flow sourcing access, but also investing into companies at a reasonable valuation, right? So While I'd love to say that very similar to what Amit had said, that we're looking at VC growth sort of companies. So ideal growth rate for us investing into companies would be 40-50% year on year over the next 3 to 4 years. And at the same time, from a risk perspective, given these companies are profitable, a capital raise for them is to explore adjacencies, right? Either building a war chest for inorganic acquisition, or for expanding into a few other countries apart from India, or getting a better institutional player before they head to an IPO pricing their own. So those have been sort of use cases which fit perfectly well from a risk perspective. So that's the segment that we fall in from an investment thesis perspective.
Makes a lot of sense. And clearly, there is a big gap in growth stage and there will continue to be, right? And just looking ahead, 3.2 billion was raised by India Focused Growth Funds, Naveen, in 2024. So there is dry powder. And Ashish, just wanted to come to you, right? Why should investors look at the alternative space more broadly? I mean, you sit inside a firm which has a deep heritage of doing wonderfully in the public markets. Yet, you made the point earlier in this conversation that some sophisticated investors are starting to say, we want to allocate money to the private asset class as well, be it, a little more illiquid, longer term, but still, exciting to see the potential to generate returns in this asset class. So would love to know, what you're seeing, what kind of investors are getting attracted to this asset class, in the seat in which you sit.
Yes, good question, Lavanya. And actually, most of this has been better articulated by our investors than it can be by us. So, when we've gone out and spoken to investors, I think good, sophisticated, smart investors are clear about a few things, right? One, they're seeing new industries being formed, and they're seeing traditional businesses being disrupted by new businesses. And they're seeing that these new businesses which are coming up are creating tremendous value for their investors, right? If you really look at the list of companies, which have gone IPO over the last 10 years, some very large businesses have come out, which have been, and which have come out of the private equity and venture capital universe, right? So these new companies are creating a lot of value. Smart investors have understood that, look, they want a share of this value. That's one reason. The second is, in a lot of these industries, a lot of the value is already discovered by the time they're coming to the market. It's not that, value does not continue to multiply. But again, smarter investors will say that, look, a lot of the value is getting discovered by the time they're coming to listing. So how can I go, as most of our investors put it, how can I find an entry point at stage N-1? And that's what smart and sophisticated investors need to do. That's the second. The third often is a function of allocation, right? Unlike public markets where, there are 500 companies and you can create a portfolio sitting at a desk. Private companies are different, right? Typically, if you see, today when these companies are coming to market, and I'm seeing a good company, right? A typical small cap would be raising 500, 600 crores of money in the IPO. You've seen these IPOs for good companies getting oversubscribed 50, 60, 70 times, right? Now, what happens? An investor who's trying to get an allocation in this through a listed mutual fund, a small cap or a micro cap mutual fund, that mutual fund typically ends up getting 10 to 15 crores of allocation in that company. So people are saying, look, I want this future champion. I want the future Swiggies and the Lenskarts and the SK Finance, etc. But I want to go in through a vehicle where I get a meaningful allocation, which means, again, as I said, you start going in at stage N-1. So I think smarter investors have understood, and obviously, and we'll probably come to this point later, risk reward, etc., and what kind of people should get into this, and what portion of your capital. But I think people who are at a certain net worth, institutions, family offices, etc., have understood that, look, there is disproportionate value being created by new businesses, and they need to enter the private markets. And that's what, sophisticated financial markets across the world have shown us, right? Whether it was the US, Europe, and later China, which is you need to then start, allocating a bit of your money to private markets to get this disproportionate share of new value. So I think, those are sort of summary reasons of Yeah.
Yeah, Ashish, that's fascinating. I mean, I resonate with a lot of that because one of the reasons we also set up a growth stage fund under the House of Trifecta was because we felt a lot of our investors were seeking exposure to the new economy. And, when we launched this fund, there were maybe 5 listed companies from the new economy. Now there's over 100 billion in market cap, even with the recent correction, right? So there's been a lot of distance travel, to your point, and I think investors have seen true value creation and also the public market showing discernment, right? They've not painted all new economy companies with the same brush. They've looked for robust business models, path to profitability, proven margin expansion, and accordingly, given their verdict. And when the public markets speak, I think there are data points that private investors then have as they make their decisions on asset allocation. So makes a lot of sense. Amit, just wanted to come to you. The segments you're looking at are truly like two of the many building blocks of the economy. And, if we are to attract the 600 billion of private capital in this early growth stage that is needed in the coming years to build out, the businesses that will address our big challenges. Would love to know, what you are seeing and what you think will really sort of help on the financial services and education side, where you were really spending a bunch of your time.
See, if you really look at from a private equity or a venture capital landscape perspective, almost between 25 to 35% of the overall private equity allocation goes to financial services. And education, specifically, if you would have seen in the year 21, 20, a lot of allocation went as well. At the same time, both these two are very, very fundamental sector, from an economy perspective. And we've seen that. Let's start with the education sector first, with about almost 150, 175 million, children going to the schools. The GER, which is the gross enrollment ratio of less than about 30%, while the developed market is more than 65%. Or we see the number of students who go overseas is almost touching 1 million.
Yeah.
The overall opportunity in the education sector is extremely large. And even the government in the current budget also mentioned the importance of early childhood education. They mentioned the importance of skill development as well. And every point of time, we have seen that today, while government allocates X amount of money for the public sector in the education, but a larger amount has been still spent by the private sector.
Yes.
And most of the parents ensures that, like today, we've got about 1.2, 1.4 million schools. At the same time, almost more than 60% of the student goes to private school as compared to government school because of the overall opportunity and the quality of education which is there.
Yeah.
So education sector is going to be a fundamental sector, and and India is, as we know, has been still driven by a knowledge economy. We all are product of education, as we know. I think the key learning in the education sector is being what we have really learned is that we have to be patient.
Yeah.
It is a long term.
Yeah.
Third, it's all about outcome.
Yeah.
Right? Today, what really people look at, whether it is K through 12, whether it is skill development, or even for that matter, college and universities, what they want is that if I go through a particular course, am I going to get the job or not? If I do good in K through 12, am I going to get into the right colleges or not? I think that is what is very, very important. And that is one. The second, what we've seen specifically in the year 2021 and 22, a lot of funding which we went, I think it was more of a FOMO where a lot of money went into it. In fact, we'll be launching our next version of education report. And one of the key finding is that almost, I would say 80% of the funding went into only 2 or 3 sectors, that is K through 12. Not even within K through 12, it's basically tutoring services within the K through 12, where most of the money went, whether it is Baiju and Academy on this.
Yeah.
So as such, the investment has been very, very under in lot of the core sectors, whether it is early childhood education, skill development, or a lot of this sector. And that's where we believe that there is a very, very large opportunities. If you look at a classic example, Imarticus Learning, where we had made an investment in 2015, it took them almost now a decade. But that company is going for an IPO and it's just raised $4 to $5 million and has been extremely profitable company. Right? Now, these are the businesses which one can create with a lot of focus, patience, and ensuring that there are outcomes. So we believe that in fact, we believe this is a very good time to make investments in the education sector because of the fundamental opportunity which is lies it. And even government is alluding to opening up this sector, with the global universities and campus coming into India, making it for profit, allowing them to repatriate as well.
Yeah.
So a lot of development is happening. Financial services always being the backbone of the economy, and more, I think we are seeing a robustness in terms of the DPI, that is the digital public goods, which the government has been creating. Whether we talk about UPI, or lately which the government has created the entire unified lending
Yes.
interface, which allows more and more people to get funding. I think with India's, and we just pick up a MSME space per se. MSME space, if you take an example, is about more than 63 million MSME, and the overall penetration is just about 15%. Or the credit card opportunity which you look about, we have just about 4 to 5 crores people who have got credit cards in a such a large population. Or even we talk about the mutual fund, or even the depository services, the DP account holder is not more than 12% penetration. The overall, the opportunity is very, very large. And we believe the entire wealth management, which is just created right now,
Yeah.
how many asset management companies are there, which we can talk about, is now managing more than $100 billion. It's hardly very few or none, actually speaking. And that is something which we have seen in the US. Now, India becoming a $10 trillion economy and then moving to a $20 trillion economy, I think we believe that a lot of asset managers and the wealth management creation is going to happen, which we have seen very, very similar thing happening in the US, where we would see more than hundreds of corporates managing trillions of dollars as well. So we believe that both this sector, that is education and financial services, are very, very fundamental sector, and going forward, good businesses are going to get built in both these sectors.
Makes a lot of sense. And Amit, I want to pick up on a thread that you alluded to, with a lot of money having gone into, in some sense, early supplementary education, like the Byju's, for example, which started out mission driven, but we've seen governance lapses that have caused huge value destruction. And Naveen, maybe we start with you, right? There is, as we know, a huge governance premium associated with well-run companies with high-quality promoters, even when they come, for an exit. What are some of the lessons learned from, some of the more public, situations on the governance side that you've seen, and what are some of the red flags you look for as you go through, and you clearly have like a quantitative approach and, a bunch of other attributes you look for. Would be lovely if you can throw light on some of the red flags you look for and the checks you do when you go about making an investment.
Yeah, so let me cover the red flags first, and then the governance. I think there are a few things that we typically look at. So one is avoid investing into party rounds, like we usually call it. And data has shown both in India and in the US that party round, the outcome of investments in the party rounds, which usually happens via FOMO driven investing, hasn't resulted in a great return. Doesn't mean that these are not good companies. These are extremely good companies. But just that you don't end up making the IRR that you would have wanted to, because you're entering in at a significantly higher valuations, right? Look, I'm of the strong believer that a founder should at every point of time take money off the table. It's very important sometimes for founders to taste their own success. I think a few found, but there has to be a limit to it. 1 to 2% of their shareholding at every rounds over the next, like every 2.5 years, I think is important. Anything over and beyond that, becomes sort of a red flag for us from a perspective. From a governance perspective, it's really important to build your board extremely strongly, given the industry that you are in, right? So if you're in the financial services industry, an employee who's been with a regulator for a long period of time, has just moved out, is extremely helpful. If you're in a retail industry, getting a relevant board of advisor becomes very helpful. Somehow strengthening your board in general has seen adds premium to the business. And the second aspect is also trying and meeting your projections as close to possible, not only
Yes.
public company, even in a private company. I have seen companies who have promised, let's say, $100 in revenue, who have achieved 105, getting significantly higher valued, because that forms a basis for the next round of investments. Because you would know this very well, Lavanya, whenever a company comes to us, straight away we slash 20 to 40% but some of the way founder has managed his projections over a period of time, of course at an early stage it's little difficult, but once the company is about seventh or eighth year in existence, I think by then there should be a reasonable merit towards arriving at the right set of projections. So these are a few things that we normally look at from a red flags and governance perspective.
Amazing. Some really great, points I'm sure all of us have noted from that. Ashish, would love to come to you. Obviously, you as a fund house have deep experience with what it takes to be a listed company, the level of governance that's expected. SEBI has also become sort of very circumspect about, how new economy companies are capitalized, how they report as they think about coming to the public markets. Would love to know, how you think about governance and some of the red flags and the no-nos that you have as filters as you think about your private investing.
Yeah, I think governance by far for us is the single largest deterministic factor, and it goes beyond financials for us when choosing who to work with. I think the way we put it inside is look, who we work with matters more than the final outcome of the investment. And we've understood that through experiences in the private market, in the public markets over many years. And unlike financial outcomes where you're sort of projecting business plans, etc., when you're investing in companies, some markets may go right or wrong, some products may go right or wrong, and they can have a percentage point difference on the outcome. A governance outcome is typically a binary outcome, right? So it's extremely difficult to come out of. Now the question then arises, what do you do? I think, look, there are certain things which every good private investment house will do, right? Which is a thorough diligence, financial diligence, a thorough legal diligence, a thorough reference check, etc. I think those are non-negotiable. And I think we've reached a stage as an industry where most good funds will be doing that. I think the idea is also then to go beyond, which is rounding up. I mean, what we typically end up doing with every company is speaking to tons and tons of stakeholders around the companies, current employees, past employees, current board members, past board members. How has the company treated its customers? How has it treated its suppliers? Because often this is where you pick up red flags around governance, and we have sometimes discovered, just through how the company is treating its suppliers, there have been red flags around governance which have led to a decision of not to sort of work with a company or a certain class of founders. So I think over and above the regular checks which are non-negotiable, doing all of this work, and ours is a long term. Unlike our other business on the listed side, you have the option of cutting positions. Ours is a long only business, so the cost of these errors is extremely high, and thus the time and resources that one ends up spending on double checking governance.
Absolutely. And Amit, since you come in early, right, you have a lot of ability to shape governance as you come in. Obviously, you have trust with the founder. That's why you've joined hands. You have a very concentrated portfolio, very good track record. So you've picked the founders very well, clearly. But would be lovely to hear what you put in place when you come in. And has that evolved into a playbook, or is it very different based on, the specific needs of each investee company?
Thanks, Lavanya, for asking this question. In fact, that is something which I was thinking as those were replying. See, the culture, when we talk about governance and everything, the culture starts right from the early days. Right? It's the mindset of it. And it's at the VC time, we as a VC firm have to create that culture, because if the culture is not about governance, then as the company become bigger, larger, it becomes impossible to change the culture and the mindset. So
Yeah.
from our perspective, I think we what we try to do is a very, very basic but a very important and a simple checklist. And it starts with saying that, hey, ensure that you report to us all. We have created a checklist, which is your regulatory compliances,
Yeah.
your employees, the policies, right? Are you paying your fees on time? Are you following policies on time? These are the basics, or the board meetings, which is there. Because many times what happens in the startup company, the question is, oh, this is just a startup. Why we should create a proper board meeting? We have so much work to done, because in this case is about the tons of work which they have to do. But what we have ensured that over a period of time, the basic hygiene factors, which is the discipline, is always been maintained. Different types of policies, such as whistle policies, the sexual harassment policy, the POSH policy, all are the different types of policies which we always have put in place. And every point of time, we have ensured that there is always an employee first mindset as well. Like,
Yes.
for example, we have ensured that each and every company has a training of around all these policies, about gifting policies, about what should they do and what should they do. And that is something which we started, like, I think all this is important. And when the founder takes it very seriously, I think that's the key. It's not about only putting the policies and all these things in place, but ensuring the founder reports to us on a monthly basis. Because once he knows that he needs to report to us as a part of a monthly MIS packet, that's the time he takes it very, very seriously. In fact, what we've gone even a step forward, we have embedded something which we call it in a very simple term, the SDG or the ESG policies, that what is the how you're ensuring that everything you're doing is through social diversification or diversifying inclusion and governance as well. Now, some of these things is something which we have already inculcated as a part of a process. So, as simple things, many times we see on a board, we have two founders who are fortunate for female, and if I'm on the board, then the other founder has to be someone who's a woman. Now, that's something we try to build it right from day one itself.
Makes so much sense, because one of the things you can bring in addition to your capital and your expertise is just what you would look like at scale, right? And like you said, it's very difficult to change DNA when you're a very large business. But when you're young and you're just becoming, then that is the time really to put in place some of these pillars that then strengthen the foundation. I know we're running out of time, so I want parting thoughts from everybody on, where we are in the current macro, right? I know we are a very long-term business. We have to be invested through cycles to truly make money. But we're also at different points in time operating in a certain macro context. And I was joking with someone recently that I feel like I'm competing with the public markets for both, the supply of capital and the demand side for deals, because companies are listing earlier because the public markets are available. Previously, they may have come for a large growth private round. Now they're saying, let's take smaller rounds, as evidenced in the falling deal size on the growth to late stage side, and saying, let's go public. And a lot of people who wanted to allocate to privates for different reasons, right? Depending on where in the world you're sitting, and all of you have different pools of capital. I know, Naveen, you have some capital from Korea and other parts of Asia. I'm sure Ashish and Amit have, diversified pools of capital from across India and, some other geographies. For different reasons, India at different points in time is either very attractive, or global investors can be a bit skittish. So just want to, get your parting thoughts on why we should be super excited long term based on what you're seeing on the private investment opportunity. And maybe, we can go Ashish, Amit, and end with Naveen.
Yeah, no, happy to go first. As you said, we're at a good time because, over the last 3 years, we've seen good incidence of capital going back to investors as well, foreign investors and also domestic investors. So that's been the good part. The second, I think, the participation from domestic investors in this space has increased. The awareness has increased, which is positive. And I think, knowledge begets knowledge in this case. And that's just a positive trend for the industry. So that's a good thing. Uh, I think the challenges, we saw funding winter in tech, etc., and we invest in a lot of traditional sectors as well, right? And in fact, 2-3 years ago, we said we'll do less of tech because we just saw too much supply of capital and very hefty valuations, and we did more financial services, manufacturing, and consumer. Uh, so I think having that flexibility and choosing a vehicle, as each individual is sort of designing their journey into the private markets, but choosing and matching that with your risk appetite is quite important. I think the last thing, I mean, you can't have this discussion without discussing valuations. And because we're late in growth stage and straddle everything from private markets all the way to pre-IPOs, it's a good time, particularly because the what's happening to valuations on the public markets, we're seeing that trickle down, and it's high time some of that sensibility started trickling down. We're seeing that. And again, private markets, don't have valuation cycles which completely mimic public markets, but we're seeing that come in, and we're seeing greater pricing sort of sensibility come in. And I think the next 6 to 12 months that will be a great time where you can look at some very good assets because there's sensibility. I think the gates and that bar to going for IPO is just getting higher, and you're seeing that with some so I think that sensibility will tickle in, which is good for our industry. So that I think it's that's why it's a good time to be here.
Lovely.
Yeah.
Amit?
Yeah. See, if you really look at India being a 4-5 trillion and moving to $10 trillion market, this can only happen when they see a lot of private participation. And the startup world, whether we talk about early stage, late stage, and that's what we've seen also. Like Zomato got created because it was a startup at some point of time, right? And there are so many businesses which got created. So it is definitely that the entire ecosystem of the private world is going to create multiple such businesses. Today we've got 128 or 125 unicorns. I think in the next 10 years or so, we'll see this figure moving to maybe 700, maybe even 1,000. And that's the only way we will see the economy growing, because that's the base of the economy which will ensure that the $1 trillion is created. But at the same time, if I look at from a pure investor perspective, we have to think about this. It's about building businesses. It takes years and years of building businesses. Haldiram, which we are talking about and been hearing, it took more than 60 years. Now, suddenly we can't say that you invest in a company today in the next 4 years is going to build business. It takes a really long time. So from anyone who is investing in the private equity funds or a VC fund, I think the game is about patience. Think from a long-term perspective. Think about business building. Think about what is fundamental in nature. And that is what I think will be very, very critical as we move forward.
Absolutely. And I think also picking what is right for your fund strategy as an underlying investment, right? If a story takes, multi-decades to play out, it's unrealistic, which is your perspective. Say in 4 years, you will see that kind of value accretion. Like it doesn't happen in that artificial manner. There is a natural growth cadence for certain companies and industries, and one has to be very cognizant of that when planning your investing cycle. Naveen, your final take?
Yeah, I think not very different than what Ashish and Amit said. And yes, you're in an economy which is growing at 6.5-7% compounding, right? On a base of and being the fifth largest GDP country in the world. I don't think the top 30-35 countries, any of them would be compounding at this rate. While valuations have been a little stretched, India PE is the third largest in the world after New Zealand and US at about 21. We still think there is a reason for that, right? Because of the kind of governance structure that we have, the kind of government which is running the business, and truly as an India Inc. So from that perspective, enough legs, and there is a reason why they say the next decade, is going to be the golden decade. Traditionally and globally, private markets have always outperformed public markets over a period of 30-35 years, and India should be no different. Indian companies, when we looked at the data recently, have always been valued at 20-25% cheaper as compared to the public comp. This is because of the eventual 7-8% delta that fund managers like us need to provide to our investor, for lack of liquidity, and that's something that we're seeing playing out in the current vintage. So yeah, clearly a great opportunity right now for investing in the alternate segment.
Amazing. With those concluding remarks, gives me even more confidence that we will top the 60 billion that was invested in 2024 this year. Really excited to have moderated this wonderful discussion between three industry stalwarts, and grateful to the PMS AIF team for inviting all of us to participate.
Thank you very much. Thank you very much to our moderator and our eminent panelists. Ladies and gentlemen, we'll now dive into a topic that is generating significant curiosity and interest amongst investors. Are private credit investments a superior alternative to traditional debt and hybrid mutual funds? But before we start this discussion around this interesting topic, let me take a quick break while we align the speakers from the back end. Stay with us, don't go away.
Thank you.
Welcome back, everyone. Traditional debt markets are constrained, prioritizing risk minimization over returns. Private credit changes the game, unlocking higher yields, bridging the credit gap, and offering structured, secured lending beyond conventional investments. Unlike traditional fixed income options, private credit delivers 500 to 600 BPS higher returns, addressing the underfunded mid-market segment where banks hesitate. It provides predictable cash flows insulated from daily market volatility, ensuring low correlation to public markets. Hybrid mutual funds mix equity and debt but remain exposed to market fluctuations. Private credit, however, offers a fixed income alternative with structured downside protection and diversified lending strategies. As we explore this asset class, the question isn't whether private credit works, it does. The real question is how can investors best position themselves to benefit from this structural shift in lending? Let's dive in. Our eminent panelists are Mr. Rohit Rathi, the principal real estate business at ICICI Prudential AMC and comes armed with over 2 decades of experience in pan-India real estate investments. Prior to this, he led the mortgages business at IPAMC and served as zonal head for corporate realty finance at ICICI Bank, managing real estate assets worth over $1.2 billion. A chartered accountant, Mr. Rohit also holds a postgraduate degree in commerce from Jodhpur University. We have with us Mr. Nachiket Nayak, the head structured credit at Alternates by Axis AMC. Mr. Nachiket is a seasoned professional with over 2 decades of experience in corporate lending, structured finance, and debt capital markets. Leading the structured credit division at Axis AMC, he is responsible for fundraising and investment strategies for private credit funds, having been a founding member of both Arca FinCap and IREP Credit Capital. Mr. Nachiket has consistently focused on bespoke structured debt transactions, positioning him as a pioneer in the private credit space. We also have with us Mr. Deepen Ruparelia, Head of Products, Vivriti Asset Management. Mr. Deepen is a founding member of Vivriti AMC and heads its product division, where he oversees fund launches in the performing credit space. With 15 plus years of experience spanning debt markets, fundraising, and fund management, Mr. Deepen has built a reputation for launching innovative funds both domestically and offshore, solidifying Vivriti AMC's standing in private credit. A CA and CFA by qualification, his expertise bridges products and performance seamlessly. And, ladies and gentlemen, this session will be moderated by Ms. Lakshmi Iyer, who is the CEO of Investment Advisory Business at Kotak Investment Advisors Limited. She has been with the Kotak Group for over 23 years. Prior to joining Kotak, Ms. Lakshmi worked with Credence Analytics Private Limited as a research analyst, where she was tracking corporate bond markets in India and generating research reports. She holds an MBA degree in finance from Narsi Monji Institute of Management Studies. She has been recognized as one of the top 25 most influential women in asset management in Asia by Asian Investor. What a privilege to have you here today. Over to you, Ms. Iyer.
Thank you so much, and very good evening to all of you. I think Aishwarya has very nicely introduced all the panelists and the topic of our discussion today. So I think I don't want to really get into that job for now, but I think the topic of today's discussion, obviously, we all know what it is. Just to put some numbers in context before I jump to our fellow speakers, if you look at the size itself, in 2024, we are tops of $9 billion, 163 deals. And this is not my data, this is EY data. And this is the India information that I'm sharing with you. While globally, we are seeing mixed patches, I would say. When I say mixed patches, I'm saying US is seeing some upgrade in growth, Euro is seeing downgrade in growth. Indian credit market, what do I say? If I were to give you a Bollywood analogy, it is actually moving in from a gully boy to a Salar status. I don't know if any of you have watched any of these movies. Is basically Gully Boy. There's this very famous song, rap song, which says "Apna time aayega," and from that status to a Salar. Salar is obviously the captain or the leader or the hero. Where there was a very famous dialogue, I don't know who all have seen it, but तेरे लिए शिकार भी बनूंगा, शिकार भी करूंगा. So I think that is what the status the Indian credit markets have, in terms of where we are today, specifically on the alternate side. My first question, therefore, to you, Nachi, is okay. I call him Nachi, but Nachiket
Please.
is what are the key factors driving this trend? Is this a fad or a future?
No, thanks. And I was waiting for the Bollywood analogy. So thanks to start off with that. No, see, the way I look at it, I mean, credit markets in India have historically been bank enabled. Anything which kind of was difficult for the banks to do purely from a regulatory and not from a risk perspective was part adjusted by the bond markets. Historically, bond markets, all said and done, have played the high investment grade space, the AAA, AA. A lot by way of the single A, triple B space was played by the NBFCs. Given last few years how the whole valuations from a capital market perspective have stacked up for NBFCs doing wholesale lending, I think a lot of them by default, including banks, frankly, have moved towards more small ticket lending because that's been flavor of the season, which then leaves a bit of a unaddressed area by way of non-bank end-use requirements not addressed by the bond market. NBFCs don't want to do it. Who does it, right? And that's where patient capital in a close-ended format becomes a logical answer. And I think that's what's driven this whole upsurge in private credit platforms. And you've got all sorts of players trying to address it. You've got the AMCs, you've got the NBFCs setting up these platforms, you've got the asset managers, you've got wealth distribution firms. I think it'll evolve. It's been all of 3-4 years old. Over the next couple of years, it will evolve. And currently, calling it performing space, everything from 12 to 18%. I think you'll get two segments, the 13, 14, which is more classic NBFC like, which AMCs would love to do. And then the 18, 20%, which falls naturally into the lap of asset managers. The LPs also who will fund them will become 13, 14 will be more institution driven, 18, 20 will be more FPI and family office driven. So the space will evolve and settle over the next couple of years, but it's here to stay. Globally, debt is bigger than equity. In India, it's just about warming up. Exciting times ahead.
So it is not like a Coldplay which comes and goes, but it is more like an Arijit Singh, which is more everlasting and evergreen.
Evergreen, absolutely.
Awesome. Rohit, would you have similar views given the fact that you run a very successful real estate practice at your firm? Real estate, if I talk about Indian investors, two asset classes which they have, I call the magnetic pull, chumbak effect, is actually real estate and gold. And in that sense, real estate is actually the shehenshah in probably everyone's personal portfolio, and these days even corporates, because they all want to move into own premises from leased premises. My question to you is that are you seeing investor participation here on the fund side, given the fact that Indians love to own real estate, and is the fund route as exciting for all of these investors?
Yeah, Lakshmi, you have correctly pinpointed it. This is real estate is the largest asset class in the world. It is the oldest asset class in the world. And this asset class is close to everybody's heart. Everybody has a view about it because we stay in a house. So typically you have a view on this asset. The question which you asked, first is residential real estate is very simple and everybody is connected to it. So most of us actually relates to residential real estate. There is another part of real estate which is called as commercial real estate, which is your offices. Okay. So like Nachiket is saying, real estate is seen always as an asset class where you should try to make the higher teen returns rather than lower teen returns. So it would be special situation rather than performing credit in private credit markets. If you see, what has happened is office space where you can get regular rental incomes. There's a regular appreciation in the rental incomes, and you can make returns out of a steady asset, which typically, if you see globally, this is owned by insurance companies. So most of the rent yielding assets are owned by institutions, which are insurance companies and REITs. However, what happened in India is REIT has just evolved 4 or 5 years back, and we have got just three REITs. So investors didn't get full opportunity to invest in this asset class. However, a lot of new age AMCs and some of the fund managers have come up with the product which they call as office rent yielding strategy, which is again similar to your performing credit markets where you try to get between 15 to 18% returns. So this strategy is now available. Lot of we are gung about this strategy since we are at a interest rate cycle where probably we have peaked out on interest rate cycle, and any interest rate reduction positively benefits the commercial real estate, especially office and steady income thing. So currently there are a lot of opportunities through which people can invest in this asset class also. We
So
also
basically, you're trying to say, Rohit, that Rajni in double role, Rajni equal to real estate in double role is
Absolutely.
also something which people are very happy to own, whether it's in physical real estate format or in
unit format.
So ye dil mange more basically.
Absolutely.
Awesome. Dipen, I'll come to you next. My question is slightly different from the earlier two questions. One is, and if I talk about market parlance, there is a main board listing versus SME listing. In movie parlance, there is a theatrical release versus an OTT release. My question to you, why I took this analogy, is to ask you, what is the relevance of these kind of strategies in an investor portfolio? Are these main board or theatrical, or they still remain OTT or SME in investors portfolio?
Yeah, I think a very important and a good question. So, in my sense, I think performing credit is part of core strategy asset allocation, and it's covers. So, in an asset allocation, you have as basically three fundamental major classes. You have debt, you have equity, and you have gold, some extent of commodities, right? Within debt, you have public market debts, which are mutual funds, bank FDs, and then you have access to private markets, which is access and enabled through alternative investment funds and private credit. And then within private credit, there are various risk return strategies per se, right? Now, in my sense, this is the core part of the debt allocation. And over a period of time, investors have realized, and especially sophisticated and accredited investors, that traditional fixed income products actually now, one, the interest rate environment in India is also sort of low. And especially for investors who are sort of falling in a high tax bracket, the traditional debt products actually don't sort of end up covering even the post-tax, post-inflation returns. And today, most of the traditional products actually are offering close to negligible post-tax, post-inflation. And even when we are sort of looking at inflation, the right barometer is not the one which is sort of published by RBI. Yours and my inflation, and most of the people on this call, the inflation rate is in fact very, very high. So it's actually part of a very, very core allocation within debt. And private credit strategies are fundamental because in terms of correlation to the other asset class, which is equity, where those are susceptible to large volatility drawdown. Private credit actually works as a sort of bringing down the overall portfolio risk because their correlation to equity market is actually virtually as close to nil. Which means that in the market environment like we are today, right, we've seen markets declining by 15-20% from peak. However, private credits tend to offer steady, predictable returns. And most of the funds will sort of target 14-15 gross headline, where the investors will still have low to mid-teen sort of returns, right? So I think it's a very, very important allocation if within the debt allocation. And investors over a period of time obviously know where within their risk return framework, whether they are part of the risk is lower, moderate, and aggressive. And I think even within the low and moderate and aggressive, private credit actually deserves an allocation.
In fact, Dipen, you touched upon a very important point that there is that need for diversification, but not as much. But as you were speaking, and Nachi, this question is to you. I was actually, have you seen this movie, Teri Baaton Mein Aisa Uljha Jiya? Have you seen the movie by any chance?
Not really.
Not really? Okay, then you must go and watch, because it is not real. It is actually AI. It is artificial, because the hero is actually romancing Kriti Sanon in that movie, and she is actually a bot or a robo. And why I asked you this, or why I gave you this analogy, is that are we seeing investor preferences also moving? And what's been your experience since you've run successful practices across firms in private credit? Is the trend very vehement that people are moving from traditional strategies to alternate strategies? Because after this movie, I have not seen any more male heroes romancing bots on silver screen. So hence the question to you.
Sure. No, absolutely. And, it really comes from a perspective that investments have predominantly been public equity markets, and alternates, in a manner of speaking, were not really on offer. Today, you've got within alternates, you've got credit, you've got real estate, you've got infra, you've got private equity, you've got venture debt. So bouquet. And to that extent, I think that's where the rigor of asset allocation comes into play. That's where the institutionalization of investing and advisory comes into play. The institutions adapt to it much more quickly. You talk to the insurance companies, and you see that even in their 3% allocation to alternates, they've got various pockets. I think family offices will take some time, given that the urge to chase the highest return asset class kind of at times dilutes discipline. But over a period of time, as, for example, investment professionals start running family offices and it becomes more policy and process driven, you will see a good mix. And like Dipen mentioned, it's playing to different pockets of risk and return, and it's not that every asset class kind of gives you that same mix. So to have that balance and to have an equal distribution which satisfies your risk appetite need, it's here to stay. I think personally, if I look at it, incrementally allocation has clearly been towards alternates as against public markets, given the fact that anyway allocation to public markets for a lot of people historically have been overweight equity, because that was by far the only available asset class. So I think it's good to have options, it's good to have balance, and at the end of the day, it's good to have institutional approach and advice which guides you towards this kind of mix.
No, but absolutely, I'm with you on that. But Rohit, I have a question for you, which is a related question. And this risk reward that we keep toggling. Again, movies, there is an anti-climax, there is a climax. To every hero, there is a villain. In movies like Dar, Shah Rukh Khan acts as the hero and the villain. How do you, this balance part, which Nachi rightly spoke about, how do you maintain this balance, the risk and reward metrics? And more importantly, how do you really protect the investor downside? Are there some guardrails that you look at when you are choosing any of these investing companies?
Yeah, of course. We need to see, as an asset manager, this is our prime job actually, to protect investors' interest, at the same time get the best return for the lowest risk which somebody can take. So that is actually the large parameter which is there. As Nachiket said, see, asset allocation is a key, and see, each asset class has its own risk and rewards. So what an investor has to see is how much risk he can take. Accordingly, the reward will be there. What commercial real estate offers is a regular annuity income, which is similar to your bond yields, which you can say. However, there is appreciation also possible because the rentals keep on escalating. Since we are in a high inflation environment, the rentals also keep on. So if I have to see a yield product strategy in a real estate, in that we at AMC have a triangle based approach. We call it the triangle approach, where there are three large parameters. First is property itself, or office asset which is there. A quality office asset or a grade building or a nicely done building always fetch a premium over the other buildings, and the rentals are much higher. Second, in a yield asset, tenant is a key. Say, tenant is MNC or GCC or some of the tenants with strong balance sheet, typically they tends to in same office for a longer period of time. And in fact, some areas are actually named after the tenant because you have to go next to the Microsoft building. So tenant is a second important pillar. And third is micro market. So how people are colored is typically we see cities. All these seven large cities, if you see in India, there are micro cities in each city. So if let's say Mumbai, I think so there would be at least 8 to 10 micro markets, and each micro market is as large as any of tier 2 city. Each of these micro markets also behave very differently. So some of the micro markets would have outperformed, some of the micro markets would have underperformed. So as an asset manager, we have to choose the best micro market. So if you see these three put together, the center of three would be the best property, best tenant, and the best growing micro market if you take. So your growth, your escalation and rental yield much higher, and so you can expect a better return in that. So we try to maximize on all the three parameters which I said.
Man, this is so important, to the point which Rohit rightly mentioned, because see, we run, for example, at Kota Calls, the country's largest real estate fund. And every time in the investment committee, we have very, very similar conversation because there's always investor mindset, ye dil mange more, shareholder mindset, ye dil mange many, many more. And then finally, when I am the investor fund manager mindset, how do you make sure that more becomes no more? I think you have to ensure that it does not go to that stage, and therefore the return of capital is so very, very important. And I would say it's not just for the RE sector; it's across sectors. Yeah, and Dipen, I want to bring you in. And again, pardon my Bollywood analogies, but if you look at the top ranking actors in 2024, you'll be surprised. You will still see Shah Rukh right at the top, followed by Allu Arjun, of course, and then we have the Khan brothers, which is Amir Khan or Salman Khan, etc. And of course, further down you have the Tollywood guys like Vijay, you have Shahid Kapoor, and these guys. In sector parlance, if I take this, extend this analogy, are there any particular sectors which you see investors are making a beeline for within your funds, or you see your manager's preference or your institution's preference trying to make a beeline towards and saying that main hu na is not really the thing, it is Pushpa Fire Hu Main, which is the Allu Arjun factor, which is more at play right now?
Yeah, I think at Vivriti, for example, we run predominantly sector agnostic funds. So there are some sectors where we are sort of overweight, and there are some sectors which we are sort of underweight, and largely sort of playing through the macroeconomic cycle, right? I think over the last 2 years, for example, and post-COVID, we've seen a lot of infrastructure thrust from government in terms of capex, and the infrastructure thrive in terms of capital allocations being extremely high. So we've seen, for example, a lot of deal flows within infrastructure at our end, in terms of telecom infrastructure, airports, roads, for example. So those sectors, for example, where the risk reward makes sense, and there is a positive government push. For example, we've seen a lot of thrive and push on renewable energies, right? And that's one of the large themes which is sort of playing out not only in India but across the world, right? So we've had deeds in those segments. There are certain sectors, for example, which are going through difficult periods, right? So over the last 7 to 10 years, we've seen massive lending by banks and NBFCs. And Nachiket mentioned that over a period of time, actually the last decade, if you see, the cycle has been extreme growth in retail lending. And if I just quote some numbers, banking lending to personal growth, for example, was almost like 16% CAGR. NBFC's loan growth was almost like 23% CAGR. So a lot of money, for example, have moved to retail lending. sectors like NBFCs and MFIs, for example, especially are going through a difficult period. So there, for example, MFI, for example, especially is an underweight with so it's actually playing along with the cycle. And there are obviously certain sectors which have also historically seen a lot of governance issues, textiles, jewelry, for example, media, those where we sort of remain underweight permanently. Yeah.
So basically, you're saying that there is, एक म्यान में multiple talwars रह सकते हैं. Basically,
Yeah.
every actor has his role to play, and therefore every sector will definitely. And I think even today the credit fund that we run, which is close to a little under $200 million, it's cut across about 8 to 9 investments, and there is no one sector which has a significant weighted. So I'm completely with you on this, Dipen. Rohit, my question to you is, since you also have a successful mutual fund practice, between a hybrid category fund and say a credit RE or any fund, or where the yields are north of 18 to 20% in gross, is the hybrid category somewhere feeling that मैं Cinderella हूँ, मतलब step treatment compared to real estate?
Not exactly. See, both the products, if you see now, they are not comparable. See, mutual fund as a product, it is more for retail investors. So if you see the investors profile would be very different who invest in hybrid. They offers liquidity, they offers transparency in terms of monthly fact sheet, etc. And depending on the fund manager, you can you are actually giving money to fund manager to accordingly allocate the funds into different asset classes. What AIFs are doing, or some of these real estate or any trading funds and private credit funds are doing, is they are putting directly into a specific sector and trying to get returns out of that specific asset class. So I will explain you. Here in the hybrid fund, it is actually you are giving to fund manager, and fund manager is deciding on your behalf. Here, where a lot of professional asset allocators and fund managers are there who are specifically managing a specific asset class, then as a advisor, you can advise him. Say your portfolio should be divided in based on your risk appetite. This much percentage into debt, this much into equity, this much into real estate, this much into commodity, and then for each specific asset class, you have a specific asset manager who is managing. So you are getting the best of specialization in AIFs. Hybrid funds are giving a general advice. I will say it's a general treatment, and these are the specific treatments. Hence, there is always an alpha written between a hybrid fund and AIF. At the same time, there are lock-ins also which are there, which a lot of these retail investors doesn't want, and they need more liquidity at some point of time. However, a lot of HNIs and ultra HNI we've seen, they wants to they are happy with the longer term commitments, and but they won't alpha returns. So it is a balance which is there. So I cannot say, you cannot compare hybrid one with some of these. These are absolutely two different actresses. These cannot be matched. One is South Asia, another is Bollywood types.
Or one to say one is Madhubala, other is Madhuri Dixit. Both are evergreen, but
both are evergreen.
But the fact of the matter is that both have been evergreen in their own era, and one also needs to remember, as an investor, that these category 2 funds that we are discussing, with this real estate or private credit or special situations, they are all like Abhimanyu, which is into the Chakravyu. Abhimanyu died, we know that, but the intent where all the noble souls which are discussing the strategy piece today will ensure that you come up victorious. So I think that is very critical. And on the victory note, actually, my final question to you is, do you think the industry has the necessary astra shastra or the brahmastra to ensure that this trend continues and gets into from a Brahma status, like creator of this entire category, and sustain for the long term?
So talking about private credit specifically, and that applies to alternates in general, given that both industries are relatively new, have a bit of a Valentine sort of thought to that, with the fact that I think it's early days, and in early days, when there is an attractiveness to the asset class, it draws players of all kind of attributes, in a manner of speaking. But as one goes a long time, things don't remain rosy forever. My biggest worry is that till now, we've had no accidents, touch wood, in any of these alternate asset classes, including private credit. Uh, the dreamy situation doesn't last forever. An accident tends to further institutionalize and formalize an industry. It separates men from boys, but in the intervening period, it has an impact on sentiment, especially given the fact that a lot of these funds are still funded by non-institutional players, where sentiment makes a big impact on their investment decisions. My only worry is that it doesn't take them off the table for a period of time, given that that might be the first time they're experiencing things not going as per plan. So to that extent, as an asset class, here to stay. By way of the linearity of growth, well, it's never going to be linear. And I hope the maturity of investors to tolerate or to understand and appreciate that things can't just go one way, and in a larger scheme of things, see the value of the asset class, is what will kind of ensure the longevity of this asset class.
No, I think very, very well summarized. And I can say this, having toggled between the mutual fund industry, helming the investment piece for about 2 decades plus, and now leading the alternates piece at Kotak Alternates, and having successfully launched and run strategies ranging from special sits to real estate to even the performing credit. I can say that roses are red, violets are blue, but the credit mood is going to be evergreen. So it's not about the blues or the violets or the reds right now. And if I were to summarize this very interesting conversation, and I'll try and I'm talking very extempore because I've had a really long day today, is I think the Halla Bol by all the Yodhas in this room has been already done. And the clarion call, I would say, is that while the Brahmastra, as the major astra for this industry, is yet to be unraveled, but the credit investment Maidan is wide open. So if you have the jigra, just come and fall in love, because today is the day of love. So yes, fall in love with this category. Trust me, there will not be a ditching moment. Thank you so much. On that note, I hand over the stage to Aishwarya.
Thank you so much to our speakers for that engaging and insightful session, and a special thank you to you, Miss Lakshmi. I think that was truly, truly wonderful. You always make it so exceptionally engaging. And with that, I guess I have to say private credit investments truly appear to be a promising space, offering both stability and higher returns. It is clear that this asset class is carving out a significant position in today's investment landscape. With that said, we'll take a short 2 to 3 minutes break before we move to our final session of the day. Please rejoin us promptly as we wrap up today with a very exciting topic. Don't go away. Welcome back, everyone, to Crystal Gazing 6.0. It's been a fantastic day of discussions and insights, and we've saved a truly forward-looking session for the last. Our final topic for the day is tomorrow's multi-bagger alternative strategies. As markets evolve and new opportunities emerge, the hunt for the next multi-bagger investment continues to intrigue investors. With 2024 marking the highest number of investors in the history of Indian equity markets so far, the hunt for multi-baggers has grown exponentially. In this session, we'll explore how innovative alternative strategies, pre-IPO investments, distressed debt, and private equity are shaping the future of wealth creation. Our speakers will share their expertise on identifying game-changing opportunities and strategies that deliver a higher alpha for investors. We're indeed honored to have a distinguished panel of industry leaders joining us. Our panelists are Mr. Nishad Khanolkar, President, Bharat Value Fund, Pantomath Group. Mr. Nishad is a seasoned finance professional with over 24 years of experience in asset management, private equity, M&A, and investment banking. He's a chartered accountant and a member of CPA Australia. Previously CEO of SP Growth Partners, he plays a key role in launching SEBI-registered Cat 2 funds, including Bharat Value Fund, managing over rupees 5,000 crore across 3 series. Now, we have our next panelist, Mr. Rumesh Agrawal, SEVP and Fund Manager, 361 Asset. And Mr. Agrawal brings more than 25 years of experience across equity capital markets, private equity, and M&A. At 361 Asset, he focuses on investment strategies for pre-IPO and late-stage private equity opportunities, having completed over 90 landmark transactions and channeling billions into emerging corporates. His deep knowledge of structuring high-growth investments makes him an invaluable contributor to this discussion. We have with us Mr. Vicky Badani, Fund Manager, Whitespace Alpha Special Situations Fund. Mr. Badani, a seasoned finance professional and CFA charter holder, has over 15 years of experience across corporate finance, distressed debt, and private equity. With expertise spanning global debt markets, M&A, and SPAC transactions, he has a unique perspective on identifying and structuring alternative investment opportunities. Mr. Vicky's career trajectory reflects a deep commitment to delivering value in dynamic and high potential sectors. And those were our eminent panelists. This session will be moderated by Ms. N. Mahalakshmi, Senior Consulting Editor, Money Control, who also moderated a session early this morning. Ms. N. Mahalakshmi, a seasoned financial journalist with over 25 years of experience as a senior leader at Network 18, heading markets and economy coverage at Money Control. Previously, she served as editor of Outlook Business and Outlook Profit and led markets and investing coverage at Business Standard. She holds the rare distinction of being among the first Indian journalists to interview Warren Buffett, along with other global investment icons like Howard Marks and Joel Greenblatt. Ms. Mahalakshmi, it's over to you.
Thank you so much, Aishwarya. This is an incredible opportunity and an incredible session. Thank you, Kamal, PMS AIF, for this opportunity. This is one session I think I don't have to really do much at all, because the 3 speakers that we have for this panel have 3 distinct alternative strategies, and all we have to know is how do they go about picking whatever securities they do. What is their thought process, and how do they do it to ensure that you are able to deliver better returns, whether it is risk considering the asset class they invest in. And first, let me sort of pose this question to Nishad, who invests largely in pre-IPO kind of companies. Nishad, please tell me, we've seen a 20% correction. There seems to be a visible change in the sentiment in the market. What does this mean for the kind of funds you manage and the strategies that you pursue?
Thanks, Ms. Mahalakshmi. First of all, nice speaking to you after exactly 1 year. Last year on the same platform, you had interviewed me. So really nice. And thanks to Kamal and his entire team for giving me this opportunity. So right now, directly coming to answer your question, I'd like to give 1 or 2 sentences about what exactly the fund we do. So that would help me in answering your question in a much better way. So we are AIF2, in a simple way, unlisted to be listed. The one-line theme of my fund is very clear. Invest in those companies which are IPOable in next 2 to 3 years time. Because the segment that we work one thing is very clear in our mind. Most important factor in my segment is exit. Exit is the most important factor in life. So we only invest in the exitable opportunity. So we always believe that there are various stages of investments, but if you invest in substance, then returns are going to come. So for example, what we have done, for whatever money we have invested till today, 97% money we have invested as a primary capital. So what is primary? Primary is a growth. So when you invest primary, the balance sheet size means the revenue, profitability of the company increases. If the profitability of the company increases, valuation is secondary. Balance sheet size is primary. Invest the primary. So rather than giving a secondary money, we are given primary. Most of the money we are invested are in the asset-backed companies. So where the substance is there. Most second important is a profitable company. The 92% of the fund invested by us till today is in a profit-making company. So when the situation gets tough, so instead of, I believe my third fund was launched in the month of December, where unfortunately my fund launching and the market correction happened at the same time. It was not planned. So it was, we most of us will thought that it was a tough situation, but in tougher market also we could garner more than 1,500 applications and 1,500 crore of fundraising and more than 800 applications within a span of 60 days. If that can happen, if you talk about the substance and not only about the valuation, and that is the core crux of our fund, that invest in those companies which are IPOable in next 2 to 3 years times. No freebies, only and only where we see a growth potential, there only we are putting our money. So that has been the success ratio of fund 1 and fund 2, and same we are translating into the fund 3 also.
So coming back to the question I asked, which is that today there seems to be, at least compared to what we have seen in the last, our reference is only post-COVID period. But people like me who've been in the markets, at least covering markets for 25 years or so, will know that this is no correction at all. We've seen worse. We've seen 50%, 60% cut in markets. But there seems to be a lot of fear, and of course, foreign investors are selling, but there seems to be a shift in sentiment, and it's scaring people away. Now, usually when market sentiment turns, the first casualty is primary markets, because everybody who wants to go IPO doesn't get the kind of valuation that they are expecting. Promoters, are unwilling to IPO. The selling shareholders may not be prepared for the price that they were anticipating. So, in your perception, is this phase something that is passing from IPOing companies or pre-IPO strategy perspective? How do you look at the situation?
So coming back to the IPO experience, as a Pentomath group, the group has executed 112 IPOs in last 10 years. So that is practically one IPO per month. So I believe the worst year or financial year in last decade was 2018. 2018 was the worst year, and 2018 also we have seen good IPOs coming. So my answer still remains the same. Cycles will come and go. We can only predict the cycle. Catching the cycle is relatively tough. But if you have invested in good quality assets at a substantial, I will not use the word lower valuation, that is a wrong statement to do, but at a good market valuation, then whenever the situation improves, you are the first person to get out. What I mean get out is you are the first person to get exited. So basically when the market gets tough, the freebies gets the first hit. And a typical asset-backed, PAT positive companies where promoter having substantial shareholding, they are the last people to get the hit. And at the same time, when the situation improves, they are the first people to get the benefit. So that is how the quality of the assets really gets determined when you, if based on what kind of a quality investments you have done. So that is the reason always stick to the principles, and that is what we have stuck to our principles.
Sure. Nishant, we'll come back to more questions. I have more questions for you. But before we do that, let me get Vicky in. Vicky, you seem to be in a sweet spot right now, because all the equity investors are getting rattled. And when usually they get rattled with debt, they run away to, when they get rattled with equities, they run away to debt. So how is your asset class, and how are your strategies looking in the current circumstances?
Hey, hi. So I hope I am audible. I have some issues with my
You
camera.
are audible.
All right, right. So Mahalakshmi, I hope when you were referring, you were not referring to my personal portfolio when you're saying that the equity downturn obviously had an impact at the personal level. But yes, you are very correct. This the run up that we had seen in the equities was kind of going to a level where people were forgetting the asset allocation and the importance of diversification as we speak. So given the current uh, volatility that we are seeing, there is a good chance for investors to reallocate, to introduce some bit of debt in their portfolio. And where my fund is different from your traditional debt products is that my fund offers a combination of debt as well as equity. So, where Whitespace Alpha Special Situations Fund differs from your traditional debt allocation is that you are entering with the mindset that there will be some debt component to the investment which will keep returning certain cash flows to you on a periodic basis. And there will also be the upside that will come about when the thesis by which we've invested actually plays out. And in that 3 year, 5 year, 7 year investment horizon, you will actually see the equity investment generating the kind of returns that you were hoping to when you invested in
Hmm.
us.
Hmm.
So yeah,
And
so
yeah,
sorry,
sorry,
no.
please go on.
So
Please go
just
on.
to conclude, yes, we are seeing a pickup in the interest given the volatilities. I'll not say that I hope this continues, but I hope that people do evaluate their portfolios seriously from the perspective of diversification and do give debt their rightful place in
Right.
their portfolios.
Right. So my question was, so I was referring to the private credit fund that you look after. How
Right.
is that space looking in this environment?
Right. Uh, So private credit essentially is, banking. I'll not say banking the unbanked. It is kind of taking punts or taking risks where your traditional banking is not helpful. So any time that you would approach your traditional banking partners and they are either too defensive on banking or backing your particular call is when you try to tap into the private credit markets. Now, private credit markets in its essence is a combination of performing credit as well as distressed credit.
Right.
Performing credit, we all understand, is companies that have great cash flows, that have great ratings, and they are well covered with their traditional banking partners, but they have certain requirements which these banking partners are shying away from, which is where a private credit fund steps in. Obviously, because of the risk element involved, the pricing also is slightly better than what you would typically get from a banking product. When it comes to distressed market, the distressed credit investing space is an altogether different animal. Here you are evaluating lots of opportunities where there was some potential in the company at some time in the past, and perhaps in a mix, due to a mix of factors, the company is facing the current situation that it is in. That actually gives us a great opportunity to enter into the company, to set right certain things, and then see the whole thing correct and the valuations come along. So that is how the whole private credit space works, that you are investing with an element of debt first, with the potential to have an equity upside once your particular investment thesis is played out.
Sure, sure. And normally, what is the kind of return that you target for this fund?
So, depending on the kind of investment or the kind of allocations of debt and equity you would see in this thing, the pre tax returns typically range from 22% plus. In our fund, and we have seen that in the past as well, in certain investments that we've done from a prop book, we've seen IRRs exceeding 30%, and they are possible with the right combination of debt and equity. So as a fund, we've been uh, looking at investments, or the only investments that we onboard are ones that have the potential of delivering 30% plus kind of IRRs to us.
Hmm. But 30% kind of IRR in a fixed income, predominantly fixed income product, how do you straddle the risk?
So look, the basics of private credit investing involves 4 C's. You have your cash flows, you have credit, you have collateral, and then you have covenants, right? Credit is something that is currently under stress right now. You are hoping that, and that is where the evaluation comes in, that is this a sunset business, or is it a sunset industry, or is it a great business in the wrong, at the wrong time? If it is a right business in the wrong time, you would want to back such a credit. Cash flows, it has to have enough cash flows to be able to return your capital. The collateral is kind of the downside protection. The governance is what will instill the financial discipline into the company. And once you have all of this coming together, what will happen is that the equity investment, or the value of your equity that you have invested, will give you multifold returns. So the debt element will be a standard 18% to 22% kind of a coupon, because you cannot load more than that, otherwise the whole business will just subside. So that's why what you're hoping is that the valuations at which, or the multiples at which you would have invested into the company, would grow multifold once the business has right sized, once the operations have stabilized, and once the theme is played out. So over a 5-year horizon, you would see the value of your equity investment growing 3x 4x, which kind of aggregates to a 30% return overall on your investment.
Right, right. So again, I have more questions on that, but let me first get Unmesh. Unmesh, you predominantly invest in pre-IPO and late stage. First of all, tell us your strategy, and under the current circumstances, how do you see these strategies working out over the next 3 years?
Yeah, hi. Thanks, Malakshmi. So we look at any investment in a company which can IPO, say 1 month to 4 years from the time that we invest. So which means that we also look at post DRHP situations, and we also look at late stage growth situations which can IPO in the next 3 to 4 years. So we have essentially three pillars, or three filters. The first is growth. We predominantly look at only those companies which are growing faster than their industry. Okay. To put some number to it, we need a minimum of 15 to 18% growth in revenues as the first filter, and in a large total addressable market, or the TAM as we call. So that is, and the revenue growth should also result into a doubling earnings in the next 3 years. Okay, so this is the first filter, that you should be growing faster than industry in a large market with doubling revenues and with doubling earnings in 3 years. The second important filter we have is a limited peer set, meaning when this company goes to the market, at that time, there should not be like dozens of companies which are very similar to this company already listed, because the market likes something new. Naya kya hai? Is company mein naya kya hai? That is the question, right? So we try to look for something unique. Now that uniqueness could be in just a new business, okay, or it could be an age-old business but with a very differentiated business model. So something which is new or different. That is something we really focus on. The third and the most important is the pricing discipline. Here, since we are late stage, pre-IPO, and IPO is our primary source of exit, we tend to get pushed by issuers and bankers to look at comparisons to public market multiples, right? But we keep reminding ourselves and to the companies that, look, this is a private company, and there is all the risks of IPOs getting delayed, etc. So there has to be important 15-20% illiquidity discount. Okay, so pricing discipline. And coming to your point of what is happening right now in terms of softness in the market, actually is fantastic for us, because the pricing is getting sensible, is getting better. We are already seeing at least a 10 to 15% correction in ongoing transactions. Okay, in some exceptional cases is even higher. And we are also seeing good companies saying, okay, I don't want to do such a large IPO transaction at these lower valuations. Can we do a private deal? So we have the flexibility to go from 100 crores to 500 crore of deal size. And we are seeing at least one company or one transaction right now, which is moving from an IPO to a private deal. For me, also the deal size is shooting up from 100 to 400 crores, and the company will relook at IPO after 2 years. So, so current
So
market
you're saying your playing ground is essentially widening.
is widening. Yeah. So we
Okay.
are actually in a way happy that there is some sensibility coming in the pricing.
Okay. So, which also means if your deal, playground for deals is widening, doesn't it also means that the playground for IPOing companies is shrinking?
You can say that, but
Which means a problem for exits.
not really. So for example, this one specific deal I talked about. Of course, I'll not get into the details of the deal, but the deal was a 700-800 crore IPO, and it is moving to 400 crore of a private deal. So where there is some primary and some secondary happening, right? So the deal size is shrinking, but the company is getting at least part of the capital it wanted, and some private equity is at least getting part of the exit that it was seeking, and they will relook at the IPO in 1.5 years or 2 years. So and this is it's temporary. See, earlier in the 2010 to 14, there were only 3 or 4 IPOs in a bad year, and then the market turned. 2017 saw 50 IPOs, 18 saw very few, but now these cycles are becoming shorter. So markets they will shut for 1 or 2 months and they will come back. We saw a blip in September, we saw a blip in March of 24, we saw a blip in November 23. So these cycles are becoming faster and shorter.
Sure, sure. So, Nishad, I'll come back to you. In terms of pricing environment, I mean, last year was great for IPOs, and this year, I think, barring January, before January, we were still thinking that this year is going to be 2025 will be even bigger. Has January, the way the markets have reacted, is it tempering your expectation in terms of how many IPOs will we be able to push through? And second, do pre-IPO investors also need to temper expectations in terms of returns going forward? And what are you telling your clients?
So I want to break down this into the two parts. For investors to understand, there are two parts to the IPO. First is getting the DRHP approved.
Right.
Your DRHP approved has got direct relation to your compliances. Your profitability, for example, you are working in a certain sector, your segment profitability is 12%. If your profitability is 10%, still you can get the DRHP approved. But if your compliances are weak, Ms. Mahalakshmi, then forget your IPO. Most important, complete the compliances, which is a tougher task, and regulators have improving their making it stricter day by day, which is good for the public. I do appreciate that. So first of all, complete the compliances. That is what we do. The day I invest into any company, the most important factor in next 2 years, I take charge of the compliances, because ultimately your IPO coming or not coming, the biggest hurdle is compliances.
Right.
So once the DRHP is done, according to me, 80-90% to काम हो गया.
Okay.
Then I do agree, SIP ki amount 25,000 crore per month, it is not going to go down. Cyclically, it will come up and come down. I cannot comment on that. In large year, what is the event that are not gone against us post-corona? Corona is a gone event. There was a war in Russia. Gaza में बम फट गए. Cyclical events आते जाते हैं. But the periodicity, the length, have a trust in Indian economy. Have a trust in Indian economy. It has to bounce back. Either 1 month, 2 months, 3 months, or 4 months, not beyond that. And we are not in a product where we have to get out on Friday morning. Once you get the DRHP approved, technically you have 1 year window to get the approval. Next 1 year, we can't expect that throughout 1 year market is going to get down. That is, we are talking about a very tough situation. So that's where we play out that, okay, markets are down. For example, I'm bringing my EPC company, I just got the approval. Okay, I may not get a 30p multiple, I may get at a 25p multiple considering your market is down. But the multiple at which I have entered is 11. So I'm still in a down market also, I'm sitting 2.5 times. So ultimately, I go back to my own expectation that what is your entry level that determines the exit. I always say to all the investors, in fund management, you do not make money on the date of exit. You make money on the date of entry. एग्जिट के दिन सिर्फ एग्जीक्यूशन होता है.
Correct.
एंट्री अच्छी करो, enter well, exit is by default taken for granted, plus or minus 2 months here and there. So all the concentration goes on the entry.
Right. Fair enough. So, so my question is, what kind of return expectations do you? What are your expectations in terms of what your returns could be from 1 to 3 years? And these funds are like typically, what is the tenure?
So my tenure is the regulated tenure is of course 5 years.
Yes.
From the first close, because SEBI has removed the final closure tenure, so 5 years from
Correct.
the first closing. But of course, cash flow point of view, we have a 30 months exit clause in all investments that we have done. So we always tell our investors, cyclical event will come. So assume not 30, 36. So cash flow point of view, my fund would be 3 years on a
Right.
higher side, considering the
Right.
cyclical event that you have been asking time and again.
Yeah.
But SEBI point of view, it's a 5 years. Because
Right.
SEBI calculates from the first entry and the last exit
So your 36 months can become 5 years. That's it.
on a higher side.
Right.
Don't
And
take 2
your
years extension.
returns
Yeah,
and
sorry.
your return expectation on these products is?
So I believe that this call is getting recorded and all three will have the
Okay.
same issue. SEBI does
Okay.
not
So
permit
this is
any
no
of the
assurance.
fund
Yeah, this is
managers.
no assurance of a fund, but okay.
But the past performance has been good. The first series that we have done, we are expecting. We are recently given one exit as almost 10 times in for the first closing people, 10 times in 17 months. The second exit, I'm expecting almost close to 4 to 5 times in probably 13 or 14 months from the date of entry. Of course, I don't want to give a false expectation. Every day is not a
Yeah.
but overall, the MOSE, what we typically call the multiplier on invested capital for my first series, is definitely in more than 3 times over a period of last little more than 1 year. So that
Right.
has been the story of my fund. But of course, वो बोलते हैं ना rare view में देख के गाड़ी नहीं चलाने का. So it's the
Correct.
same way. So because this is call is getting recorded, I want to put the
Correct.
disclaimers time and again.
Sure. Fair enough. So, Vicky, coming back to you, and I want to pick on a point that you talked about, that you said that, in normally on the debt that you pick up, you look at about 18 to 20% return, and anything over and above that is like an equity optionality. Is
Right.
that correct?
Yes, that's correct.
Yeah. So now I'm just wondering, how many businesses do we really have, sustainable businesses, which can afford a 18 to 20% cost of debt and still be, still see an upside in terms of equity?
So the way
I
that
mean,
you
it's from a,
no, so the
yeah,
way that you evaluate these investments is what is the size of debt compared to the cash flows that it can generate.
yeah,
The very first pillar of private credit, when I talk about cash flows, what I am looking at is that once the operation stabilizes, what are the kind of cash flows, what are the kind of free cash flows, what are the kind of EBITDAs that the company is going to generate. Will that EBITDA be sufficient to service my 18%, 20%, 22% kind of coupons on my private credit debt that I would on the debt that I would have loaded onto the balance sheet? If it
no,
can
my
only
question, the reason I'm asking this question often, and I'm today talking about everything from the prism of where we are in markets today and where the economy is right now. I mean, we're just seeing signs of a slowdown for just one quarter, maybe this quarter. I mean, we've slashed our expectations for economic growth for the
right,
coming year, and we're
right,
coming off a high. So we don't know what is in store. It is good for us to be optimistic and say that, this growth is not getting altered significantly. But
right,
in all of these products, to temper our own expectations, we need to look at what is the stress case scenario, and
right,
that's why I'm asking this question.
right.
That in India, do we have enough businesses which have such level of competitiveness or profitability that they can afford to assume a 20% cost of debt and yet be able to navigate a downturn?
Right. So, to be honest,
Because
the space that we operate in, we are in the SME segment. Our ticket sizes are such that our ideal investment would be an SME which wants to become a mid market or a large player. We don't typically target a large player. We typically target these SMEs that want to then become middling kind of players where uh, what's important is sizing the debt. If you ask me, are there enough businesses in India that can service an 18 to 20% kind of a debt? There are very few businesses that can do that. The 18 to 20% coupon matters if the size of the debt is equal to the size of the revenue. If my debt is only 1/5 of the revenue and the margins are 15% plus, what I am looking at is essentially a 3 to 4% kind of an interest cost over an annum, as against a 15% EBITDA. So it is important to size your debt such that, as I said, that the debt will instill discipline. Since this company is coming off a distressed scenario, you don't want to give them free reins such that they again make reckless decisions. I mean, if you're working with the promoters, if you're yourself running the company, then you can instill everything. But if you're working with a promoter, you want to instill or have appropriate guardrails such that your investment is not at risk at any point in time. We understand risk. We understand that there is risk in every investment. What is important is how do you price that risk and how do you safeguard your capital. So there are these metrics that we use as our indicators when we are sizing the debt. If there is a capital required in the company which is over and above the adequate size or optimal debt that the company can service, we would, if we are gung-ho about that investment, we would take an equity call on that. So every investment that we do it as a mixture of debt and equity. I mean, to be honest, this debt and equity thesis was very relevant pre 1st February, because there the returns that are generated would get taxed in the hands of the investors as an interest income or as capital gains. Now everything is removed for capital for Cat 1 and Cat 2. So I still have that leeway, or I use it as a lever. That I do see 18 to 20% returns guaranteed from day one for the first 2 or 3 years, and then once that debt is paid off, once it starts getting regular banking, its valuations and attractiveness to other investors will go up, which will result in returns to my equity portion.
Sure. Unmesh, would you like to highlight something in terms of risk in this? And you have already said that we look at this ongoing correction as an opportunity because the opportunity set is increasing and it's a good hunting ground. What would you highlight as risk and how do you cover?
Yeah, I think I would place risks maybe in uh, 2 or 3 buckets. Okay, one bucket is where we are remaining invested for 3 to 4 years, and as I said, the first filter is I want revenue to grow at 15 to 18 and earnings to double, right? So here, see, in sectors like consumer, for example, we see that companies tend to underestimate the investments in distribution, in marketing, in building in the dealer network. Okay, and we see so many business plans where they say that my investments will go down and the sales will go up. This never happens. In the healthcare sector, for example, we see that the regulatory processes, the approvals are also undermined by the managements, and we've seen lot of delays because of that. So we also have to factor in that again. It's an important pillar in the revenue growth story. On the manufacturing side, the key thing we find is companies, left, right, and center, they're expecting their margins to improve, but it's very hard to improve margins in the manufacturing sector. Very hard to improve their working capitals. So these are risks on the business side, which is very important to be very pragmatic to be pragmatic about. The second aspect of the risk, which we are seeing increasingly, because as we are a pre-IPO fund, but we don't exit in the IPO. Like we exit maybe 25% of what I own in the IPO. Say if I own 10% of a company, I may sell 2 or 3% in the IPO, and then I would like to sell post-listing. But we are seeing increasingly a large number of companies with financial investors who are owning a large part of the cap table. So this supply overhang is becoming increasingly a big problem. that anywhere between 20, 30, 40, 60, 70% cap table, post listing is looking for exit in the public market. And I don't think our markets are that deep. And then you have 70, 80 IPOs coming every year, right?
Right.
So I don't think our markets are that deep to absorb this kind of supply. So increasingly, we are getting very concerned about the supply overhang and prioritizing companies with high promoter ownership. Okay.
Right.
That is the second. I think this ongoing correction is not really a challenge because, as I mentioned earlier, these cycles are short. Things can go back. They can fall back in place in as short as next 8 weeks. So I don't see this as a problem. The India story is not dented. It's a little bit of a pause, which is very healthy for deals. It's very healthy for this crores of retail investors who are buying as if there's no tomorrow. It is a
Right.
good wake-up call. It's very healthy for
Sure.
everybody.
Sure. So, Nishad, you can have the last word. How bullish are you compared to 2024 right now?
Of course, you are bullish because the India growth story is there. And again, I want to say only one thing: cycles will come and go. Don't try to chase them. Be a long-term investors. You are tend to make the money. You tend to make the money. And whatever has happened today, those who have money in hand, especially the funds like me, we are able to find something. I would not use the word cheaper because that's a wrong way, but at a good valuation.
Sure.
So entry determines the exit.
Sure. On that beautiful note, thank you so much, gentlemen. It was a fairly good session. I quite enjoyed it. Thank you so much for joining this evening. Over to you, Aishwarya.
Thank you very much once again to our eminent panel and to you, ma'am. And with that, we wrap up an incredible first day of the PMS AIF World Summit. On behalf of PMS AIF World, a heartfelt thank you to our esteemed speakers and moderators. Your time, insights, and wisdom have truly enriched today's discussions, setting the stage for meaningful conversations ahead. A huge shout out to our event partners. Your support makes this platform possible. With 16 partner associations, your belief in curating knowledge-driven investing is what fuels this summit. So special thanks to all our partners. Our title partner, ICICI Prudential AMC, Platinum Partners 361 Asset and Ampersand Capital, Gold Partners Alternates by Axis AMC, Carnelian Asset Management and Advisors Private Limited, Tata Asset Management, White Space Alpha and Right Research. Our silver partners, Blink Investment Management Private Limited, Generational Capital, Invasset LLP, Neogen Capital, Prudent Equity Private Limited, Code Invest, Sundaram Alternates, and Volvin Limited. And of course, a big, huge thank you to you, our attendees and our viewers. Your engagement, your questions, your passion make this event what it truly is. Now, tomorrow will be a powerhouse of insights with industry titans like Amit Jeswani, Anirudh Garg, Sameer Arora, Rajesh Kothari, Arun Subramaniam, Samit Vartak, and many, many more. And we have 6 impactful sessions lined up tomorrow, leading to the industry's most prestigious PMS and AIF Awards 2025, which are going to be held in association with IIM Ahmedabad. This is the place to be if you're serious about navigating the future of investments. So rest up, recharge, and come back ready to dive in. We'll see you at sharp 10 a.m. right here, www.pmsaifworldsummit.com. Until then, stay safe, stay sharp, and most importantly, stay invested. This is your host, Aishwarya Singh. I have to sign off now. I'll see you tomorrow at 10 a.m. sharp.